Hello cainter students, at your request we prepared this 100% English marathon on income tax subject recorded by our expert faculty member Ramakrishna sir, having more than 14 years of rich teaching experience. This 12 hours focused session is designed to ensure you to score 30 plus marks in public exams, and here is an outline of the chapter wise coverage in this 12 hours detailed in-depth learning marathon. Chapter wise timestamps information is already provided in the description of this video. If you appreciate our content, click the like button so that YouTube can recommend this video to more number of students. If this video has been helpful to you, kindly share it with your friends so that they'll also gain benefited from it. So share your feedback in the comment section. It will definitely inspire us to create more videos like this. Exclusive materials used by the faculty in this marathon are available for free download, and here is the step-by-step process with which you can freely download the same. First, in an Android mobile or an Android tab, install our app Masterminds Online Classes from Google Play Store. In the home screen, click the three horizontal lines icon in the top left corner and select the free marathon material option. In the Documents tab, you will find the required folder. Open it using Acrobat Reader or some other PDF reader app in your mobile. You can download or share it, or you can even take a printout of the same. Marathon videos of all the remaining subjects of CA Inter are already available in our YouTube channel, that too recorded in 100% English. Please check the available playlist. Subscribe and press the bell icon so that you will never miss an update. Now start enjoying the marathon video. All the best, my dear students.
Good evening, students. Hope you are doing well. This is the marathon session for income tax subject applicable to January 2025 attempt. So, and I am sure about that, and I promise you that I will be covered all the important topics in each and every chapter. Okay, and one of the important point will cover the amendment areas also. And one more important point here is, so we'll discuss all the topics in each chapter where the students have been suffering some difficulties. Okay, so listen carefully. This video is very much useful to you for upcoming examination January 2025 attempt. Okay, so now coming to the main discussion. So first one is residential status, my dear students. So in residential status, there are 4 sections involved in this chapter: section 5, section 6, section 7, section 9. Okay, so section 7 is an unimportant section. So except that rest of the remaining 3 sections are very important. I will discuss you. So, and I will discuss all the main topics in these 3 sections: section 5, section 6, as well as section 9 also. Okay, so first of all, section 6. Section 6 says that how to determine the residential status. That's the important section 6. So determination of residential status. Okay, so section 5 deals with the scope of total income. Section 9 deals with income deemed to accrue or arise in India. Section 9, income deemed to accrue or arise in India. Okay, these are the important sections in residential status chapter. Residential status. Okay, we'll discuss one by one. So first of all, want to start with section number 6. Okay, section 6. Section 6 deals with how to determine the residential status of a person. Person includes, so there are 7 types of persons involved in the person definition. Section 6 deals with for all those persons, the status determination shall be made according to the section number 6. Okay. So the rules and regulations for determining the residential status of each and every person covered in the definition of person deals with section number 6. Okay. So verify the residential status of each and every category. First one, individual. Second one, HUF. Third one, company. Fourth one, all other persons. Okay, have you understood? First, let's start with the status relating to individual. My dear students, please, so individual status is most important. We should mainly concentrate in this area in this marathon session. Okay, individual status, most important. So when compared to other three persons, HUF, company and other persons. In this marathon session, we should mainly concentrate on how to ascertain the status of individual. Individual is having three types of statuses, ROR, RNOR, NR. Okay. So first of all, in general cases, exceptions. In general, how to ascertain the residential status? My dear students, there are 4 conditions involved in section number 6. 2 basic conditions, 2 additional conditions. 2 basic conditions, 2 additional conditions. For ascertaining the main status, that is resident or non-resident, need to verify basic conditions, B1 or B2. If any one of B1 or B2 satisfied, then he shall be treated as a resident. Any one of the B1 or B2 satisfied, then he shall be treated as a resident. And if both the additional conditions were satisfied, then he shall be treated as a ordinary resident also. Okay, my dear students, when the individual gets the status of ROR is nothing but if he was satisfied any one of the basic conditions and both the additional conditions. In this case, the individual gets the status of ROR. If he was satisfied any one of the basic conditions and only one or none of the additional conditions, then he shall be treated as a resident but not ordinarily resident. If he was satisfied none of the basic conditions, then he shall be treated as a non-resident. Okay, so in general, while calculating the residential status of individual, need to verify B1 or B2. B1 or B2. If any one satisfied, then he shall be treated as a resident. Whenever he was resident in India, then again go for additional conditions for ascertaining his ordinary status. So then verify additional condition 1 and additional condition 2, A1 and A2 also, for ascertaining his ordinary status. My dear students, in general cases, need to check B1 or B2 for ascertaining the main status, and need to check additional conditions also for ascertaining his ordinary status. Okay, so but here so many of students are having doubts in that area, that is exceptional cases. My dear students, in general cases, need to verify all 4 conditions, B1, B2, A1 and A2. But in exceptional cases, the procedure is something different. Okay, so what are those exceptions? There are 2 exceptional cases. Exception 1, Indian citizen. Exception 1A, leaves India for employment or self-employment. That is for permanent settlement. That is one of the case covered in exception 1. Okay. So, or another case covered in this exception B. Indian citizen leaves India. As a crew of an Indian ship. So these are the two cases covered in exception 1. In these two cases, most important point here, need to check only basic condition 1. B2 is not applicable here. Need to verify only B1. B2 is not applicable in these two cases. If B1 was satisfied, then need to verify additional conditions also for ascertaining residential ordinary status. A1 and A2 also applied here if B1 was fulfilled. So, my dear students, exception 1, there are two cases involved in this exception. In these two cases, the procedure is here. Okay. So, what about exception 2? Exception 2. Indian citizen or person of an Indian origin comes to India on visit. So, this is the exception 2. This is one of the important area. This exception will be classified as two parts. Okay. So, I will explain you, just wait. Based on the total income of the assessee. So, if the total income other than the income from foreign sources, don't consider the foreign sources while calculating the total income in this case. Okay. So, total income other than the income from foreign sources, case A, if it does not exceed 15 lakhs, that is less than or equal to 15 lakhs, more than 15 lakhs, A, B. In exception to part A, part B. Have you understood? So, if it does not exceed 15 lakhs, what is the treatment? If it exceeds 15 lakhs, what is the treatment? If it does not exceed 15 lakhs, the treatment is need to apply B1 only. Same as exception 1. The treatment is same as exception 1. Same treatment. B1 only need to verify basic condition 1. If B1 was satisfied, need to verify additional condition also. A1, A2. Have you understood? Exception 1, exception 2 part A. The treatment is same in these both cases. Okay. And what about part B? Part B is most critical and complicated area. In part B, if total income exceeds 15 lakhs, need to verify B1 or modified B2. Modified B2 is nothing but the basic condition 2 was slightly changed. Replace 120 days instead of 60 days in basic condition 2. That's the modified B2. That is stay in India during the current previous year at least 120 days and preceding 4 years aggregate stay in India at least 365 days. That's the modified B2. Okay. So, if B1 or B2 need to verify B1 or modified B2 also. If B1 was satisfied, then need to verify additional conditions 1 and additional condition 2 also. Need to verify additional conditions. If B1 was fulfilled, that's the most important observation here. So, if modified B2 was satisfied, then need not check additional conditions. Don't verify the additional conditions if modified B2 was satisfied, because he shall be directly treated as RNOR. That's it. he shall be directly declared as resident but not ordinarily resident. Need not check additional conditions if modified B2 was satisfied. Go for additional conditions only if B1 was satisfied. That's the main area for residential status of an individual. Have you understood the student? So in general, need to verify all 4 conditions. In exceptional cases, the rule is something different. In exception 1, need to verify B1 only. If B1 was satisfied, then go for additional condition. In exception 2, part A, need to verify B1 only. If B1 was satisfied, then go for additional condition. Exception 2, part B, B1 or modified B2. Need to verify B1 as well as modified B2. If B1 was satisfied, then go for additional conditions for ascertaining his ordinary status, whether ordinary resident or not ordinary resident. If modified B2 was satisfied, then don't go for additional conditions. Here, additional conditions are not applicable. He shall be directly declared as resident but not ordinarily resident. This is the clear picture of the residential status of individual. Okay, so what the condition says that stay in India during the current previous year. What is our current previous year? Previous year 23-24. So in current previous year, at least 182 days. Stay in India for at least 182 days in India. If anybody from any country visit to India and stay in India during the current previous year, 23-24, at least 182 days during the current previous year, then so he shall be satisfied basic condition 1. Okay, that's the B1. B1 says that stay in India for at least 182 days during the current previous year. What is our current previous year? 23-24. If B1 was not satisfied, then go for B2. B2 says that in current previous year, that is 23-24, stay in India at least 60 days. And in preceding 4 years, is nothing but 22-23, 21-22, 20-21, 19-20. In preceding 4 years, aggregate stay in India at least 365 days. These 2 parts will be combinedly satisfied. Then he will be satisfied on basic condition 2. B2 says that stay in India in current previous year at least 60 days, and in preceding 4 years, aggregate stay in India at least 365 days. That's the basic condition. If any one of these 2 conditions were satisfied, then he shall be treated as a resident. But B2 is not applicable in exception 1, exception 2. B2 is not applicable in exceptional cases. However, in exception 2, part B, B2 will be applied but subject to some change, that is modified B2. Replace 120 days instead of 60 days. That's the modified B2. Okay. So next, additional condition 1 says that in preceding current previous year, what is our current previous year? 23-24. In preceding 10 current previous year, preceding 10 years, at least 2 years resident in India. That's the additional condition 1. Have you understood? Resident in India for at least 2 years out of 10 years preceding the current previous. Additional condition 1. Okay. Next, additional condition 2. So what is our current previous year? 23-24. The preceding 7 years. The aggregate stay in India is at least 730 days. stay in India for at least 730 days in preceding 7 years. So that's the one of the important point. These are the conditions to verify for ascertaining residential status of an individual. My dear students, next, generally if any individual gets the status of resident in India, compulsory comes to India and visit India at least for B1 182 days, B2 at least 60 days, exception 1 at least 182 days, exception 2 part A at least 182 days, exception 2 part B at least 120 days. So stay in India is mandatory to get the status of resident. My dear students, most important area here is there is a status called as deemed resident under section deemed resident under section 6(1)(a), deemed resident. So sometimes that non-residents also shall become a deemed resident in India subject to 4 conditions. Okay, so deemed resident concept is also very important in examination point of view. Deemed to be treated as resident, actually he is not a resident, that is he is a non-resident. Non-residents also sometimes falling under the definition of deemed resident. Okay, but subject to satisfaction of 4 conditions. Condition number 1, conditions to get the status of deemed resident: he must be an Indian citizen. To get the status of deemed resident, compulsory he must be an Indian citizen. And second one is not satisfied the any of the basic conditions specified in 6 subsection 1. Not satisfied any of the basic conditions. Specified in section 6 subsection 1. Not satisfied the any one of the basic conditions, either B1 or B2. So if he was satisfied any one of the basic conditions, then he shall be directly treated as a resident, actually treated as a resident. Why the deemed resident concept is applicable in that? Because he will be actually resident in India if B1 or B2 was satisfied. Therefore, to get the status of deemed resident, he was not satisfied any one of the basic conditions. Okay, then only the question of deemed resident concept gets attracted. And third one is his total income other than income from foreign sources exceed 15 lakhs. Total income other than income from foreign sources. Exceed 15 lakhs. And such income was not taxed in any other country. Not taxed in any other country due to any reason. And all these conditions must be specified in section 6 subsection 1A, then he shall be treated as a deemed resident. All these conditions must be satisfied to get the status of deemed resident. Okay, my dear students, compulsory, please observe that non-residents sometimes gets the status of deemed resident. And one more important, so to becoming an actual resident, compulsory stay in India is mandatory, but to becoming a deemed resident need not stay in India. The stay in India is not relevant. Even if assessee's stay in India during the current previous year is nil, then he may get the status of deemed resident subject to fulfillment of these conditions. Stay in India not required to get the status of deemed resident. That's the very important conclusion. Stay in India is not required to get the status of deemed resident. Even if associates stay in India during the current previous year, nil is also becoming a deemed resident, subject to satisfaction of the following condition. And one more important point, if these conditions were satisfied, then he shall be treated as a deemed resident. Then don't verify the additional conditions. Here also additional conditions not applicable. He shall be directly declared as a RNOR. Need not check additional conditions. Here additional conditions not applicable. Additional conditions not applicable because deemed resident always be treated as resident but not ordinarily resident. That's the status of deemed resident. Directly declared as RNOR. Then why to check the additional conditions? Not required. Have you understood? So this is the concept relating to deemed resident, which is also very important in residential status chart. Please observe that there are some note points are there. One is foreign citizens not covered in exceptional cases. Never covered the foreign citizens in exceptional cases. Foreign citizens always be covered in general cases. Need to verify all the conditions. If you want to solve the problem relating to foreign citizens, you go for general rule. Need to verify B1 or B2, A1 and A2. Exceptions are available only to Indian citizens, person of an Indian origin. Okay. Next topic is section 5. Section 5. So, and one more important, I want to give you some clarity about residential status of other persons also. So, for example, residential status of HUF. Residential status of HUF. HUF is nothing but resident or non-resident shall be decided based on control and management. That's the important sentence. Control and management fully or partly in India, then it will be treated as, then such HUF shall be treated as a resident in India. Okay. Otherwise non-resident. That is, if control and management wholly outside India, then it shall be treated as a non-resident. That's it. Simple. Control and management fully or partly in India, then it shall be treated as a resident. Control and management wholly outside India, fully outside India, then it shall be treated as a non-resident. That's the simple explanation. So nothing, I think individual status is very important. Okay. So HUF status is too easy to determine. Please concentrate on the place of control and management. Control and management fully or partly in India, then it will be treated as a resident, otherwise non-resident. But what about ordinary status? If Karta satisfied additional conditions A1 and A2, if Karta satisfied A1 and A2, so then such HUF shall be treated as ordinarily resident also. If Karta satisfied one or none of the additional conditions, then it shall be treated as not ordinarily resident. That's it. For deciding whether the HUF is resident or non-resident is based on control and management. So control and management fully or partly in India, then it shall be treated as a resident. Wholly outside India, then it shall be treated as a non-resident. Okay. So for deciding whether the HUF is ordinarily resident or not ordinarily resident, it purely depends on satisfaction of additional conditions by Karta. If Karta satisfied both the additional conditions, then it shall be treated as an ordinarily resident, otherwise not ordinarily resident. That's it. Simple. Next one, companies. company, Indian company, foreign companies. One of the important point here is all Indian companies are always resident in India, irrespective of place of business, irrespective of place where the company was located, irrespective of the shareholding, even if it was held by non-residents. It's all irrelevant data. If it was registered in India, then it shall be treated as resident in India always. Okay, always resident in India. Always resident. Okay, but important point here is foreign company may become resident or non-resident, depends on place of effective management. That's the important area. Okay, so how to decide the residential status of foreign company? Resident, non-resident. So how to decide it? As based on place of effective management. Place of effective management in India, then it shall be treated as a resident. If place of effective management outside India, then such foreign company shall be treated as a non-resident. That's it, simple. But here the place of effective management concept is too difficult because it's an out of syllabus topic, because it will be clearly discussed in CA final. So now at present, please concentrate on board meetings only. Place of effective management is nothing but conducting majority of the board meetings. Okay, place of effective management. If it was located in India, resident, otherwise non-resident. The question of ordinary status not available to company. Company, either foreign company, either may be resident or non-resident. Ordinary status is not available to company associate. That's it. Okay. Next, all other persons. Other persons, same as HUF. Here also, please concentrate on control and management. Same control and management, fully or partly in India, then it shall be treated as an resident. Otherwise, non-resident. Same as HUF. Whatever the rules applicable to HUF is applicable to other persons. But the difference between HUF and other persons is ordinary status is available to HUF but not available to other persons, except that the rest of the data is same. Okay, that's the end of section number 6. Next, I'll give you a practical example for section number 6, a simple example for better understanding. To start section number 5, which is also very important section, how the residential status affected on total income of the associate. Residential status, how affected on total income. Effect of residential status on total income will be observed in section number 5. So the section 5 heading is scope of total income. Okay, so section 5, I want to say some important information in section 5. So generally in each and every income, there are two elements involved. One is place of generating such income, that is place of accrual, and place where such income was received by the associate, that is place of receipt. Sometimes these may be located in two different places. Then how it will be taxed? In the hands of ROR, RNOR, NR. It will be discussed in section number 5. Okay, so place of accrual, place of receipt. Place of accrual is different from place of receipt. Place of accrual is nothing but place where the income was generated, the place where the source of income was located. It's called as place of accrual. The place where the assessee has received such income actually is called as place of receipt. So for taxability of any income in any person, in the hands of any person, is purely depends on these two elements. Okay, so I'll explain. It's a tabular form. Place of accrual, place of receipt. ROR, RNOR, NR. So the first point is place of accrual in India. Place of accrual in India. Place of receipt outside India. If place of accrual in India, but place of receipt located outside India, then it will be taxable in the hands of all assessees, irrespective of residential status. Always taxable. Okay. Next, place of accrual outside India, place of receipt India. Here also taxable in all cases. So the conclusion is either place of accrual or place of receipt. If anyone located in India, then it will be taxable in the hands of all assessees, irrespective of residential status. Okay, that's the important observation. If anyone located in India, if place of accrual located in India, then receipt is irrelevant. No need to check place of receipt because accrual already located in India. Then blindly it will be taxable in the hands of all assessees, ROR, RNOR, NR. Okay. Next point. What about if both located outside India? This is the important area. Outside India, outside India. Even in such case, the first party is liable to pay tax. That's the ROR. Taxable, not taxable, not taxable. Most important point, if both located outside India, still ROR is liable to pay tax to the government. Now, one more important point here is both outside India, outside India, outside India. If both outside India, generally taxable in only first case, that is the third case. Generally, if both located outside India, then it will be covered in third point, taxable in only first case. But in addition that, if both located outside India, in addition that two more conditions was satisfied. In addition that, the income is pgbp, the head of income is pgbp, and the business controlled from India. Or profession set up in India. The business was controlled from India or profession was set up in India. There are four conditions here involved. One is place of accrual outside India, place of receipt also outside India. Accrual outside India, receipt outside India, PGBP head income, the business controlled from India. Or if it is a profession, the place of set up such profession in India. If it is a business, please concentrate on place of control. If it is a profession, please concentrate on place of setup. In this case, the taxability will arise in two cases: taxable, taxable, not taxable. That's it. Okay. There are four conditions involved in this point. If all four conditions were satisfied as it is, then it will be taxed in the hands of ROR or NOR. Have you understood? That's the important point. If any of these conditions were not satisfied, then it will be covered in third point. Then taxable only to ROR. That's it. If it is not a PGBP income, then covered in third point. Taxable in only first case. If control was not located in India, then covered in third point. Taxable in only first case. That's it. Have you understood? I will give you a small example for this. Just wait. Next, point number 5. Past foreign income. Whether taxed or untaxed, brought into India. During the current previous year. Not taxable in all cases. Okay. because such income is not at all related to current year. It's a past year's income, never taxable in India. Next, last one, exempted incomes. Not taxable in all cases. That's it. This is section number 5. Have you understood? If you observe clearly this table, then you can answer any question based on this section. This section is also very important in exam point of view. Okay. So next, go to the section number 9. Section 9, number 9, deemed to accrue or arise in India. So I want to discuss only one area in this this table is very important in section number 9. This table deals with royalty, interest, fee for technical services. When these incomes shall be deemed to accrue or arise in India. If it is deemed to accrue or arise in India, then taxable entity. Otherwise not taxable. Section 9, reading section 9 with a view to that always the assessee is a non-resident. Okay, non-resident viewpoint. Prepare this section with a view to the assessee always be non-resident. If assessee is a ROR, then the no relevance for deemed accrual, because ROR is always taxable in India, irrespective of place of accrual. Why deemed accrual is relevant in case of ROR? Is always liable, even if place of accrual not located in India. So section 9 is applicable only to non-residents. Read this section carefully with a view to non-resident assessee. Okay, so next, interest, royalty, fee for technical services. Interest, royalty, fee for technical services. I give you the details about these 3 incomes. Interest, royalty, fee for technical services. Fee for technical services. Case 1. There are 3 cases involved in this. Case 1, case 2, case 3. First of all, what is the case 1? Case 1 is nothing but if these payments made by Indian government to non-resident. So government to non-resident, payable by government to non-resident. Recipient non-resident, payer government. Second case, resident to non-resident. Third case, non-resident to non-resident. That's the important observation in the difference between all 3 cases. The payer is the payer was changed. In first case, the payer is government. Second case, the payer is resident. Third case, payer is non-resident. Of course, in all 3 cases, the recipient is non-resident. Here, the assessee is a non-resident. The income is taxable in the hands of recipient. Here, the recipient in all 3 cases is non-resident. Okay, so how it will be taxed? Is it treated as a deemed to accrue or arise in India or not? Deemed accrual in India or not? If deemed to accrue or arise in India, then it will be taxable in the hands of non-resident recipient. Otherwise, not taxable. Okay, first of all, case 1, interest, royalty, fee for technical service. Act says that in all 3 cases, the income shall be treated as deemed to accrue or arise in India. Always. Have you understood? All these 3 payments, interest, royalty, fee for technical services, if it was paid by government to non-resident, then always be treated as deemed to accrue or arise in India. The most important point. irrespective of place of utilization of funds, rights, services, whatever. Don't consider the place of utilization of such funds or rights or services. Blindly it will be taxable in the hands of non-resident if such payment was made by government, because such payment shall be treated as deemed to accrue or arise in India. Yes. Next, case 2. The very important cases, case 2 and 3 are very important. In case 2, payable by resident, recipient by non-resident. Okay, but how, when it will be treated as deemed to accrue or arise in India? Here also the income, the payment shall be treated as deemed to accrue or arise in India. Yes, because the payment made by residents generally shall be treated as deemed to accrue or arise in India, except there is an exception, except funds utilized outside India. That's it. Except the funds utilized outside India, then it shall not be treated as a deemed accrual in India, hence not taxed. Have you understood? So, except funds utilized outside India, in all other cases, the payment shall be treated as deemed, that is, the interest shall be treated as deemed accrual in India. What about royalty? Here also, royalty paid by resident, recipient by non-resident. Here also, always be treated as deemed to accrue or arise in India, except there is an exceptional case, except rights utilized outside India. Royalty on rights, payment, copyrights or patent rights, whatever it is, rights utilized outside India. Except this case, in all other cases, deemed to accrue or arise in India. Yes, it is deemed to accrue or arise in India, hence taxable in the hands of non-resident, except this case. If it was covered in this exception, then no need to pay any tax. Okay, so fee for technical services, here also same, deemed to accrue or arise in India, hence taxable to non-resident, except one case, except services utilized outside India. That's it. Have you understood? But there is no such exception to government to non-resident payment. In always, irrespective of place of utilization, always be treated as deemed accrual if it was paid by government to non-resident. Okay, but resident to non-resident, the treatment is something different. Have you understood? The next one is, my dear students, the third case is transaction between non-resident to non-resident. Is nothing but payer non-resident, recipient also non-resident. In these cases, so generally not treated as deemed accrual in India. Okay, in general, not treated as deemed accrual. Not treated as a deemed accrual in India. Not treated as deemed accrual in India, except one case, except funds brought into India utilized for the purpose of business or profession. In that case, that will be treated as a deemed accrual in India, except funds used in India. Used in India, most important point here is funds used in India for business or profession, exclusive. Business or profession. Funds used in India for business or profession, then it will be treated as deemed accrual in India. Except that case, in all other cases, it shall not be treated as a deemed accrual in India. Have you understood? So that's the very important point. So next, here also royalty paid by non-resident, recipient by non-resident, generally not treated as deemed accrual in India, except rights used in India for any purpose. Next, here also, except services used in India. for any purpose. That's it. The table in section 9, this table is very popular and very important. Okay, please be concentrate at least on this table in section 9. Section 9 is exclusively non-resident section. Here the assessee always non-resident. Have you understood? And some other points we'll discuss relating to section 9, deemed accrual. For example, salary. When the salary shall be deemed to accrue or arise in India? Deemed to accrue or arise in India. Salary, place of rendering services in India. In India. Okay, generally place of rendering services in India, then deemed accrual in India. A place of accrual in India. If place of rendering services outside India, then place of accrual outside India. Except, most important point, except, so one case, except, most important point, except government employees working outside India. Indian citizen being a government employee working outside India. Indian citizen being a government employee. Working outside India. So in this case, the salary shall be treated as deemed to accrue or arise in India. Even if place of accrual outside India. Even if place of rendering services outside India, the salary shall be treated as deemed to accrue or arise in India. So that's the important point. Deemed to accrue or arise in India. Even if place of rendering services outside India. Consulate employees, ambassadors, etc. All those persons covered in this point. Being Indian citizen, government employees working outside it. This rule is not applicable to private employees. And one more important point, for these persons, if employer provided any allowances, perquisites exempt from tax under section 10(7). Okay. Next, dividends declared by an Indian company. Dividends declared by Indian company deemed to accrue or arise in India, even if recipient is non-resident and place of receipt outside India. Place of receipt outside India and recipient also non-resident. Such dividend shall be treated as deemed to accrue or arise in India. Deemed to accrue or arise in India. Even if received by non-resident and place of receipt outside India. Thus, such dividend shall be treated as deemed to accrue or arise in India because it was declared by Indian company. That's it. Next, gifts. Provided by resident to non-resident or to foreign company shall be treated as deemed to accrue or arise in India. If it was provided by resident, even if recipient is non-resident or foreign company, such gift shall be treated as deemed to accrue or arise in India, hence taxable in India. Of course, the gift is taxable if value exceed 50,000. Gift provisions are applicable as this. If gift provided person is a resident, then the gift is taxable even if recipient is a non-resident or foreign company. Taxable in India always because deemed accrual in India. So business, pgbp, business connection in India. Then such business income shall be treated as deemed accrual in India. Have we understood? These are the main points relating to section 9. First of all, table is very important. After that, you need to prepare salary, dividends, and gift and PGP. Okay, some other points are there. So just these are the main topics relating to residential status. Okay. So my dear students, let's close this chapter here. We'll start income from house property, the second head of income. My dear students, next chapter, the second head of income, income from house property. Section 22 to 27. So this is also one of the important chapter. This time I will expect a problem from this chapter, because there is no problem in September attempt from this chapter. So we'll expect in next attempt. So compulsory prepare house property chapter mandatorily. Okay. So first of all, when house property gets attracted, when will this head of income gets attracted? The charging section, the first section itself in each head of income is a charging section. Section 22. Charging section says that, so there must be a satisfaction of 3 conditions for attracting this head of income. Condition number 1 is the asset must be a building or land appertinent thereto. Building or land appertinent thereto, that is land attached to the building within the compound wall. Car parking place, gardens, playgrounds, so cellars, swimming pools, etc. All these are treated as a land appertinent thereto. Okay. So, and condition number 2. Condition number 1, the asset must be a building or land appertinent thereto. Condition number 2, the assessee must be the owner of such property. Ownership is mandatory. The ownership may be either legal owner or deemed ownership. Okay. So ownership is mandatory, essential, one of the essential condition for taxability of income under the head income from house property. If you don't have any ownership on that property, then the rental income will be taxable under the head other sources. The question of house property does not arise. And one more important, the building may be either residential or commercial. Even if commercial buildings let out to some other party, the rental income will be taxable under the head house property itself. So the building may be either residential or commercial, taxable under the head house property. Ownership may be either legal or deemed ownership, taxable under the head house property. And the third condition is the property not used for own business or profession. Not used for own business or profession. This is the last condition. If it was used for own business or profession, then that will be covered under the head pgbp. The question of house property does not arise. Okay, have you understood? Charging section says that all 3 conditions were satisfied, then the resultant income is taxable under the head income from house property. Okay, no other asset will be covered in this chapter. Have you understood? So we directly go to the practical part. Okay. So first of all, I want to give you a format which is useful for calculating the house property income. Okay, format. Actually, there are 2 types of formats involved in this chapter. I give you both the formats and explain the topics which are related to house property, wherever, whatever important. Okay, so format. My dear students, there are 2 formats involved in this chapter. One is the first format is applicable to the first format. First format is first calculate the gross annual value, GAV. Calculate GAV. Okay. Next, less municipal taxes paid. Okay, so after that we'll get NAV. Okay, after that reduce deductions under section 24. There are two deductions involved in this. A, standard deduction, 30% of NAV. Next one, B, interest on borrowed money. The resultant income is either positive or nil or negative. Income from house property. The resultant income may be either positive or 0 or negative. So this is the one of the format, but most important observation is this format is useful. This format is useful in 3 cases. The above format is useful in case of fully let out property, deemed let out property, part of the year let out, part of the year self-occupied. And part of the year self-occupied. So my dear students, in these 3 cases, you can use the above mentioned format. Okay, so fully let out, deemed let out, part of the year let out, part of the year self-occupied. If you want to solve the problem in any of these 3 statuses, you can use the above mentioned format as it is. Okay, so second format. Second format, NAV shall be taken as nil minus deductions under section 24. Only one deduction is available, that is B, interest. The resultant income is either negative or nil. The question of positive result does not arise in this format. This is the format which is useful in self-occupied, unoccupied. Have you understood? So there are 2 formats. If you want to solve the problem on self-occupied property or unoccupied property, then need to apply the above mentioned format. NAV shall be taken as nil minus only one deduction, that is interest on borrowed capital. Have you understood? These are the formats. Next, we'll go to explanation part. First of all, GAV. And one more important point, self-occupied, unoccupied properties or self-occupied, unoccupied properties, GAV not required to calculate because NAV shall be taken as nil. Therefore, GAV need not be calculated in self-occupied, unoccupied property. And municipal taxes are not deductible in self-occupied, unoccupied property. These are the important observations here. Okay, then we go to GAV calculation. For calculating GAV, 4 types of values to be considered. 4 types of values to be considered. The first one is municipal value. Second one, paid rental value, or alternatively called as similar property rent. Okay. Third one is standard rent. Fourth one is actual rent. These are the values to be considered for calculating the gross annual value. Okay. Municipal value, paid rental value or similar property rent, standard rent or actual rent. Next. So how to calculate the GAV? The procedure is first step. First to compare the municipal value with paid rental value and whichever is higher to be considered. Step 1. Whichever is higher. Municipal value and paid rental value. Whichever is higher to be considered. Have you understood? The second one is amount as per step 1. Amount as per step 1 shall be compared with standard rent. Then whichever is lower to be considered. Step 2. Whichever is lower. amount as per step 1, the resultant amount as per step 1 shall be compared with standard rent, and whichever is higher, whichever is lower to be considered. The resultant amount in step 2 shall be treated as expected rent. That is the rent expected by the government from your property. That is the expected rent. Then expected rent shall be compared with actual rent. Expected rent shall be compared with actual rent. So in step 3, either whichever is higher or whichever is lower. Here one of the important point, step 3 is very important, because for step 1 always be higher to be considered. Don't have any confusion. So step 2 always whichever is lower to be considered. No confusion. Clear. But step 3 in majority cases whichever is higher to be considered. In some exceptional cases whichever is lower to be considered. Okay, I give you when whichever is higher to be considered for step 3, when whichever is lower to be considered for step 3, we'll discuss. Just wait. Okay, so the extension of step 3. The extension of step 3 here is so there is a section called section 23 subsection 1 class C. If such section gets attracted, then whichever is lower to be considered. If such section does not attract it, then whichever is higher to be considered in step 3. That's it. Simple procedure. Easy to calculate. Okay. So first of all, if section 23 subsection 1 class C was applied, if section 23 subsection 1 class C was applied, then whichever is lower to be considered for step 3. For step 3, whichever is lower to be considered. Whichever is lower. Important point. If such section does not attract it, then whichever is higher to be considered. If section 23 subsection 1 class C not attracted, then for step 3 whichever is higher to be considered. This is the application procedure. When section 23 subsection 1 class C gets attracted, we'll discuss. Just wait. There are 3 conditions to be satisfied for attracting this section. For step 3, if this section was applied, then whichever is lower, otherwise whichever is higher to be considered. Whenever section 23 subsection 1 class C does not attract it, then whichever is higher to be considered. Have you understood? So first of all, notes. There are most valuable notes are there related to GAV. So అందులో when, first one is when section 23 subsection 1 class C gets attracted. Conditions for applicability of section 23 subsection 1 class C. Conditions for applicability of section 23 subsection 1 class C. Okay, so what are the conditions to be satisfied for attracting this section? There are 3 conditions. Condition number 1, it must be a let out property. One of the important condition, it must be a let out property and it must be vacant during the previous year. There is a vacancy during the previous year. Vacancy is nothing but absence of tenant. That is where the owners put the to-let board. The period is called as vacancy period. The idle period in between 2 tenants. Old tenant was vacated, that new tenant was occupied after 2 months. Then in between both the tenants, 2 months period, the owner is not have any receipt of rent due to not having any tenant. Such idle period is called as vacancy. Vacancy is nothing but idle period between old tenant to new tenant. That will be treated as a vacancy. Vacancy is a loss to the owner because it's a rental loss to the owner. Okay, so it must be a let out property, and condition number 2, it must be vacant during the previous year. That is, there is a vacancy during the previous year, either full year or part of the year. Okay, due to vacancy, third condition is most important. Due to vacancy, actual rent is less than expected rent. That's it. Most important. If these 3 conditions were satisfied as it is, then for step 3, whichever is lower to be considered. If any of these conditions were not satisfied, then class C does not attracted, then whichever is higher to be considered for step 3. Simple. If any of these conditions were not satisfied, then whichever is higher to be considered for step 3. Okay, most important. Due to vacancy, actual rent is less than expected rent. That is, for better explanation, if there is no vacancy, what would have the situation? Actual rent is more than or equal to expected rent. If there is no vacancy, actual rent more than or equal to expected rent. Due to vacancy, it was less than expected rent. That is, actual rent is less than expected rent because of vacancy. If there is no vacancy, actual rent would have the more than the expected rent or equal to expected rent, but it was falls short when compared to expected rent because of vacancy. Then section 23 subsection 1 class C gets it. Have you understood? All these conditions must be satisfied for applicability of section 23 subsection 1 class C. Important. Okay, next, some other important points relating to GAV. Point number 2. For self-occupied, unoccupied property, GAV need not be calculated because in these cases NAV shall be taken as nil. For self-occupied property, unoccupied property, no need to calculate GAV. Because in these cases, NAV shall be taken as nil. That is one of the important observation. And the third point here is for DLOP. DLOP is nothing but one of the important status in this chapter. DLOP is nothing but assumed to be treated as let out. We'll discuss when DLOP concept gets attracted. So, but now is what is the GAV of DLOP? DLOP is nothing but not actually let out, deemed to be let out, assumed to be let out. In DLOP, there is no actual rent, there is no availability of actual rent because it was not actually let out. Due to non-availability of actual rent, how would apply the step 3? Because step 3 is comparison of expected rent with actual rent. But in DLOP, there is no actual rent, non-availability of actual rent because of here the property was not actually let out, assumed to be treated as let out. How the actual rent will be available in this? So for that, Act says that in DLOP need not apply step 3, amount as per step 2, that is expected rent, to be considered as directly GAV. That's the one of the important observation in DLOP. Expected rent is equal to GAV. Expected rent to be taken as GAV. That is step 3 not applicable, not applied, because non-availability of actual rent. Have you understood? So that is one of the important observation DLOP. Okay. Next one is, so these are the points relating to GAV. GAV need not be calculated to self-occupied, unoccupied. Reason is, in these cases, NAV shall be taken as nil. Okay. Next one, note number 2. Sometimes standard rent will not be available in the problem, because standard rent is nothing but rent as per Rent Control Act. So in some cases, standard rent will not be available. In those cases, don't apply step 2. Cancel step 2. Therefore, amount as per step 1 to be directly taken as expected rent. Need not apply step 2. Okay. So one of the important, if standard rent has not given in the problem, if standard rent will not be available, then step 2 cancel and step 1 answer shall be taken as expected rent and directly go to step 3. That's the another important note point. Next, where the property was came into an existence during the current previous year. That is, the property construction completed in middle of the current previous year, or the property was purchased in middle of the previous year, then GAV shall be calculated only for existing period. Okay. So in these type of cases, sometimes problem contain the information for full year, municipal value per annum, standard rent per annum, paid rent per annum. So in those cases, we should require to apportion the data and taken into account only for that period. So for that period in which the property was in existence. If property was constructed on June 30th, that is in existence from July 1st. So how many number of months that the property was in existence in current previous year? April, not in existence. May, not in existence. June, not in existence. From July 1st onwards, the property in existence. That is only 9 months. In this case, GAV shall be calculated only for 9 months. Even if data given in the problem for full year, we should be taken into account only for 9 months. Otherwise, the problem may be wrong. That is one of the important observation. This dispute will arise only in first year itself. That is year of construction completion or year of purchase. Please check whether the property was in existence for full year or not. If not in existence for full year, then GAV shall be calculated only for existing period. Okay. So this condition was already discussed. 23 subsection 1 class C applicability. Next one is completed. Deemed let out property completed. So this will be discussed later, just wait. Most important point number 8, unrealized rent. Unrealized rent. Unrealized rent is also a loss to the owner. Unrealized rent is nothing but due but not collected. Due but not collected. Due but not collected. So it's a loss to the owner. Unrealized rent, the treatment of unrealized rent is, while calculating GAV, unrealized rent shall be deducted from actual rent in step 3 minus unrealized rent, if any. That's the treatment of unrealized rent. Shall be deducted from actual rent in step 3, subject to rule 4 conditions. Shall be deductible from actual rent, subject to rule 4 conditions, otherwise not deductible. That's the treatment of unrealized rent. These are the conditions given in your material. Please go and verify. I don't want to explain the conditions because time is very limited. Okay. So these are the points, note points relating to computation of GAV. So all the note points which are relevant to the GAV provided here. Some of the note points are very important. Applicability of section 23, subsection 1, class C. Treatment of unrealized rent. Unrealized rent treatment, there is an alternative treatment also. It can be deducted from directly GAV also, subject to rule 4 condition. This is the alternative treatment of unrealized rent. You can deduct it from GAV also. Have you understood? So this is the computation of GAV. Step 1, municipal value, paid rent, whichever is higher. Step 2, amount as per step 1 or standard rent, whichever is lower. Step 3, expected rent or actual rent, whichever is higher or whichever is lower. Depends on applicability of section 23, subsection 1, class C. Okay. So step 3 is very important. When section whichever is lower gets subtracted, when whichever is higher gets subtracted, it's a very important point. Income from house property. Next topic is interest deduction is most important in house property head. Actually, section 24 deductions. Section 24 deductions. There are two deductions from NAV. One is A, standard deduction. B, interest on borrowed money. Okay, two deductions in section 24. The first one is too easy. So I don't want to explain the first one. It simply says that 30% of NAV irrespective of expenditure. It's a flat deduction. Okay, so don't confuse. It's too simple. So 30% of NAV irrespective of actual expenditure. Irrespective of actual expenditure is nothing but don't consider the actual expenditure, even if it was more than the 30% or less than 30%. Actual expenditure doesn't matter. Just ignore it if given in the problem. Okay. The purpose for giving standard deduction is for repairs and collection charges. Repairs and collection charges. Okay. Even if actual repairs was provided in the problem, then don't consider it, just ignore it. Actual repairs does not consider it. Always the deduction fixed in the act at the rate of 30% of NAV. You always be deductible at the rate of 30% of NAV. It's mandatory deduction, no actual expenditure to be considered, just ignore if given in the problem. The next one is interest on borrowed money. This is one of the important calculation in house property chapter. Generally, interest deduction 24B, there is a limit for claiming interest to self-occupied, unoccupied, but there is no limit to let out, deemed let out, part of the year let out. I give you the limits for deduction of interest first of all. Okay, so limits. Most important area. So limits for let out property, deemed let out property. Third one is part of the year let out, part of the year self-occupied. My dear students, please observe this point. Here in these three cases, there is no limit for claiming interest. You can claim any amount of interest. No limit. No limit. 100% of interest is deductible. Okay. So, but here the most important area is self-occupied, unoccupied property. Here there is a limit to claim interest because the format for self-occupied, unoccupied is NAV shall be taken as nil minus only one deduction, that is interest. The interest is deductible maximum up to 2 lakhs subject to fulfillment of certain conditions, otherwise restricted to 30,000. That's the limit of interest to self-occupied, unoccupied. Most important point. And what about if assessee occupied 2 houses for self-occupation? Here also the aggregate deduction for both houses cannot exceed 2 lakhs. Don't claim 2 lakhs for each house. So 2 lakhs limit is applicable either for one self-occupied property or even more two self-occupied properties also. Even if assessee occupied 2 houses for self-occupation, the aggregate deduction of interest cannot exceed 2 lakhs. That's the important point. Okay. So the limit applicable here is aggregate interest. Aggregate interest cannot exceed 2 lakhs for one or two self-occupied properties or unoccupied properties. Aggregate interest cannot exceed 2 lakhs either for one self-occupied properties, even for two self-occupied properties also. Okay, subject to some conditions. Otherwise, if those conditions were not satisfied, restricted to 30,000. 30,000 only. Most important area here is, okay, aggregate deduction of interest either for one self-occupied property or two self-occupied properties cannot exceed 2 lakhs subject to some conditions. Otherwise restricted to 30,000. What are those conditions? Please go and verify the material. So I will explain briefly. The condition one is to claim deduction of interest up to 2 lakhs. The conditions are, the first one is date of borrowing on or after 1499. If it was taken before 1499, then deduction is restricted to 30,000. And purpose of borrowing, either purchase or construction. If loan was taken for repairs, renovation, reconstruction, then restricted to 30,000. Purpose must be either for purchase or construction. And third one is the construction must be completed within 5 years from the end of the financial year in which loan was borrowed. Have you understood? If these three conditions were satisfied, then the interest is deductible up to 2 lakhs. If any one of these conditions were not satisfied, then restricted to 30,000, either for one self-occupied property or two self-occupied property. The conditions are date of borrowing on or after 1499. Purpose of borrowing, either construction or purchase. Construction completion within 5 years. So from the end of the financial year in which loan was borrowed. These are the three. One more condition is there. It's an unimportant. The person giving the loan, the lender must be gives a certificate. So as to that loan was given for construction or purchase. That's the fourth condition. Okay, and I don't want to write here. These are the main conditions. Okay, so this is the limits for interest. And one more valuable point here is for let out, deemed let out, part of the year let out, part of, in these cases there is no limit for interest and deduction is available in both default and opt out also. Opt out. But here is, in case of self-occupied, unoccupied property, deduction is available only in default, not available, only optional. Opt-out is nothing but optional. Deduction available to self-occupied, unoccupied, only in optional tax regime, not in default tax regime. That's the important observation. Have you understood? Next. Interest includes pre-construction period plus current year interest. Interest types of interest. Pre-construction period, current year interest. Okay, so interest includes pre-construction period interest, current year, aggregate both. to be claimed as deduction under section 24B. So now the question is, so many of students are having doubts about pre-construction period. What is pre-construction period interest? So pre-construction period interest is nothing but the interest relating to the period preceding the year of construction completion. It includes interest relating to the period preceding the year of construction completion. Pre-construction, just like a preliminary expenditure in financial accounting. So I'll give you a simple example. So it includes interest relating to the period preceding the year of construction completion. So treatment, what is the treatment of pre-construction period? Allowed as deduction, don't claim the entire PCPI in 1 year, 1 financial year. It can be claimed as deduction for 5 equal installments from the year of construction completion or purchase. Construction completion or purchase, whatever it is. What is the treatment of PCPI? Allowed as deduction for 5 equal installments. From which year the deduction will start? From the year of construction completion. Construction completion or purchase, whatever it is. So PCPI treatment is allowed for 5 equal installments from the year of construction completion or purchase. So I'll give you some more points relating to house property. Section 26, co-ownership. This is also very important. So co-ownership says that, for example, a property owned by 2 owners, X and Y brothers, co-owners, X and Y. Co-ownership or joint ownership, you can use any of these words. Okay. So what is the treatment? How to calculate the income from this property? The section 26 says that how to calculate the income from co-owned property. Okay. Act says that first of all, identify whether the property was self-occupied by co-owners or it was let out to some other party. First observe whether the property was, for example, if this property was self-occupied by co-owners, then what's the treatment specified in section 26? Section 26 says that if co-owned property self-occupied by both the co-owners, then need to calculate the income for each co-owner separately. That's the important point. That is, NAV shall be taken as nil for each co-owner, and each co-owner is entitled to claim deduction of interest up to 2 lakhs or 30,000, subject to some condition, or 30,000 each co-owner. That's the beneficial provision to the assessee. Okay, that is, for each co-owner, calculate the income separately. Okay, based on the self-occupied status. Okay, so this is the computation procedure. So X, Y. For each co-owner, NAV shall be taken as 0. Minus each co-owner is entitled to claim only one deduction because this is self-occupied property. Each co-owner is entitled to claim deduction of 2 lakhs, oblique 30,000. Here also Y is also entitled to same amount of deduction, 2 lakhs oblique 30,000. The resultant amount is negative. Have you understood? So this is the computation procedure of co-owned property if it was self-occupied by co-owner. Each co-owner entitled to claim deduction of interest up to 2 lakhs. That's the beneficial to assessee. So in that, both the co-owners are having right to claim interest maximum up to 2 lakhs, up to 4 lakhs, 2 lakhs plus 2 lakhs, 4 lakhs from same property. Actually, this is the beneficial calculation to the assessee. Actually, for one property, never claim to deduction of interest more than 2 lakhs, but except co-owned property. In co-owned property, the co-owners both are entitled to claim deduction of interest up to 2 lakhs or 30,000. maximum limit. Have you understood? This is the computation procedure if it was self-occupied by co-owners. But what is the treatment if it was let out to some other party? Let out. Then Act says that first compute the income as if such property was owned by one owner. Assume that the property was owned by only one owner. Calculate the income based on let out status. Thereafter, the resultant income shall be apportioned between co-owners as per the share. That's the treatment if it was let out. First compute the income as if such property was owned by one owner. That is, first calculate the let out status. First calculate the GAV minus deduct municipal taxes. Then we'll get NAV. Then deduct section 24 deductions under section 24. Both the deductions, A, standard deduction, B, interest. After that, the resultant income must be apportioned between co-owners as per that share. That's the treatment. X, Y. Apportioned between co-owners. If co-owners having equal share in that property, then it must be apportioned as 1:1 based on the ratio of property held by co-owners. That's it. This is section 26. And one more thing we should remember, if one of the co-owner is having another house property, for suppose Mr. X is having another house property which is also self-occupied by X, then X is having two self-occupied properties. One is co-owned property and second one is other self-occupied property. Co-owned property, shared in co-owned property and other self-occupied. Both the houses were self-occupied. But Act says that the limits applicable here. So same assessee having two self-occupied properties, then aggregate interest for both self-occupied properties cannot exceed 2 lakhs. Then aggregate deduction of interest, co-owned property and such other property, aggregate interest cannot exceed 2 lakhs or 30,000. That's the important point. Co-owned property and other self-occupied property. Aggregate interest for these two self-occupied properties, interest deduction cannot exceed 2 lakhs. Subject to some conditions, otherwise restricted to 30,000. Have you understood? The next topic relating to the house property is foreign property. Foreign property. So my dear students, taxable in the following cases. The first case is the residential status of the assessee is the assessee must be ROR. That is one of the case. And second one, R, place of receipt located in India. So that is, in these two cases, the foreign property will be taxed in India. The assessee may be either ROR or at least the income from such property was received in India. So anyone, if assessee falling in any one of these points, then automatically foreign property will be taxed in India. Okay, now the question is, if taxable, then what is the computation procedure? Computation procedure, income computation procedure. Computation of income from foreign property. The procedure is same as if such property was located in India, same as an Indian property. So same as if such property was located in India. Okay, that's it. This is one of the important information. So there is a problem on this concept. Please prepare. It is very important. But here one thing we should remember that in foreign property related problems, the data will be given in foreign currency. We should require to calculate the income by converting the foreign currency into Indian currency. Of course, the rate of conversion will be given in the problem, no issue. So the details given in foreign currency, we should require to calculate the income in Indian currency. Okay, that's the one of the point you should remember. Except that rest of the procedure is same as property was located in India. That's it. Computation of GAV, municipal taxes. So even municipal taxes paid to the foreign government is also deductible if such income was taxed in India. Okay, next topic is interest payable outside India. Interest payable outside India, that is section 25. Interest payable outside India will be allowed as deduction subject to the following conditions. If those conditions were not satisfied, then such interest is not at all deductible under section 24B. So outside India will be allowed as a deduction under section 24B subject to following conditions. So these are one of the important concept. Interest payable outside India, then only section 25 gets attracted. Section 25 says that outside India interest is allowed as deduction to you subject to fulfillment of the two conditions. One is the payer is required to make TDS from such payment. One of the condition is the conditions to be satisfied by payer. So conditions to be satisfied by whom? Payer. Payer is required to make TDS from such payment. TDS from such payment. And both the conditions must be satisfied and deposit the same into government account within the due dates. The TDS amount into government account within the due dates. So these are the conditions to be satisfied. Both the conditions must be satisfied by whom? Payer. What will be the consequence if these conditions were not satisfied? Then the payer is not entitled to claim the interest amount under section 24B. That's the punishment. Have you understood? So payer is required to satisfy the two conditions. Otherwise, such interest is not deductible. Simple but important. But what is the TDS rate and what is the due date of deposit? These topics will be discussed in TDS chapter. Please go and verify the TDS chapter. So deposit date and TDS rates will be given in TDS chapter because each and every payment is subject to separate TDS rate. Okay, so that's it. Next, TDS covered in TDS chapter, the rent payment, the interest payment was covered in section 194A. Okay, next one is computation procedure in various statuses. Some important statuses are there. In those statuses, how to calculate the income. For example, income computation. In various statuses. So mostly three important statuses are there. In those cases, the income computation is very important in those. First one is part of the property let out, part of the property let out. I have a building. The building is having two floors, ground floor, first floor. Ground floor self-occupied, first floor let out. The status of this property is part of the property let out, part of the property self-occupied. And part of the property self-occupied. Now the question is how to calculate the income from this property. The procedure, the act says that in this type of cases, the income shall be computed for each part of the property separately. Calculate the income from each part of the property separately. That's the computation procedure. Calculate the income from each part of the property separately. So each part of the property separately, that is compute the income from ground floor separately, compute the income from first floor separately. After that, aggregate these amounts, then we'll get ultimate answer. Have you understood? The one thing we should remember here, in this case, if data given on combinedly, that is consolidated basis for entire property, then the data will be apportioned between ground floor and first floor on reasonable basis. The ratio will be given in the problem. For example, municipal value for entire property is 10 lakhs. Then it should be apportioned between ground floor and first floor. So whatever the data which was given on consolidated basis, that should be apportioned between ground floor and first floor on the basis of mainly in area occupation ratio. Okay, that's the unique provision, and that's the procedure for computation of income from this type of properties. Next, another type of property. I have a property, I have only one property which was self-occupied for 8 months, let out for 4 months. This is part of the year let out, part of the year self-occupied. Part of the year let out and part of the year self-occupied. This is the another important status. But how to calculate the income from this property? Act says that compute the income as if such property was let out for full year. It's just like a fully let out property. So compute the income as if such property was let out for full year. Have you understood? This is one of the important. Fully let out, treated as let out for full year. Then calculate the income as if such property was let out for full year. That is, so municipal value to be considered for full year. That is 12 months. Paid rental value also to be considered for 12 months. Standard rent to be considered for 12 months. But only actual rent only to be considered only for let out period. What is the let out period here? 8 months. And municipal taxes deductible for full year. Entire amount can be deducted. Interest also deductible for full year. That's the procedure. So simply says that treated as let out for full year. That's the important observation. Except actual rent. Actual rent only to be considered for let out period, except that rest of the problem is to be considered as if such property was let out for full year. Okay, so that's it. And one thing we should remember here is, if in this case, in this status, exclusive problem, which is an exclusive point, so which is applicable exclusively in this status, that is part of the year let out, part of the year self-occupied. The most important note, in this status, part of this note is not applicable to other statuses. Only in part of the year let out, part of the year self-occupied. If FRV has not given in the problem, then actual rent for full year to be taken as FRV. This is most important assumption which is applicable only to part of the year let out, part of the year self-occupied. Have you understood? Most important. If FRV not available, then actual rent for full year to be considered as FRV. That's the important observation. So many of students have no knowledge about this point. If you don't know this point, then you may get some confusion while calculating the income from such property. Okay, next one is deemed let out property. Sir, when deemed let out concept gets attracted, Act says that if assessee is having more than two houses under self-occupied category, then DLOP gets attracted. Okay, most important point. If assessee having applicability of deemed let out. If assessee having more than two houses under self-occupied category, then the concept of DLOP, self-occupied or unoccupied category, then the concept of DLOP gets attracted. First of all, important point. Wherever the assessee occupied more than two houses for self-occupation, then DLOP concept gets attracted. Then Government Act says that never accept more than two houses for self-occupation because the resultant income from self-occupied property is negative. Negative, it's a loss. It can be adjusted against other positive income that is eligible for set off against other incomes. It's a loss to the government. It's a revenue loss to the government. That's why the government made a restriction for self-occupied properties. An assessee cannot occupy more than two houses for self-occupation. Can be occupied either one self-occupied or two houses. It can be accepted by the government. If more than two houses were occupied as self-occupied category, then DLOP gets attracted. So the treatment here is any two houses. For example, if assessee is having three houses, all are under self-occupied, then Act says that any two houses at the option of the assessee can be adopted as self-occupied. The remaining houses shall be treated as DLOP. So any two houses. At the option of the assessee. Can be adopted as self-occupied. The remaining house or houses are treated as DLOP. That's the treatment. Any two houses at the option of the assessee, that is option given to the assessee. Therefore, assessee can select any two houses whichever is beneficial to him. So, to be treated as a self-occupied, the balance houses shall be treated as DLOP. But how to select? How to select? Selection criteria. Selection criteria. How to select which house is to be adopted as self-occupied? So that's why there is a method called option method. Better to solve this problem in option method. Option method says that, so open all possible options and compute the income in each option and select the option which is having lower income. That's the decision criteria. Okay. For example, assessee is having three houses. Open all possible options. In each option, consider two houses as self-occupied, remaining house as DLOP. Compute the income from all three houses. So the same procedure to be followed for remaining options also. And later on, after completion, then conclude that which option is beneficial to you. Begin our discussion with capital gain chapter, that is fourth head of income. which is very important in examination point of view also. So let's begin. First of all, what are the incomes taxable under the head capital gain? The charging section, section 45 subsection 1. Charging section is section 45 subsection 1. 45 subsection 1. Charging section says that two conditions to be satisfied for attracting this head of income. The triggering point for attracting capital gain chapter is there must be a satisfaction of two conditions. What are those conditions? The asset, the assessee is having any capital asset and it must be transferred during the current previous year. Then on transfer of such asset, the resultant income, if it is positive, capital gain. If it is negative, capital loss. Okay. So what are the conditions to be satisfied for attracting capital gain chapter? There are two conditions must be satisfied for attracting capital gain. That is, one is the asset must be a capital asset and the transaction must be transferred. These are the two conditions to be satisfied for attracting capital gain. Okay. So if these two conditions were satisfied, then the resultant income, if it is positive, it will be treated as a capital gain on satisfaction of these two conditions. If the resultant income, if it is positive, then capital gain. If it is negative, then capital loss. Have you understood? So that's the main criteria for attracting capital gain. That is, there must be a satisfaction of two conditions. Okay. Now, most important point here is these two are very important definitions in capital gain chapter. What is capital asset? What is transfer? These two are very important in capital gain chapter. Definition of capital asset, definition of transfer. Okay. The entire chapter is purely depends upon these two definitions. If you observe the definition carefully, then you can answer the question very easily, which is relating to capital gain. Otherwise, you may get some confusion. Okay. What are the definitions required to know for calculating the capital gain? So, the capital asset definition and transfer definition. Next one. Capital gain will arise on transfer of capital asset in the hands of transferor. Who is liable to calculate capital gain? The transferor is liable to calculate capital gain. This chapter will be discussed in transferor viewpoint of view. Okay. Transferee point of view, the transaction will be discussed in other sources said gift concept gets attracted in the hands of transferee. So just ignore it about the transferee point of view. Here we should concentrate only mainly on transferor viewpoint. The transferor is liable to calculate capital gain on transfer of capital asset. Okay. Next, definitions. Capital asset definition. My dear students, capital asset definition, the definition of capital asset is Act says that all types of assets, whether movable, immovable, tangible, intangible, whether involved in the business or not, are treated as a capital asset. All types of assets, whether movable, immovable, tangible, intangible, whether used in the business or not, are always be treated as a capital asset. But it excludes the sum of the assets. Those exclusions list is very important. Every student must remember those assets which were excluded from the definition of capital asset. Capital asset means all types of assets, whether movable, immovable, tangible, intangible, whether used in the business or not. But it excludes, most important point, exceptions to capital asset. What are the assets excluded from the capital asset definition? Around 7 assets are there in exclusions list. So, but in this session, we want to discuss only about 4 assets. The first exclusion is stock in trade. First exception to capital asset definition is the stock in trade. Personal effects is nothing but it's a movable nature of asset which was used for personal purpose. These are the conditions to be satisfied. It's a movable nature of asset and it must be used for personal purpose, either by assessee or family members. Then such asset shall be treated as a personal effect automatically. The two essential conditions to be satisfied to declare asset as a as a personal effect. So it must be a movable nature of asset and it must be used for personal purpose, either by assessee or family members. Then such asset shall be treated as a personal effect. Then no need to calculate capital gain on sale of such asset because it was excluded from the definition of capital asset. Okay, but however, some assets are excluded from personal effects. These are the exceptions to personal effects. Therefore, these assets always be treated as capital assets, even if it is a movable, even if it was used for personal purpose. Even the above conditions were satisfied, these assets always be treated as a capital assets, not at all treated as a personal effect. Jewelry, archaeological collections, paintings, drawings, etc. Okay, this is the definition of stock in trade. Sorry, personal effect. Personal car, no doubt, is a personal effect. Bike used for personal purpose, household equipments used for personal purpose, whatever it is. The above mentioned conditions were if satisfied, then such asset will be treated as a personal effect. Except the following: jewelry, archaeological collections, paintings, drawings, etc. Okay, so second exception from capital asset definition is personal effects. The third exception is agricultural land located in non-specified area. Non-specified area is nothing alternatively called as rural area. Agriculture, it's a beneficial provision to the farmers. So the farmers who transfer the agricultural land located in non-specified area, the farmers are not required to calculate capital gain because such asset is not a capital asset. How to measure the rural area? There is a definition in the Act, urban area, that is a specified area definition is there. Any area other than the specified area will be treated as a rural area. Any area other than the specified area will be treated as a non-specified area. If agricultural land located in non-specified area, then such asset is not treated as a capital asset. What about if it was located in specified area? No doubt it must be treated as a capital asset. Need to calculate capital gain on transfer of such asset. Have you understood? So please go and verify the definition of specified area. Specified area definition is purely depends upon population in that area. Okay, based on the population, we should decide whether it is specified or not. If it is a specified area, then any area other than the specified is treated as a non-specified area. Then conclusion is agricultural land located in non-specified area is not a capital asset. No need to calculate capital gain on transfer of such agricultural land by the transferor. Okay, next one, security deposits issued under gold monetization scheme. Okay, these are the main assets which were excluded from the definition of capital asset. All these assets are not treated as a capital asset. Therefore, no need to calculate capital gain. Next, my dear student, one more concept is there. What are the conditions to be satisfied for attracting capital gain? The first condition is capital asset. Second condition is transfer. Capital asset definition was already completed. So, but what about transfer? Transfer definition is most important definition. Transfer is nothing but any type of transaction. Any type of transaction will be treated as a transfer. Any type of transaction. Around 9-10 transactions are there. It includes sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capital asset into stock in trade, redemption of zero coupon bonds, and 53A conditions. Whatever the transactions, all the transactions which will be treated as a transfer. Here also one thing you should remember, any type of transaction, whether sale or exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capital asset into stock in trade, redemption of zero coupon bonds, and 53A conditions, whatever it is, except the following. Here also exceptions, very important. Exceptions to transfer. Section 47, most important section in capital gain chapter. Transfer includes any transaction transfer includes any transaction which includes sale, exchange, relinquishment, extinguishment, conversion of capital asset into stock in trade, compulsory acquisition, and redemption of zero coupon bonds, as well as 53A condition. One more transaction is there, it's an unimportant. Except the following. Here also the most important area is what are the exceptions from transfer? Section 47. Around 14-15 points are there in exceptions list, which is very important in capital gain chapter. So due to time constraint, I don't want to explain each and every point here. I will explain some of the points. Okay. So first of all, this is the list of transfer exceptions to transfer. Around 16 points are there. Okay. I will explain some points relating to exceptions to transfer. First one, total and partial partition of HUF. Partition of HUF. My dear students, at the time of partition of HUF, either full partition or partial partition, the assets of HUF shall be transferred to members. Members are co-partners. Such transaction will not be treated as a transfer. At the time of partition of HUF, whatever the capital assets transferred by HUF to its members or co-partners, then transferor need not calculate any capital gain, because such transaction will be treated as an exception to transfer. Have you understood? And second one is gift or will or inheritance. Gift or will or inheritance. If X gifted his capital asset to Mr. Y, X need not calculate capital gain. X transferred a capital asset to Y by way of will is also not treated as a transfer. No capital gain will arise. Inheritance is also not treated as. If X died and all the assets of X will become the assets of his son, such as transaction is treated as an inheritance of assets. Such transaction will not be treated as a transfer. No capital gain will arise. Third one is holding company to subsidiary company. Transaction between holding to subsidiary, vice versa, will not be treated as a transfer. Transfer of capital assets by holding company to subsidiary company to holding company will not be treated as transfer, subject to two conditions here. One is the recipient company must be an Indian company, and shareholding must be 100% shareholding must be held by the holding company, wholly owned holding company. Then only exception is available. Otherwise, it becomes a transfer. The transferor is required to calculate capital gain. Have you understood? Transactions between holding to subsidiary, subsidiary to holding will not be treated as a transfer. And next one more exception to transfer is at the time of liquidation. At the time of liquidation, assets distributed by a company to shareholders. Distribution of assets on liquidation is not treated as a transfer. No need to calculate capital gain by the company. Company is not required to calculate capital gain. Direct distribution. Distribution made by the company to its shareholders on its liquidation will not be treated as a transfer. No need to calculate capital. Have you understood? So next, one more transaction is at the time of amalgamation. At the time of amalgamation, there are two parties, amalgamating company, amalgamated company. Amalgamated company. At the time of amalgamation, the assets of amalgamating company shifted to amalgamated company. Transfer of assets. Such transaction will not be treated as a transfer. No capital gain will arise. Okay. Transfer of capital assets by amalgamating company to amalgamated company at the time of amalgamation will not be treated as a transfer. No need to calculate capital gain by the transferor. Okay. And one more important point, in same amalgamation, the amalgamating company shareholders are required to exchange their shares of amalgamating company into amalgamated company shares. Such exchange is also not treated as a transfer. Okay. Another transaction is exchange of shares. Exchange of shares of amalgamating company into shares of amalgamated company at the time of amalgamation is not treated as a transfer. Okay. So tell me again, the first transaction is distribution of assets by HUF to its members or co-partners at the time of partition, including partial partition also. Second one is transfer by way of gift or will or inheritance. Third one is transfer of holding company to subsidiary company or subsidiary company to holding company. One of the transaction is HUF to members or co-partners, assets transferred on partition is not treated as a transfer. No capital gain will arise. Okay. Liquidation point, amalgamation point, partition of HUF, and another transaction is transfer by way of Mr. X transferred asset to Mr. Y on gift or will or inheritance. This is also not treated as a transfer. No capital gain will arise. And the next transaction is holding company to subsidiary company. Holding company to subsidiary company or subsidiary company to holding company. The asset transferred will not be treated as a transfer. No capital gain will arise in such transaction. It's a vice versa transaction, but subject to two conditions. The recipient company must be an Indian company and shareholding must be 100%. And the next one is, another transaction is demerger. There are two parties involved in demerger, demerged company, resulting company. Resulting company. Okay. So here also same, just like amalgamation, at the time of demerger is nothing but split up as two companies. A big company was separated as two small companies. It's a demerger. Okay. So at the time of demerger, the assets of demerged company, some of the assets of demerged company will be transferred to resulting company, new company. That will not be treated as a transfer. Transfer of assets will not be treated as a transfer. No capital gain will arise. Transfer of capital assets by demerged company to resulting company at the time of demerger is not treated as a transfer. And in same demerger, the shares were exchanged is also not treated as a transfer. Exchange of shares. The demerged company shareholders are required to exchange some of their shares to resulting company shares. Such exchange of shares will not be treated as a transfer. Some other transactions are there in section 47. Please verify the rest of the transactions. So I want to most popular transactions which were covered in section 47. These are the most popular transactions which will be involved in problematic part. Okay, have you understood? So around 10 transactions are there. Remaining transactions, read it in your material. Okay. But remaining are, I think, in problematic point of view, it's an unimportant transaction. These are the very important transactions. Okay. Next. My dear students, coming to the computation procedure, how to calculate the capital gain. First of all, capital gains are classified into two types: long-term capital gain, short-term capital gain. Capital gains are classified into two types: long-term, short-term. One of the important long-term capital gain will arise on transfer of long-term capital asset. Short-term capital gain will arise on transfer of short-term capital asset. On transfer of long-term capital asset, the resultant capital gain is long-term capital gain. On transfer of short-term capital asset, the resultant capital gain is short-term capital gain. If it is negative, short-term capital loss. Have you understood? So, my dear students, now a question rises in this: how to decide whether the asset is long-term or short-term? How to decide whether the asset, capital asset, is long-term or short-term? It's a very important process. It's not given directly in the problem. We too require to calculate the nature of capital asset, whether it is long-term or short-term. Okay, how to decide the capital asset, whether it is long-term or short-term, whether long-term or short-term, nature of capital asset, whether long-term or short-term, shall be decided based on period of holding period of such asset. How much period held by assessee? Such asset was held by the assessee. So based on that period, to decide whether it is long-term or short-term, period of holding. But which period to be considered? Which period to be considered to decide whether the asset is long-term or short-term? My dear students, the assets are classified into three types. Category 1, Category 2, Category 3. Category 1 assets. There are 5 assets covered in this category. In those assets, to decide whether it is long-term or short-term, 12 months holding period to be considered. 12 months. The assets covered in category 1 is treated as long-term or short-term. It depends upon 12 months holding period. If it was held by the assessee for more than 12 months, long-term capital asset. Less than or equal to 12 months, short-term capital asset. Have you understood? For category 2 assets, 24 months to be considered. If it was held for more than 24 months, then long-term capital asset. If it was held for less than or equal to 24 months, then short-term capital asset. Okay. For category 3 assets, 36 months to be considered. Okay. 1 year, 2 years, 3 years. Category 3 assets to be decided whether it is long-term or short-term based on 36 months. If it was held for more than 36 months, then it shall be treated as a long-term, otherwise short-term. Okay. What are the assets covered in category 1, 2, 3? Okay. Category 1 assets, listed securities, including shares, units of UTI, units of equity-oriented mutual fund, zero coupon bonds. All these assets shall be decided whether it is long-term or short-term based on 12 months. Category 2, unlisted shares, immovable property, 24 months to be considered. Any other asset not covered in category 1 and category 2 will be treated as 36 months to be considered to decide whether it is long-term or short-term. And one more important point, 50AA is a newly added section. The assets covered in section 50AA is always short-term capital asset. The above table is not applicable. We'll discuss about 50AA later, just wait. Okay. So for category 1 assets, 12 months to be considered. For category 2 assets, 24 months to be considered. For other assets, category 3 assets, 36 months to be considered. This table is very important. What will be the format? First format, what is the format for computing capital gain? First of all, gross capital gain, gross consideration or full value of consideration. You can take it, anyone. Okay, no issue. Gross consideration to be considered on transfer of such capital asset. Gross consideration. Okay. Next one, transfer expenses. If any expenses incurred at the time of transfer, it must be deductible from gross capital gain. Example, brokerage commission, etc. Okay. Next, then we'll get net consideration. Net consideration. After that, deduct cost of acquisition if it is a short-term capital asset. Indexed cost of acquisition if it is a long-term capital asset. Okay. Next, cost of improvement if it is a short-term capital asset. Indexed cost of improvement if it is a long-term capital asset. After deducting these two amounts, then we'll get gross capital gain. Gross capital gain. After that, exemptions, if any, under section 54 series, then we'll get ultimate answer, that is net capital gain, either long term or short term, based on nature of asset was transferred. Okay, this is the format to be filled up while calculating the capital gain. Have you understood? So I'll explain some parts which are very important, which are very helpful to the students. Okay, next, cost of acquisition, most important concept. Cost of acquisition is nothing but generally whatever the cost incurred at the time of acquisition of capital asset, including incidental expenses, to be considered as a cost of acquisition. The most important point, actual cost of asset. Actual cost of asset plus incidental expenses, registration charges, etc. Actual cost of asset plus incidental expenses incurred at the time of purchase, to be considered as cost of acquisition. Okay, cost of acquisition, cost incurred at the time of purchase of asset is nothing but acquisition of asset plus incidental expenses. For example, I have purchased a building for 40 lakhs and the registration expenses incurred were 3 lakhs rupees. Then what is the cost of acquisition of such asset? 43 lakhs. Okay. But however, the most important point, however, while determining the cost of acquisition, fair market value as on 1/4/2001 is very important on 1/4/2001 concept. Okay, so Act says that if asset was acquired before 1/4/2001, then 1/4/2001 market rate to be considered. This is most important concept. It will very useful to the students. Please remember carefully. Please listen this concept carefully. It will become very useful to you. Compulsory in examination point of view also, this is very important concept. Fair market, the concept of fair market value as on 1/4/2000. When it will be applied, Act says that. And one more important point, it's applicable only to tangible assets. Applicability. There are two conditions to be satisfied for applicability of this concept. One is asset transferred to tangible assets. This concept is not applicable to intangible assets. Okay. And date of transfer 1/4/2001, before 1/4/2001. Date of transfer before 1/4/2001. Okay. So if these two conditions were satisfied, then concept of 1/4/2001 gets attracted automatically. Okay. So what is the provision? Provision says that if asset was acquired before 1/4/2001, the two tangible assets. Okay. So then cost of acquisition is equal to for movable asset. Cost of acquisition is equal to actual cost. You may take the fair market value as on 1/4/2001 to be considered instead of actual cost. You may take it. It is not a mandatory. Okay. That means you can select whichever is higher. That's the beneficial to you. Okay. So directly cost of acquisition in such case, if it is a movable asset acquired before 1/4/2001. Okay, then what is the cost of acquisition? Actual cost or fair market value as on 1/4/2001. Whichever is higher to be considered. That's it. So this concept is applicable only to movable nature of asset. And movable nature of asset as well as immovable asset also, but it must be a tangible. Intangible asset, this concept is not applicable to intangible assets. Okay, I give you the note point about intangible, just wait. So if it is a movable asset, cost of acquisition shall be compared with the fair market value as on 1/4/2001. Then you may take, you can take whichever is higher directly. Okay. If it is immovable property, Act says that the fair market value cannot exceed stamp duty value on that date. That is 1/4/2001. If fair market value exceed stamp duty value on 1/4/2001, then whichever is lower to be considered. Then compare with actual cash. Then whichever is higher to be considered. That's the too complicated point. If it is an immovable property, if it is an immovable property, A, actual cost to be considered. B, lower of the following: paid market value on 1/4/2001, stamp duty value on 1/4/2001. Whichever is lower to be considered, ultimately whichever is higher to be considered. Have you understood? If it is a movable asset, you can compare directly to fair market value and whichever is higher to be considered. If it is an immovable property, then actual cost shall be compared to lower of the fair market value or stamp duty value, whichever is higher to be considered directly. Have you understood? So most important in capital gain chapter, and the above provision is not applicable to intangible assets. Fair market value on 1/4/2001 not applicable to intangible assets. But what about intangible assets? For intangible assets, always actual cost to be considered, irrespective of date of purchase. That is, for intangible assets, actual cost to be considered. Irrespective of date of purchase. Have you understood? That's the important concept. So for computing capital gain, the first transaction is gross consideration or full value of consideration. After that, deduct transfer expenses, if any. After that, we'll get net consideration. After that, reduce cost of acquisition if it is a short term, indexed cost of acquisition if it is a long term. Cost of improvement if it is a short term, indexed cost of improvement if it is a long term. Okay. So this is one of the important concept in cost of acquisition provision. And one more important point for cost of acquisition provision to be: generally, what is the cost of acquisition? Actual cost of asset plus incidental expenses to be considered. That's the first point and main point. However, if asset was acquired before 1/4/2001, then what is the cost? Then fair market value concept gets attracted. And one more important point: what is the cost of acquisition if asset acquired by any modes specified under section 49(1). 49(1), there are lot of cases covered in section 49(1). So, for example, 49(1) is nothing but the cases covered already in section 47. Gift, will, inheritance, partition of HUF, holding company to subsidiary company to holding company. Some of the transactions, important transactions covered in section 49(1) are: first one, transfer of assets by way of gift or will or inheritance. Second one, partition of HUF. Third one, holding company to subsidiary company or subsidiary company to holding company, transfer of asset. Next one, transfer of assets at the time of liquidation. Next one, transfer of assets at the time of amalgamation. at the time of amalgamation, demerger. Okay, these are the main transactions. Some other transactions are there, but these are the main transactions covered in section 49.1. 49.1 cases. Of course, these are all the cases which were covered in section 47 also. It's nothing but the interpretation is these transactions are not treated as a transfer. Hence, at the time of a transfer by way of these transactions, no capital gain will arise. But now the question is, such asset will be sold by the transferee in future to some other person, then what is the cost of acquisition? That's the deals with section 49.1. Okay, for example, let us say an example, gift. Gift says that in all these transactions, whatever the transaction covered in section 49.1, whatever the transactions covered in section 49.1, cost of acquisition is previous owner cost to be considered. In all these cases, cost of acquisition is equal to previous owner cost to be considered. Previous owner, whatever the cost incurred by the previous owner to be considered as a cost of acquisition. The same rule is applicable to above mentioned all cases. Have you understood? I gave you a practical example for this. X purchased a capital asset, purchase value 10 lakhs. After that, X gifted such asset to Y. Gift to Y. So gift to Mr. Y. What is the treatment at the time of gift by X to Mr. Y? Not transfer. No capital gain will arise. Because gift is not treated as a transfer. It was covered under section 47. Section 47 transaction. Gift. Asset received by way of gift. X is not required to calculate capital gain because X is a transferor here. X is a transferor, is not required to calculate any capital gain because such transaction is not treated as a transfer. Okay. Now the question is, what will be the consequence if Mr. Y sold this asset to any other person subsequently? Y transferred, sold to Mr. Y, Mr. Z. Y sold to Mr. Z, such asset received as a gift from Mr. X. What will be the consequence? In this case, at the time of sale to Mr. Z, that who is transferor here? Mr. Y. Y is required to calculate capital gain. Compulsory, the transferor is liable to calculate capital gain here because sale is treated as a transfer. But what is the cost of acquisition? What is the cost of acquisition here? Here section 49.1 gets subtracted. 49.1 says that whatever the asset received by any modes specified under section 49.1, then cost of acquisition is equal to cost to the previous one. Here who is the previous owner here? Mr. X. What was the cost incurred by X for acquiring this asset? 10 lakhs. The same 10 lakhs to be considered as cost of acquisition. That's it. That's the 49.1 treatment. Have you understood? 10 lakhs to be considered as cost of acquisition. Then calculate the capital gain. Okay. So this is one of the important 49.1 cases. How to calculate capital gain if asset was acquired by any modes specified under section 49. Okay. Next transaction is important transactions. Now we want to start some special cases for computation of capital gain. Special cases. Some of the special cases in which the capital gain computation procedure is something different. What are those cases and how to calculate the capital gain in those cases? Okay. So first one is generally capital gain. In which year the capital gain shall be calculated? Year of transfer. Whenever the asset was transferred, then only you are required to calculate capital gain, which was already discussed at the beginning. So in the year of transfer, irrespective whether the consideration is received or not, because we are following cash basis. Sorry. We are following accrual basis. Okay. So when the capital gain calculation shall be made? In the year in which the capital asset was transferred in general. Okay. Generally, capital gain shall be calculated in the year of transfer, but in some exceptional cases, the capital gain shall be calculated in some other in some other period, in some other time. So those cases were covered, and a lot of cases were covered in this special cases. So around, for example, 45(1)(a), 45(2), 45(5). These are the important special cases. In these cases, the capital gain shall not be calculated in the year of transfer. Okay, but when will be calculated? We'll discuss one by one. 45 subsection 1A. 45 subsection 1A, one of the important, 45 subsection 1A, one of the important special case. 45 subsection 1A. Okay, for example, I will explain this section with a practical example. It's a damage destruction of capital asset. What is the heading? What is the heading for this section is transfer of capital asset for damage or destruction, by way of damage or destruction, and received insurance compensation. Then how to calculate capital gain? Section 45(1)(a). 45(1)(a) deals with how to calculate capital gain. In case of transfer of assets by way of due to damage or destruction and received insurance compensation. Have you understood? So how to calculate capital gain? In case of loss of assets due to damage or destruction and received insurance compensation. Have you understood? And one more important point, I will explain this section with practical example. Okay. For example, Mr. X purchased the capital asset purchased in 2010-2011 for rupees 20 lakhs. Okay. Next, this asset was lost by the assessee due to destruction, due to fire accident, typhoons, hurricanes, civil disturbances, accidental fire, action taken by. There are some of the reasons specified in the act. Go and verify the reason for destruction. Due to any of those reasons, the asset was lost by the assessee. Due to any of those reasons, then section 45(1)(a) gets attracted. Yes. So the asset was destructed in 2015, 2020, 2021. Okay. So, and subsequently he insured the asset. Automatically the insurance company paid the insurance compensation, received insurance compensation in 2023, 2024. What will be the tax consequence? Okay. So, and one of the important point here is generally what is transfer here? Act says that transfer includes sale, exchange, relinquishment, extinguishment of capital asset. This is an extinguishment of capital asset. Destruction is an extinguishment. So the asset was transferred. What is the year of transfer here? 21-22. Year of transfer here is 21-22. Generally, capital gain shall be calculated in the year of transfer. If you followed the basis of chargeability accrual basis, then you need to calculate the capital gain in 21-22. It's 2021 itself, because transfer took place in that year. Okay. But 45(1)(a) says that here in this case, you are required to calculate capital gain not in the year of transfer. Just wait until the receipt of compensation, then only you are required to calculate capital gain. That is, you simply follow the cash basis. Okay, that's the 45(1)(a) is an exception to method of accounting. That is exception to basis of chargeability, exception to accrual basis. In this case, you need not calculate capital gain in the year of transfer. Just wait until the receipt of compensation. Whenever the compensation was received, then only you are required to calculate capital gain. Therefore, here the capital gain shall be calculated in the year of receipt of compensation, that is 23-24. That's the concept section 45(1)(a) says that. Okay, generally the capital gain shall be calculated in the year of transfer, but here capital gain shall be calculated not in the year of transfer, only in the year of receipt of compensation. But however, year of chargeability is 23-24, but indexation facility and period of holding to be considered only up to the year of transfer. Indexation and period of holding. Period of holding and indexation. To decide whether the asset lost due to destruction, whether it is long term or short term, period of holding to be considered from the date of purchase up to the date of destruction. And if it is a long term capital asset, indexation facility is available. Indexation is also to be made up to the year of transfer. But year of chargeability is whenever the compensation was received. Then only you are required to calculate capital gain. But period of holding and indexation shall be considered only up to the year of transfer. Have you understood? This is the main content relating to section 45 subsection. Yeah. Example relating to section 45 subsection 2. It says that how to calculate capital gain where the capital asset was converted into stock in trade and sold. Okay. So we'll explain with a practical example. Then you can understand very easily. For example, I was purchased a capital asset. Capital asset purchased in 2010-11 for rupees 10 lakhs. After that, the capital asset was converted into stock in trade. In 2017-18. At the time of conversion, the fair market value of capital asset is 18 lakhs. Okay, at the time of conversion of capital asset into stock in trade, the market rate of such capital asset is 18 lakhs. Okay, subsequently, this converted stock in trade was sold, sale of stock in trade in 2023-24 for rupees 25 lakhs. So section 40, what section 45(2) says that, so generally the conversion of capital asset into stock in trade itself is treated as a capital asset, sorry, transfer. This transaction was covered in the definition of transfer includes. Okay, this transaction will be treated as a transfer. What is the year of transfer here? Here the conversion takes place in 2017-2018. Therefore, year of transfer is 2017-2018. Okay, but Act says that generally capital gain shall be calculated in the year of transfer. But this section is an exception to method of accounting, that is accrual basis. You need not follow here accrual basis. But when you will calculate the capital gain, Act says that the capital gain shall be calculated not in the year of conversion. Just wait until the sale of stock in trade. Then only you are required to calculate capital gain. Okay. So that is the year of chargeability. What is the year of chargeability? Year of sale of stock in trade. Whenever the stock in trade was sold, then only you are required to calculate capital gain. Okay, need not calculate capital gain in the year of conversion. Only calculate the capital gain in the year of sale of stock in trade. Okay, that's the something different rule to be followed for calculating the capital gain. And one more important point here is, but period of holding and indexation to be considered up to the date of transfer. Period of holding to decide whether it is long-term asset, short-term, shall be period of holding shall be reckoned from the date of purchase up to the date of transfer itself. And indexation is also available up to the year of conversion. If it is a long-term capital asset, indexation facility is available up to the year of conversion. But year of taxability is year of sale of stock in trade. That's the important, these are the important points relating to section 45 subsection 2. But what is the consideration for calculating the capital gain? Whatever the fair market value at the time of conversion to be considered as consideration for calculating the capital gain. This will be taken as consideration for computing capital gain. And one more important point here is, you should remember, in the year of sale of stock in trade, not only the capital gain, you are required to calculate you are required to calculate pgbp also. So this is the one of the important section. Why this section is very important? In this section, you are required to calculate two heads of incomes. One is capital gain for conversion, pgbp for sale of stock in trade. Okay, two heads of incomes will arise in this particular section, 45 subsection 2. For calculation of capital gain, the fair market value to be considered as a consideration, but same consideration, same fair market value to be considered as a cost of acquisition for calculating pgbp. So that here one thing we should remember, fair market value on the date of conversion itself is to be considered, plays very important role in this section 45 subsection 2. It plays two important roles. One is consideration for computation of capital gain and cost for computation of pgbp. Okay, so these are the details relating to section 45 subsection 2. Next one, 45 subsection 5. How to calculate capital gain in case of compulsory acquisition of capital asset. Compulsory acquisition of capital asset. By government, either central government or state government, whatever it is. So how to calculate capital gain, when to calculate capital gains, what is the procedure for computation of capital gain in case of compulsory acquisition of capital asset by the government, deals with section number 45 subsection 5. This is also a very important section. Of course, my dear students, my suggestion is all three sections covered in this 45 series, 45 1A, 45 2 and 45. Three sections are triple star sections, most important sections in capital gain chapter. Okay, so don't neglect while preparing capital gain chapter. Please concentrate on these three sections. These are very important. Okay, so how to calculate capital gain in case of compulsory acquisition of capital asset? I'll explain with a practical example. For example, I was purchased a capital asset in 2010-2011. Capital asset purchased in 2010-2011. Subsequently, this capital asset was compulsorily acquired by government in 2020-2021. But the government pays the compensation in compensation received in 2023-24. Okay, So what section 45 subsection 5 says that how to calculate, when to calculate. So calculate the capital gain in case of compulsory acquisition of capital asset by the government. Generally, here the transfer is compulsory acquisition itself is treated as a transfer. What is the year of transfer here? 2020-21, because compulsory acquisition itself is treated as a one of the transaction covered in transfer definition. Okay, but generally capital gain shall be calculated in the year of transfer. Here transfer took place in 2020-21, but Act says that need not calculate capital gain in the year of transfer here. Just wait until the compensation received from the government. Okay, you should require to calculate capital gain not in the year of transfer, only in the year in which the compensation paid by the government. Here the compensation received in 2023-24. Therefore, you are required to calculate capital gain in 23-24 itself. What is the year of chargeability? Year of receipt of compensation. And one more important point, if compensation received on installment basis, then year of receipt of first installment. Entire compensation is taxable in the year of receipt of first installment. That's the very important one. For example, I was received a part of the compensation in 23-24, that is 20 lakhs. Remaining again, second installment of compensation received in 24-25, 10 lakhs. Again, third installment, first installment, second installment, third installment, 25-26, 10 lakhs. So compensation received on installment basis, 20 lakhs plus 10 lakhs plus 10 lakhs, total 40 lakhs. Act says that entire compensation, entire capital gain shall be calculated in the year of receipt of first installment. You're required to calculate capital gain on entire amount of 40 lakhs. Again, we need not calculate any capital gain in receipt of second installment and third installment. No need to calculate, because so those installments were also taxed in the year of receipt of first installment. Have you understood? And one more important point here is period of holding and indexation shall be calculated up to the year of transfer. That is to decide whether it is long term or short term. The period of holding shall be calculated up to the year of transfer. If it is a long term capital asset, indexation is also available up to the year of transfer. Have you understood? So, and one more important point, generally in case of compulsory acquisition, the compensation will be fixed by the government. Sometimes the assessee is unsatisfactory about compensation, he may go for appeal before any authority or court. Based on the instructions by the court, if government paid any additional compensation, that will be called as enhanced compensation. Enhanced compensation is also taxable under the head capital gain, but not in the year of receipt of initial compensation. That will be taxed in the year of receipt of such enhanced compensation. So, of course, enhanced compensation is also taxable under the head capital gain, but in the year of receipt of such enhanced compensation. And one more important point, no cost of acquisition, no cost of improvement for enhanced compensation. These two amounts shall be taken as nil. But if any expenses, legal expenses incurred to get such enhanced compensation shall be deductible, except that no other expenses shall be deductible from enhanced compensation except legal expenses. Okay, what is the treatment of enhanced compensation? That will be taxed under the head capital gain. But what is the year of taxability? Year of receipt of such enhanced compensation is nothing but cash basis. Cost of acquisition nil, cost of improvement nil, expenses, legal expenses if any, shall be deductible. That's it. And one more important point, sometimes the government paid an interest on compensation also. If compensation paid on lately, or if compensation paid on installment basis, on enhanced compensation, whatever it is, sometimes government paid any interest on compensations. That interest will not be taxed under the head capital gain. Interest will be taxed always under the head income from other sources, subject to a deduction under section 57. We'll discuss in other sources, just wait. Interest element always taxable under the head other sources. initial compensation and enhanced compensation, both taxable under the head capital gain, but interest will be taxed under the head other sources. Have you understood? Okay. Next, these are the sections covered in 54 series. So, 45 series, 45 1A, 45 2, 45 subsection 5. All three sections are very important. Okay. So, few more sections relating to capital gain in 50 series. So, 45 series has completed already, 45 1A, 45 2, 45 5. These three sections are very important. And in 50 series, there are 6 sections are there in this series, but out of that, so I want to explain only 2 sections. So, one is 50, second one is 50. These two are very important in 50 series. Okay. So, first section 50. Section 50 is nothing but how to calculate capital gain on transfer of depreciable assets. This section deals with how to calculate capital gain on transfer of depreciable assets. What is depreciable assets? Generally, the assets on which the assessee has claimed depreciation in his books of accounts. It simply says that generally assets used in business or profession are treated as depreciable. Have you understood? So, for example, if building used for residential purpose, then it's a non-depreciable asset. If building used for business purpose, it's a depreciable asset, because the assessee is maintaining books of accounts for business or profession and has claimed depreciation in each and every financial year on such asset. So in future it will be transferred to some other person, then they are required to follow section 50 for calculating the capital gain. So generally assets used in business or profession are treated as depreciable capital assets. Then on transfer of those assets, then capital gain shall be calculated as per the procedure specified in section 50. Okay, what was the procedure specified in section 50? Act says that, so the procedure, the format to be used for calculating the capital gain on depreciable asset is, first take the consideration, full value of consideration. Is nothing but gross consideration as it is, less transfer expenses, if any, shall be deductible. Then we'll get net consideration. Okay, then less, generally from net consideration we have to deduct the cost of acquisition if it is a short-term capital asset, indexed cost of acquisition if it is a long-term capital asset. But here is something different point. That's one of the important area. What was the cost to be considered here for calculating the capital gain on depreciation? Here cost of acquisition is opening WDV of such block, opening WDV, plus additions if any in that block, the value of cost of addition in that block during the current period to be considered as this addition, cost of addition. This will be taken as cost of acquisition. And one more important point, no indexation facility for depreciable asset, because we have to take opening WDV as cost of equity. It need not be indexed again. Okay. So the resultant capital gain is always short term. The question of long term capital gain does not arise. Short term capital gain if it is a negative, short term capital loss. These two are very important in section 50. So now tell me, what was the cost of acquisition to be considered for calculating the capital gain on depreciable asset? Opening WDV of such asset or such block plus additions if any in that block. Cost of addition if any shall be added to opening WDV and to be taken as cost of acquisition. Then the resultant amount is always short term. If it is a profit, short term capital gain. If it is loss, short term capital loss. So these are the very important points. First one of the note here is to be considered indexation facility not available to depreciable asset. Indexation not available. And the period of holding also not to be calculated because the resultant income fixed as short term. Okay, so no need to calculate the period of holding. Period of holding not required to be calculated because the resultant income was already decided as short term. Therefore, the question of period of holding also not. Have you understood? These are the highlighted points relating to capital gain on depreciable assets. Have you understood? Depreciable assets, section 50 was connected with section 32 in pgbp head because 32 and 50 are mutually exclusive. Whenever section 32 gets attracted in a block of asset, then section 50 does not attract. Whenever section 32 does not attract it, then only section 50 gets attracted. That's the important. Have you understood? For example, let us take a block. For example, block plant and machinery 15%. Let us take example, opening WDV of the block 20 lakhs. Around 6 machines are there in that block. Next, during the current previous year, 2 more machines were purchased falling under same block for rupees 10 lakhs. Add cost of additions. 2 machines for rupees 10 lakhs. Total 30 lakhs. Now sale of some machines from this block for 32 lakhs. Sale value. Around 4 machines were sold. For example, around 7 machines were sold for 32 lakhs. So Act says that for applicability of section 32, if section 32 gets attracted, then need to calculate depreciation unclaimed as deduction under the head pgbp. The question of applicability of section 50 does not arise. Whenever section 32 does not attracted, section 50 gets attracted. Here, section 32 does not attracted because the block becomes closed. Okay. Conditions for applicability of section 32. For applicability of section 32, at least one asset in block as on the last day of the previous year. At least one asset. In that block as on the last day. of previous year. At least some value in that block. Value is nothing but positive value in that block as on the last day. Of previous year. If these two conditions were satisfied, section 32 gets attracted. For example, if these two conditions were satisfied, then section 32 gets attracted. If any one of these conditions were not satisfied, not satisfied, not satisfied. In these three cases, instead of section 32, section 50 gets attracted. Section 32 not attracted in these three cases because one of the conditions were not satisfied or both the conditions were not satisfied. If the above mentioned conditions both satisfied, then section 32 gets attracted. Whenever section 32 gets attracted, then you are required to calculate depreciation and charged under the head pgbp. Whenever section 32 does not attracted, then 50 gets attracted, then need to calculate capital gain. Okay, so please verify it in current example whether 32 was applied or 50 applied. Here in opening WDV, around 6 machines are there. During the previous year, 2 machines were purchased. 6 plus 2, 8 machines. Out of that, 7 machines were sold. Therefore, machines left in that block as on the last day is 1 machine. Therefore, one of the condition was satisfied. At least one asset in that block as on the last day. Yes, there was a machine. There was a machine in that block as on the last day. One of the condition was satisfied. At least some value in that block as on the last day, but here no value in that block. The value becomes negative. Therefore, the second condition was not satisfied. Therefore, here section 32 does not attracted. Section 50 gets attracted. Then you are required to calculate capital gain. Whenever section 50 gets attracted, then need to calculate capital gain. What was the consideration to be considered here? 32 lakhs. Capital gain format is consideration minus cost of acquisition. It's a depreciable asset. You can use section 50. Consideration is equal to 32 lakhs. Minus cost of acquisition. What was the cost of acquisition in depreciable asset? Opening WDV plus additions. These two amount in aggregate to be considered as cost of acquisition. That is 30 lakhs. Opening WDV plus additions. 30 lakhs. The resultant income is positive. Therefore, short-term capital gain. If it is negative, short-term capital loss. That's the connection of section 50 with section 32. Have you understood? Whenever section 32 does not attract it, then only section 50 gets attracted. Then you are required to calculate the capital gain or capital loss. Have you understood? Next. One more section in 50 series. 50. My dear student, this is one of the important section. Consideration on transfer of immovable property. Consideration on transfer of immovable property. Consideration on transfer of immovable property. Okay. Generally, for immovable property, if you want to transfer the immovable property to any other person, compulsory registration formality is mandatory. Whenever the transfer when completed on transfer of immovable property, the answer is whenever the asset was registered in the name of buyer. Registration is mandatory to transfer of immovable property. That is one of the important points. But whenever you went to registrar office for registration, they are valuing your asset. Again, that value which was taken by the registration authority to be considered as stamp duty value. Stamp duty value plays very important role in this section. Stamp duty value is nothing but the value ascertained, adapted ascertainable by stamp valuation authorities, alternatively called as registration authorities. Whatever the asset comes to registration office for registration purpose, automatically the registration authorities valuing such asset. Okay, so whatever the value ascertained by the registration authority for those immovable properties who comes to registrar office for registration, so then such value to be considered as stamp duty value. Now, section 50C. Section 50C says that how to ascertain the consideration on transfer of immovable property. Okay, so the Act says that the main provision in this section is the main provision. For example, if X transferred a land to some other person for 40 lakhs, both the parties went to registrar office. The registration authorities valued such asset. The value taken by registration authorities is stamp duty value, which is 46 lakhs. So now the question is, the consideration actually you received is 40 lakhs, but value ascertained by the registration authorities is 46 lakhs. There is a difference between value consideration actually received by the assessee and value ascertained by the registration authorities. Here section 50C says that, so whenever the stamp duty value, if stamp duty value exceed 110% of your actual consideration, then while calculating the capital gain, stamp duty value to be considered as deemed consideration. That's the main and important point in this section. The main provision says that if stamp duty value exceed 110% of actual consideration, then stamp duty value to be considered as consideration. Okay, so that is one of the important point. And if it does not exceed 110%, for example, actual consideration here is 40 lakhs, stamp duty value 46 lakhs. Yes, here stamp duty value exceed 110% of actual consideration, because 40 lakhs into 110%, 44 lakhs. Stamp duty value 46 lakhs. Yes, it exceed 110% of actual consideration. Therefore, stamp duty value to be considered as consideration, as deemed consideration. It's a deemed consideration. Okay. So, and some other points relating to this section is, sometimes stamp duty value as on the date of agreement and stamp duty value as on the date of registration are not the same. Then which value to be considered? That's also an important note point. If stamp duty value on the date of agreement and stamp duty value on the date of registration are not the same, then Act says that subject to some conditions. There are 3 conditions. One is the transferor is required to collect some consideration from transferee, received consideration either fully or partly, and the date of receipt on or before the date of agreement, mode of receipt any mode other than cash. If these 3 conditions were satisfied, agreement related stamp duty value to be considered. If not satisfied, registration related stamp duty value to be considered. That's it. Condition number A. So received consideration. Either fully or partly. And B. Date of receipt. On or before the date of agreement. See, mode of receipt other than cash. If these three conditions were satisfied, then consideration is equal to stamp duty value on the date of agreement to be considered. If it exceed 110% of actual consideration, that conditions must be satisfied. If these conditions were not satisfied, then consideration is equal to stamp duty value on the date of registration. That's another important point. Okay, this is one of the important point. And one more note is there. If assessee is having any objection about stamp duty value, in the opinion of the assessee, if the opinion of the assessee stamp duty value exceed paid market value, that is, stamp duty value is unjustified in the opinion of the assessee, then the assessee is having two remedies. The assessee is having two remedies. Remedy 1, he may go for appeal before any authority or court. Then what will be the consideration in case of appeal? Then consideration is equal to value ascertained by appellate authority. Value ascertained by appellate authority to be considered as this as consideration. If stamp duty value is objectionable in the opinion of the assessee. Objectionable is nothing but in the opinion of the assessee, it exceeds the market rate in that area, then he may go for appeal. Then whatever the value ascertained by the appellate authority to be considered as it is. Another remedy is remedy 2. He may request to assessing officer. Request to assessing officer to refer the case to valuation officer. Okay, so request to assessing officer, for what purpose? Please refer the case to valuation officer and valued it correct paid market value with the valuation officer. So make a request to assessing officer. Okay, so then the assessing officer may refer the case to valuation officer. Refer the case to valuation officer, expert valuationers. Then what will be the consideration here to be considered is, what was the amount taken by valuation officer or stamp duty value, whichever is lower to be considered. Here consideration is equal to stamp duty value or valuation officer's amount, whichever is lower. That's it. This is all about section 56. Have you understood? So most important section. The main provision is very important and two note points very important. If stamp duty value on the date of agreement, on the date of registration are not the same, then what will be the value to be considered? That's also one of the important. And second one is, in the opinion of the assessee, stamp duty value is objectionable. Then what are the remedies the assessee is having? That's the important. Okay. Next, we'll go to another section. 51, per future of advance money. Section 51. For example, I was entered into an agreement with so and so person for transfer of my asset, that is land. I entered into an agreement and received some amount as an advance. For example, 5 lakhs received as an advance. After some time, due to violation of the buyer, due to default of the buyer, the agreement will be cancelled. The agreement was cancelled due to violation of the buyer. Buyer not interested to purchase such asset, so that he is ready to cancel the agreement, and the transferor retained the advance money. Retained the advance money is nothing but not refunded to the buyer. So it's retained by the seller that retention money is called as per future of advance money. If it was repaid to the buyer, then the question of income does not arise. Then section 51 does not arise in that case. Whenever the amount of advance received by the seller was not refunded to the buyer due to violation of the buyer, here default made by the buyer, so that the seller is not having any right to refund the amount, because it's not his mistake. Okay, that's one of the important point. If you want to transfer your asset to any other person and received as an advance due to any reason, if agreement was cancelled and the advance received by you retained by the assessee, then retention money is called as per future of advance money. It will be treated as an income to the seller. Transfer our point of view, such retention money, that is perfuted amount, shall be treated as an income. No doubt he is liable to pay tax to the government. But the question is how it will be taxed, when it will be taxed. Okay, that's the provisions relating to taxability of per future of advance money deals with section number 51. 51 says that, section 51. Section 51 says that per future amount, generally, no doubt, per future amount shall be taxable in the hands of transferor. Now the question is, under which head of income it will be taxed, and in which year it will be taxed. That's the important points. Okay, so section 51 says that treatment based on the date of per future. One of the important point, if date of per future before 1/4/2014, if date of per future before 1/4/2014, if date of per future on or after 1/4/2014, if date of per future before 1/4/2014, then Act says that it will be taxed directly under the head capital gain, taxable under the head capital gain. The treatment is reduced from capital gain. That is one of the important point, taxable under the head capital gain, in capital gain itself. But here is, if date of transfer on or after 1/4/2014, then it will be directly taxable under the head income from other sources. Need not taxable in capital gain chapter, it will be shifted to income from other sources. That's the important point. And one more point, year of taxability. Year of taxability is, year of taxability if date of per future before 1/4/2014, year of taxability is year not in the year of per future. Just wait until the capital asset was transferred to some other person. Okay, year of transfer of such capital asset. So year of transfer, not in the year of per future. Just wait until the transfer of such capital asset to some other party. Then only the per future amount will be taxed. Okay, but if date of per future on or after 1/4/2014, year of taxability is year of per future itself. Whenever the per future took place, then it will be taxed in same previous year itself. Okay, so one of the important point, taxability is purely depends on date of per future. If it was perfuted before 1/4/2014, the treatment is different. If it was perfuted on or after 1/4/2014, the treatment is different. Okay, and one more important point, how it will be taxed. Treatment reduced from cost of acquisition. That's the treatment. In the year of transfer of such capital asset, the per future amount shall be deducted from cost of acquisition. Then based on that reduced cost of acquisition, calculate the capital gain. Instead of actual cost of acquisition, actual cost minus per future amount. Balance will be taken as cost of acquisition. If it is a long-term capital asset, first to reduce the per future amount from cost of acquisition, then make the indexation. Okay. So that's the important point. But here the treatment is directly taxable. Directly taxable. That's it. So this is the treatment of section 51, per future of advance money. The treatment is purely based on date of per future, either before 1/4/2014 or first identify the date of per future, either before or on or after. Before, if it was perfuted before, then it will be taxed directly in capital gain chapter, but wait until the transfer of such capital asset. Treatment is deducted from cost of acquisition. If it was perfuted on or after, directly taxable under the head income from other sources. Have you understood? Yeah. One more section relating to capital gain, that is liquidation. Section 46. Liquidation. How to calculate the capital gain in case of liquidation. What is the tax treatment in case of liquidation? So in case of liquidation, company point of view, what is the treatment? Shareholders point of view, what is the treatment? So company point of view, first of all, company point of view, at the time of liquidation, the company is having two options. One is at the time of liquidation, due to settlement of shareholders account, sometimes company directly distributed the assets to the shareholders due to settlement of the shareholders account. Assets directly distributed to the shareholders. This is one of the option. Second option is assets sold in the open market and the sale proceeds will be distributed to the shareholders. This is the second option. Okay. So in liquidation, company is having two options. Assets directly distributed to shareholders. Option 1. Assets directly distributed to shareholders. Assets sold in the open market. And the sale proceeds were distributed to shareholders. Okay. So two companies having two options. In option 1, company not liable to calculate. No capital gain will arise in company points of view in option 1 because it was covered in section 47, exception to transfer. But in second option, the company is liable to calculate capital gain. Mandatorily. That's the treatment of treatment in case of liquidation to the company point of view. Shareholders point of view. Shareholders point of view always liable to calculate capital gain. Shareholders liable to calculate capital gain. Mandatorily. Whatever the option taken by the company, the shareholders always liable to calculate capital gain. No options to the shareholders because the shareholders are surrendered their shares to the company and received the payment from company, whatever the payment made by the company. That will be treated as a transfer, extinguishment of capital asset. Therefore, the shareholders always liable to calculate capital gain at the time of liquidation. No options to the shareholders. But How to calculate the capital gain? Procedure. What is the consideration received for calculating capital gain by the shareholders? Consideration is equal to company, whatever the payment made by the company to shareholders to be considered as a consideration. But here is one thing you should remember. If company paid monetary in nature, then money value to be considered. If company settled, the settlement was made in kind, then fair market value of such asset to be considered. Consideration, if it is money received from company, money value to be considered. If it is asset, then fair market value to be considered. Consideration is very important. Consideration determination is very important in case of liquidation. Okay. Settlement in the form of money, then whatever the amount received to be considered. If settlement in the form of asset, then fair market value of such asset to be considered. Consideration. Aggregate of this amount. Okay. Minus share in reserves of the company. Whatever the share of shareholders in reserves of the company to be deductible from this amount. That is deemed dividend. Deemed dividend under section 222C. Share of company's reserves shall be deductible from the above amount. The balance to be considered as a consideration. Why this amount was deducted here? Because this will be taxable under the head income from other sources. That's why it was deducted while calculating the consideration due to avoidance of double taxation. Taxable under the head income from other sources. Okay. And one of the point here is the above fair market value in case of subsequent sale of this asset by the shareholder to any other person subsequently, then this fair market value to be considered as cost of acquisition for calculating capital gain on subsequent sale. Here the fair market value is 10 lakhs. In future, this asset will be sold to some other party for 12 lakhs rupees. Then this 10 lakhs will be taken as a cost of acquisition. Okay. These are the points relating to liquidation. Company point of view, there are two options, but shareholders point of view, there is no option. Shareholders always liable to calculate capital gain in case of liquidation. But consideration computation is very important in the hands of shareholders. Okay. Next one's exemption from capital gain. Exemption from capital gain. So around 5 sections are there. I'll discuss in simple manner around 3 sections, 54, 54 EC, 54F. Okay. So exemptions. Exemptions. What is the format relating to capital gain? As I was discussed at the beginning, format of capital gain. The last part of the format is exemptions. This is the exemptions covered in section 54 series. How to claim these exemptions? Okay. So 5 exemptions are there, but I will discuss only 3 exemptions, important exemptions. If you want to claim exemption in 54 series, compulsory you need to reinvest the capital gain. The gross capital gain arising on transfer of asset shall be reinvested in a specified asset in the act within the specified time limit. Then only you are eligible for exemption. That's it. So if you want to claim exemption, compulsory you should reinvest the gross capital gain into another asset which was specified in the act, and the investment must be made within the time limit. Okay. So I'll give you a small explanation relating to exemption. The first section of exemption, section 54, it says that on transfer of residential house property, shall be reinvested into another residential house property. Then you can claim exemption under this section. That's it. So the main triggering point to claim exemption under section 54 is asset transfer is residential house property. Reinvestment, investment in another residential house property. Investment is nothing but either purchase or construction of another residential house property within the time limit. Then you can claim exemption under section 54. Have we understood? Transfer of residential house property and the resultant gross capital gain shall be reinvested in another residential house property. Then you can claim exemption under 54. But the time limit is very important. What is the time limit? And what was the amount reinvested in new asset? The gross capital gain. The gross capital gain shall be reinvested in another residential house property within the time limit. What is the time limit? What is the time limit? From the date of transfer. From the date of transfer, the new house must be purchased within 2 years. Purchase 2 years. After the date of transfer. If you want to construct a new house property, the time limit is 3 years. Construction. And one more important point, purchase before the date of transfer but within 1 year is also eligible to claim exemption. What is the time limit for investment in new asset? For purchase within 1 year before the date of transfer, or within 2 years after the date of transfer. For construction within 3 years after the date of transfer. The important point. Have you understood? And one more important point, the new house must be held for 3 years. Otherwise, earlier exemption will be cancelled. So, the new residential house holding period at least 3 years. If it was not held for 3 years, then earlier exemption shall be cancelled and reduced from cost of acquisition for calculating the capital gain on transfer of new house. Have you understood? This is the main points relating to section 54. And one more important point, the time limit is 2 years or 3 years. For purchase 2 years, for construction 3 years. But however, if you have not invested within the due date for filing the return of income, then need to deposit in capital gain account scheme. Based on such deposit, you can claim exemption. Later, the deposit must be withdrawn and utilized within this time limit for the purpose of investment in house property. Okay, so that's the important point. Okay, so next one is 54B. Here the transferred asset is urban agricultural land, and reinvestment shall be made. Investment shall be made in agricultural land, another agricultural land, either in urban or rural. Okay, what was the asset transferred to get the exemption under section 54? The asset transferred must be urban agricultural land. But the asset reinvestment was made in either urban agricultural land or rural agricultural, whatever it is, you can claim exemption. Okay, so what the amount was reinvested in new asset? Here also gross capital gain. Gross capital gain shall be reinvested in another agricultural land, either in urban or rural. What is the time limit? From the date of purchase of, from the date of transfer of urban agricultural land, the reinvestment shall be made within 2 years. Purchase. The new agricultural land must be purchased within 2 years from the date of transfer of urban agricultural land. Okay, so but department says that, government says that if you have not purchased within the due date for filing the return of income, then you want to claim exemption, you need to deposit such amount into capital gain deposit scheme. Later it will be withdrawn and utilized for purchase of agricultural land within 2 years. Deposit in capital gain deposit scheme is very important. If actually not invested within the due date for filing the return of income, then the amount required to be deposited unclaimed exemption. Later it will be withdrawn and utilized for purchase of agricultural land. That's the concept of capital gain account scheme. Okay. Next, 54F. 54F. 54F says that here the asset transferred is any asset other than house property. Any asset other than residential house. Any asset other than residential house property, but reinvestment made in residential house property. Investment in either purchase or construction of residential house property. Then you can claim exemption under section 54F. Have you understood? Okay. And here the one more point will be added in each section. What is the capital gain exemption in this section? 54 exemption. Exemption under section 54 is equal to gross capital gain or investment in new house or 10 crores, whichever is lower. Maximum exemption in 54 cannot exceed 10 crores. Have you understood? So that's one of the important point. Gross capital gain or investment in new house or 10 crores, whichever is lower. Next, what was the exemption in 54B? Here also same. Gross capital gain. Exemption under section 54B. Gross capital gain or investment, whichever is lower. Here no limit of 10 crores applicable here. We can claim more than 10 crores also as exemption in this case. The 10 crores limit is applicable only to 54 and which applicable to 54F also. We'll discuss, just wait. Have you understood? 54B. 54F Act says that transfer of any asset other than house property but reinvestment was made in residential house property. In this case, you are eligible to claim 54F exemption. But the amount required to be invested here is most important, net consideration, not the gross capital gain. That's the unique section 54F when compared to other sections. Here amount required to be invested is net consideration. What is the time limit? Time limit in for new investment is same as 54. That is for purchase 2 years, for construction 3 years. Purchase within 1 year before the date of transfer is also eligible for exemption. Have you understood? But important point, what is the exemption to be claimed here? Here also the new asset must be holding period 3 years. For all sections, the new asset must be held for 3 years except 54 EC. EC point of view, the new asset must be held for 5 years. Okay. Next, here the time limit same as 54 and exemption point is very important. Exemption. Here the amount invested is net consideration. If you invested entire net consideration as exemption. So if your investment is more than or equal to net consideration, then 100% exemption. Fully exempt from tax. And if your investment is less than net consideration, then proportionate exemption is available. And most important amendment and one of the important note is investment cannot exceed 10 crores. If you invested more than 10 crores, first restrict it to 10 crores, then claim exemption of proportionate. That's the important amendment, latest amendment applicable to you. Okay. So while calculating the profit, if your investment is more than or equal to net consideration, then fully exempt from tax, but investment restricted to 10 crores. If you invested 14 crores in new house, then it will be restricted to 10 crores, then claim exemption. So investment cannot exceed 10 crores. First restrict it to 10 crores, then claim exemption. Have you understood? That's the important point. So these are the points relating to exemption 54 series. One more section I want to discuss, 54 EC. Transfer of asset. Land, building or both, immovable property. Reinvestment was made in investment in bonds. Not any bonds. Bonds issued by NHAI, RECL or any other notified person. Specified bonds. If you invested in these specified bonds, then you can claim exemption. Here also amount required to be invested is gross capital gain, like 54 and 54B. The time limit is from the date of transfer of asset within 6 months to be considered. Purchase of bonds must be made within 6 months from the date of purchase of immovable property. The new investment shall be made within 6 months. Okay. And maximum exemption, here also exemption point. Exemption is equal to same formula applicable to 54, gross capital gain or investment in new asset or 50 lakhs, whichever is lower. Here also there is a restriction. Maximum exemption in this section cannot exceed 50 lakhs. That's it. Have you understood? Okay. It's end of the capital gain chapter. There some of the sections are there, but I don't want to discuss because due to time constraint. Okay. So I hope you understood well. I hope all important topics were covered. Okay. Let's begin our discussion with salaries head of income. Okay. Salaries. Section 15 to section 17. This is also one of the important head of income. Actually, this is the first head of income out of 5 heads. Okay. So directly enter into the main concept. This head of income is also a lengthy head of income. Actually, due to time constraint, it will take around 1.5 hours to complete this chapter. Okay. I mainly concentrate on most important areas in this chapter. Okay. First of all, what type of income is taxable under this head of income? Act says that, so there is a relationship of employer and employee between payer and payee, then whatever the benefits provided by the payer to payee shall be taxable under this head of income automatically. Okay. The triggering point for taxability of income under this head of income is the relationship of employer and employee must be in existence between payer and payee. Then the benefits will be taxable in the under the head salary. Okay. So that's the important criteria. Employer, employee. Whatever the benefits provided, either in monetary or non-monetary, taxable under the head salary. in the hands of employee. That is the main point, triggering point for attracting this chapter is the benefits provided by employer to employee, either in monetary or non-monetary. In the course of employment, the benefits will be taxable in the hands of employee under the head salary income. Have you understood? So, and one of the important point here is the relationship of employer and employee must be in existence between paid and payee. Otherwise, the question of salary income does not arise. Okay. So, the employer and employee in between paid and payee, the relationship of employer and employee must be in existence. Otherwise, the question of salary head does not arise. If there is no relationship between employer and employee, between paid and payee, then the benefits may be taxable under the head, either pgbp or other sources. The question of salary head does not arise. Have you understood? The benefit arising in the course of employment are only taxable under the head salary. Otherwise, those benefits will be taxed either in pgbp or other sources. Example, remuneration received by partners from partnership firm. It's a pgbp income. Commission received by LIC agents, it's an other sources. Pension received by family members, it's an other sources. Salary received by MP, MLAs, other sources. Remuneration received by directors, other sources. Because in those cases, there is no relationship of employer and employee between paid and payee. Have you understood? Yeah. Next. Conditions for taxability of income under this head of income. Mainly two conditions for taxability under this head. Condition 1, relationship of employer and employee must be in existence. Between paid and payee. That's the one of the most important condition, and the payment received in the course of employment, the benefits received, the payment or benefit received in the course of employment second condition is also one of the important condition. Not all the benefits provided by the employer to employee are taxable under the head salary. Salary head gets attracted only if those benefits were provided in the course of employment. If it was provided outside the scope of employment, then it will be taxable. It will not be taxable under this head of income. It will be taxable under other heads of income. For example, I am an employee of so and so company. Whatever the benefits received from such company in the course of employment shall be taxable under the head salary. In addition that, I was let out my house to my own employer. I was let out my own house to my employer. Per month rent is 35,000. Every month my employer paid a rent of 35,000 to me. Now tell me, what is the treatment of this 35,000? Yeah, this will not be taxable under this head of income, because even payment made by the employer, because this rental income, this rental payment not in the course of employment. It's an outside the scope of employment. So that the rental income will be taxable under the head income from house property, not taxable under this head. Not all the benefits provided by employer to employee are taxable under the head salary. Only those benefits provided in the course of employment are only taxable under this head of income. Have you understood? Next point is the benefits classified into benefits provided by employer to employee, classified into 5 parts. 5 types of benefits provided by employer. One is basic payments. Allowances, perquisites, welfare contributions, retirement benefits. So these are the benefits provided by employer to employee. All these benefits shall be aggregated. All these benefits shall be aggregated, then we'll get gross salary. Gross salary. After that, reduce deductions under section 16. There are 3 deductions covered in this section. The balance will be treated as a net taxable salary. Okay. So this is the format for computation of salary income. Aggregate of all the benefits provided by employer to employee. Then we'll get gross salary. After that, reduce the deductions under section 16. Then we'll get net salary, on which you are liable to pay tax to the government. Actually, there are 3 deductions covered in section 16. Standard deduction, entertainment allowance, and professional tax. We'll discuss later, just wait. Standard deduction, entertainment allowance, and professional tax. These are the deductions allowable from gross salary under section 16. Okay, so we'll discuss one by one. The first one is basic payments. Basic payments is too simple, because basic payments always be taxable irrespective of employee. It's mandatory taxable payments. There is no exemptions available in this. Okay, so it's too simple. Basic payments includes what type of benefits covered in this heading basic payments? It includes basic salary, arrears of salary, advance salary, also covered in this list. Grade pay, bonus, commission, fee, advance salary, arrears of salary, also covered in this list. Okay, so these are the main points: basic salary, grade pay, bonus, commission, fee. All these type of benefits provided by employer to employee. What is the tax treatment for these benefits? Treatment always taxable, fully taxable, irrespective of employee. Every employee is liable to pay tax on these benefits. Have you understood? So this is too simple. Basic payments part is too easy. The treatment here is always be taxable irrespective of employee. Have you understood? Next we'll go to next topic, allowances. One of the important topic. Please concentrate. The very important topic in salary set. Allowances. Allowances generally allowances in monetary in nature. Always be the allowances in monetary in nature. That's a very important. I give you the details about allowances, differences between allowances and perquisites later, while explaining perquisites. Okay, so just wait till then. Allowances. What is the treatment of allowances? And one of the important allowances always in monetary in nature. Okay, perquisites. What about perquisites? Perquisites may be either in monetary or non-monetary. It purely depends on. Okay, but allowances always be in monetary in nature. That's one of the difference between allowances and perquisites. Okay, but what is the tax treatment of allowances? What is the tax treatment of allowances? That's a very important topic. Allowances are classified into 4 categories. Category 1, Category 2, Category 3, Category 4. Allowances are classified into 4 categories. Category 1, Category 2, Category 3, Category 4. Okay, so what are the differences between how it was classified, why it was classified as categories? Because of tax treatment. The treatment is different for each category of allowances. Have you understood? So allowances are classified into four categories. The first category treatment is fully taxable allowances. Fully taxable allowances. Fully taxable, irrespective of employee. Always be taxable, irrespective of employee. Always taxable, fully taxable, irrespective of default and opt-out tax regime. Default and optional tax regime. Irrespective of tax regime, whatever the allowances covered in category 1 are fully taxable, and irrespective of employee also, whether government or private. Okay, what about category 2? Category 2 allowances exempt to the extent of amount expended for official purpose. Exempt to the extent of amount expended for official purpose. Taxable value is equal to amount received minus amount expended for official purpose. The balance is only taxable. Okay, so if nothing was informed in the problem, then assumed that it was wholly utilized for official purpose, because these allowances were provided during official duties. So that generally the allowances used for official purpose, therefore not taxable. If problem specifically mentioned that some portion of the expenditure not used for official purpose, then such portion of amount will be taxed as it is. Okay, that simply says that exempt to the extent of amount expended for official purpose. The balance is only taxable, if any. If 100% used for official purpose, then fully exempt. If nothing was used for official purpose, then fully taxable. If part of the amount was used for official purpose, then part of the amount is exempt, balance taxable. Whatever the amount used for official purpose is exempt, balance is only taxable. Have you understood? This is the category 2 allowance. What are the allowances covered in category 2? I don't want to write the allowances in a screen, but you should identify here what are the allowances covered in category 1 and category 2. Yeah, this is the allowances chart, which is very important. Category 1 allowances: dearness allowance, city compensatory allowance, domestic servant allowance, telephone allowance, medical allowance, entertainment allowance, overtime allowance, tiffin allowance, warden allowance, night duty allowance, special allowance, etc. Okay, all these allowances are covered in category 1. What is the treatment of category 1? Fully taxable in both default and opt-out. Fully taxable in both default and optional tax regime. That's it. Simple treatment for those allowances covered in category 1. It's fully taxable allowance, irrespective of employee, irrespective of tax regime. But what about category 2 allowances? Category 2 allowances, there are only 6 allowances covered in this category. Conveyance allowance, daily allowance, cost of travel or tour allowance. It simply says the traveling allowance, uniform allowance, helper allowance, academic research allowance. These 6 allowances. What is the treatment of category 2? Exempt to the extent of amount expended for official purpose. This is the treatment for category 2 allowances. What are the allowances covered in category 2? Conveyance, daily allowance, cost of travel or tour allowance. It's nothing but simply traveling allowance. Uniform allowance, helper allowance, academic research allowance. Okay. So only 6 allowances covered in this category. What is the treatment? Exempt to the extent of amount expended for official purpose. If 100% used for official purpose, then fully exempt. If nothing was used for official purpose, then fully taxable. If something used for official purpose to the extent of that amount is exempt, balance is taxable. Exemption is purely depends on utilization for official purpose. Okay. So, but what about default opt-out effect in this category? What about the effect of default in category 1? Category 1 allowances are always taxable, irrespective of tax regime, whether default or optional. But what about category 2? Category 2, first 3 allowances. First 3 allowances, exemption is available only in optional tax regime. Exemption available in both the tax regimes. The default or opt-out. You can claim exemption. You can claim exemption in both the tax regimes for first 3 allowances: conveyance, daily, cost of tour or travel. Have you understood? Exemption is available irrespective of tax regime, whether default or optional. So what about last 3 allowances? These 3 allowances, exemption available only in optional tax regime, is nothing but fully taxable in default tax regime. Okay, exemption available in only optional tax regime. But not available in default tax regime. Is nothing but in default tax regime, last 3 allowances are fully taxable without claiming any exemption. Have you understood? Most important point. Next one. What about category 3? Category 3 allowances. What is the treatment in category 3? Exempt to the extent of amount expended for official purpose. Sorry, exemption specified in the act. Only whatever the amount specified in the act to be claimed as exemption. That is exemption fixed in the act. Please remember those exemption limits. Unclaimed same amount as exemption, balance is taxable. So exempt to the extent of amount specified in the act. Exemption was specified in the act. Only the same amount to be claimed as exemption, the balance is taxable. So many of allowances are there in this list. Around 14-15 allowances. Out of that, important allowances, children education allowance important, hostel allowance important, transport allowance is most important allowance, and the last one, HRA, is most important allowance. These 4 are very important in this category. Okay. So some other allowances are there, but these are the very important allowances. Please keep in touch with these 4 allowances mandatorily. So what is the treatment of allowances given in category 3? Exemption fixed in the act. Here the exemption mentioned. This amount is only eligible for exemption. Balance is taxable. Exemption already fixed in the act. Whatever the amount specified in the act, to be claimed as exemption, irrespective of actual expenditure. Don't consider the actual expenditure. Only the exemption fixed here. This amount to be claimed as exemption, the balance is taxable automatically. That's the treatment. Have you understood? So this is the category 3 treatment. Okay. But what is the effect of default tax regime in this category? So here, third allowance, that is transport allowance. Transport allowance is eligible for exemption in both the tax regime. Transport allowance eligible for exemption in both the tax regimes. Both default and opt-out, except transport allowance. Rest of the allowances, remaining allowances are allowable exemption only in optional tax regime, not eligible in default tax regime, except transport allowance. That's it. Except transport allowance, remaining all allowances eligible for exemption only in optional tax regime. Except transport allowance. Transport allowance is eligible for exemption in both the tax regimes, but except transport allowance, remaining allowances are eligible for exemption only in optional tax regime. Have you understood? Okay, so many of allowances are there in category 3: education allowance, hostel allowance, transport allowance, running allowance, mining allowance, tribal area, hill compensatory. Some of the allowances are exclusively relating to armed forces. Never expect that in your examination point of view. It's an unimportant allowances. Okay, around 6-7 points are there which are very important in examination. Out of that, 4 are very important: education, hostel, transport allowance, and last one is HRA, and one more allowance is also important: running allowance. Okay, I don't want to explain the exemption limits. So these are the exemption limits specified in the act. You should remember these limits and claim it as exemption. Okay, the balance is taxable. Exemption always fixed in the act. Okay, so but default effect in this category is the transport allowance is eligible for exemption in both the tax regimes, whereas other allowances eligible for exemption only in optional tax regime. Have you understood? And fourth category, the treatment of fourth category allowances fully exempt from tax. Always exempt from tax. Fourth category allowance. Fourth category allowances are fully exempt from tax. The first one is fully taxable, last one is fully exempt. Exact opposite to first category. Allowances covered in this category is around 5 allowances. Allowances to High Court, Supreme Court judges, UNO employees related allowances, compensatory allowance by judge, and sanctuary allowance granted to High Court, and last allowances granted to government employees working outside. These allowances are always exempt from tax. But what is the effect of 115 BAC default regime? So here also, first 4 allowances exemption is available in both only optional tax regime, but last allowance is eligible for exemption in only allowed in both the tax regimes. Allowed in exemption in both the tax regimes. Both regimes. That is allowances granted to government employees working outside. Okay, but what about remaining 4 allowances? Exemption allowed in only optional tax regime. The last one is eligible for in both the tax regimes. First 4 allowances exemption to be claimed only in optional tax regime. That is, in default tax regime, those allowances are fully taxable. But last allowance is eligible for exemption in both optional as well as default regime. Have you understood? So please observe carefully what are the allowances to be claimed as exemption in both the tax regimes in entire list of 4 categories. In category 2, there are 3 allowances which are eligible for exemption in both the tax regimes. 3 allowances. In category 4, only 1 allowance is eligible in both the tax regimes. In category 4, category 3, 1 allowance. Category 4, 1 allowance. Category 2, 3 allowances. Category 3, 1 allowance. Category 4, 1 allowance. 3 plus 1 plus 1. Around 5 allowances. 5 allowances are eligible for exemption in both the tax regimes. Except those 5 allowances, remaining allowances always be taxable, irrespective of tax regime. Have you understood? Okay. These are the treatment. This is the treatment of allowances in salaries head of income. Allowances topic is very important. The third category, specifically in third category, the exemption fixed in the act. Please do remember those exemption limits. Okay. Next one. Next topic. Welfare contributions. Welfare contributions. This is also another benefit provided by employer to employee. Welfare. Whose welfare? Employees' welfare. So, for employees' welfare, sometimes the contributions made by the employer as well as employee also. But how it will be treated according to the Income Tax Act? Is it taxable or not? If taxable, what is the amount of taxable value? Okay. So, welfare contributions. Welfare contributions is having only two types of welfare contributions. Welfare contributions. There are two types of welfare contributions involved. This one is Provident Fund, Superannuation Fund. Provident Fund, Superannuation Fund. Provident Fund is very important. Okay. PF calculation is very important. Provident Fund. So, let's start the discussion relating to Provident Fund treatment. What is the treatment of contributions to Provident Fund? Okay. Generally, for Provident Fund, contributions every month, the contributions made by employer as well as employee also. Employer's contribution, employee contribution. So there are two contributions to be made to Provident Fund. Then what is the treatment of those two contributions in the hands of employee? Is it taxable or not? Then what is the tax rate? Okay. So here mainly we should concentrate on 4 areas. So those are, for example, this is the Provident Fund. For this Provident Fund, in each and every month, both the parties contributed certain amount. Employer as well as employee contributed some amount to Provident Fund. Contributed, contribution. Employer's contribution, employee contribution. Both contributions shall be made by both the parties to Provident Fund in each and every month. What is the treatment of those contributions? Okay. So, in both contributions, in every financial year, there will be an interest to be added. What is the treatment of interest added on both the contributions, employer as well as employee? And the last one is, what is the treatment of withdrawal by employee? Receipt. There are 4 topics will be discussed in this. One is, what is the treatment of employer's contribution? What is the treatment of employee's contribution? What is the treatment of interest credited? And what is the treatment of amount withdrawn from Provident Fund by the employee? That is amount received from Provident Fund. All these topics will be discussed. Okay, that's a very important topic, Provident Fund treatment. And one more important point, the Provident Funds are classified into 4 types. 4 types of Provident Funds in India. One is Public Provident Fund, Statutory Provident Fund, recognized provident fund, unrecognized provident fund. We should require to know the treatment of all 4 provident funds relating to all these 4 questions. 4 questions in 4 provident funds. 4 into 4 in total 16 question marks. Have you understood? So, provident fund. There are 4 types of provident funds: statutory, recognized, unrecognized, public provident fund. Statutory is only to government employees. These two are to private employees other than government employees. This is the employees, self-employees, including salaried employees, self and salaried employees. Okay, 4 types of provident funds, 4 question mark. Question number 1, employer contribution. What is the treatment? Question number 2, employees contribution. What is the treatment? Question number 3, interest credited in both contributions. What is the treatment? Question number 4, amount received on retirement, etc. What is the treatment? In provident fund, RPF, URPF, SPF, RPF, PPF. Okay, what is the treatment? So first of all, RPF is a very important in examination point of view. Please do remember RPF related treatment most important when compared to other provident funds. Most important provident fund, RPF. Okay, what is the treatment of employer's contribution to RPF? Employer's contribution to RPF, what is the treatment? Act says that employer's contribution to RPF is taxable in excess of 12% of salary. If employer contributed the amount which is in excess of 12% of salary, then excess amount shall be taxable under the head salary. That's the treatment. Okay. What is the salary to be considered here? Here salary is equal to basic plus DA forming part plus commission percentage on turnover to be considered. That is a specific definition. Okay. So basic salary plus DA forming part plus commission percentage on turnover. Aggregate of all these 3 amounts into 12%. If actual contribution made by the employer exceed that amount, the excess amount shall be taxable. If 12% of your salary is 1 lakh, employer contributed 1,10,000. The 10,000 is taxable under the head salary. Have you understood? What is the treatment of URPF contribution made by employer? Not taxable. Except RPF contribution in remaining provident fund, the question of taxability does not arise. Taxability will arise only in RPF contribution. Employer contribution to RPF is taxable. That too only if contribution exceed 12% of salary. Otherwise not taxable. Rest of the 3 provident funds, employer contribution not taxable. And one more important, there is no employer contribution to PPF. It's purely applicable to general public. Here only one contribution to be made by such person, that is self-contribution. The question of employer contribution does not arise in PPF. Except that remaining 2 provident funds, URPF, PPF, employer contribution is not taxable. Taxability only in RPF, that too if contribution exceeds 12%. Okay. Next, what is the employee contribution? Employee contribution is not an income to the employee because contributed by employee, received by employee himself. There is no benefit from employer. So it's not treated as an income. Therefore, the question of taxability not arise. But however, employee contribution is eligible for deduction under section 80C. Except URPF. Except URPF, in all other 3 provident funds, employee contribution eligible under section 80C. Yes, eligible. URPF not eligible. Eligible, eligible. Okay. Next treatment is interest. What is the accrued interest on both contributions? Interest credited on both contributions. Here also, the taxability will arise only in RPF if rate of interest exceeds 9.5%. If rate does not exceed 9.5%, not taxable. If it exceeds 9.5%, then excess over 9.5% interest will be taxed. Rest of remaining 3 provident funds, the interest is not taxable. Simple treatment. Taxability of interest accrued in provident fund will arise only in RPF. That too if rate of interest exceed 9.5%. In remaining provident funds, the interest accrued is not taxable. Have you understood? And what about fourth point? Amount received from provident fund, that is amount withdrawn from provident fund. What is the treatment of withdrawal from provident fund? In PPF and SPF is fully exempt from tax. PPF and SPF fully exempt from tax. Okay, but what is the treatment of RPF and URPF, withdrawal amount? These two are very important. Okay, so please verify this table very carefully. I give you the details of withdrawal amount from PPF and URPF. Just wait. Okay, what is the treatment of withdrawal from URPF? Withdrawal from URPF. What is the treatment of withdrawal from RPF? These two are very important because for remaining 2 provident funds, it's fully exempt from tax, withdrawal amount. Only taxability will arise in only 2 provident funds, URPF and RPF. Okay, what is the treatment of withdrawal from URPF? Withdrawal from URPF. So what are the amounts was withdrawn from URPF? So actually 4 amounts to be withdrawn from URPF. 4 amounts. One is employer's contribution, interest on employer's contribution, employees contribution, interest on employees contribution. Okay, so what is the treatment for all these 4 withdrawal amounts? Employer contribution, interest on employer contribution, employee contribution, interest on employee contribution. Okay, what is the treatment of withdrawal of all these 4 payments? Employer's contribution, employee contribution, interest on both contributions. What is the tax treatment? Act says that the first 2 payments, employer's contribution, interest on employer's contribution, these 2 amounts shall be taxable under the head salary. In salary head. Okay, because contribution made by employer, received by employee, interest accrued on employer contribution, this will also be treated as provided by employer. Okay, to employee. These 2 amounts shall be taxable under the head salary. And employee contribution not taxable because it's not a benefit. Because it was contributed by employee himself, now received by employee. There is no benefit from employer. Therefore, the question of income does not arise in this, not taxable. Interest accrued on employee contribution taxable under the head income from other sources. Statement of withdrawal from URPF is very important. Have you understood? Next, what about treatment of withdrawal from RPF? Withdrawal from RPF. Withdrawal from RPF. Generally, withdrawal from RPF is exempt from tax in some cases. First one is if employee completed continuous service of 5 years with that employer. 5 years of service completed. Then withdrawal from RPF is exempt from tax. Or withdrawn before expiry of 5 years, before completion of 5 years, due to some specified reasons, that is ill health or discontinuance of employed business, or due to any other reason beyond the control of the employee. In these cases, the withdrawal amount is exempt from tax. Exempt in the following cases. Exempt. First exempted case is withdrawn after completion of 5 years of service. This is one of the case where the withdrawal from RPF is exempt from tax, or withdrawn before completion of 5-year service due to A, ill health, B, discontinuance of the business, C, any reason beyond the control of the employee. Any other reason beyond the control of the employee. In these two cases, the withdrawal amount is exempt from tax, from RPF. If withdrawal amount was not covered in any of these two cases, then it will be taxed. In all other cases, taxable. What is the treatment, tax treatment? If taxable, under which head it will be taxable? The treatment is same as above, that is URPF withdrawal. Treatment is same as URPF withdrawal. Have you understood? This is the treatment for RPF withdrawal. Okay. Next, one more point I want to discuss here is there is a new section added in 3 years back. That's also an important in exam point of view. 17 to 7, 17 to 7A. 17 to 7, 17 to 7A. What is the treatment in 17 to 7, 17 to 7? It's a perquisite. How it will be taxed? Okay, 17 to 7 is nothing but please observe this funds: recognized provident fund, RPF, NPS, notified pension scheme referred to in section 80 CCD, and approved superannuation fund. Okay, so for any of these funds, if employer's contribution to these funds aggregate employed contribution to these funds, if it exceeds 7.5 lakhs, then excess amount shall be taxable as perquisite under section 17 to 7A, 17 to 7. Have you understood? Employer contribution in excess of 7.5 lakhs. For example, employer contribution 10 lakhs. Employer contribution 10 lakhs. In excess of 7.5 lakhs. In excess of 7.5 lakhs is equal to 2.5 lakhs. This amount of 2.5 lakhs is taxable under section 17 to 7. Okay, employer's contribution. Please remember, this section is not applicable to employee's contribution. Only concentrate on employer's contribution in aggregate to any of these following funds: recognized provident fund, NPS, approved superannuation fund. In aggregate, if it exceeds 7.5 lakhs, the excess amount over 7.5 lakhs shall be taxable. under section 17 to 7. Have you understood? And one more section is there, 17 to 7a. 17 to 7a says that the interest accrued on this excess contribution shall be taxable under section 17 to 7a. So interest accrued, interest on such excess contribution is taxable in section under section 17 to 7a. This has two sections. One is excess contribution is taxable under section 17 to 7. Interest on a such excess contribution, interest on such amount which was taxed in section 17 to 7 will be taxed in 17 to 7a. Okay, have you understood? There are two sections which were introduced in 3 years back. I think 2020 or 21. Okay, but it's the two complicated sections. Okay, so what is the formula? If how to calculate the taxable value in these sections? Okay, give you a small formulas, how to apply those formulas also. So first of all, taxable value under section 17 to 7. 17 to 7. Taxable value is equal to employer contribution minus 7.5 lakhs. The balance is taxable. That's it. Too simple. This section is too simple. But what about 17 to 7a? 17 to 7a. Taxable value is equal to, there must be compulsory, this formula is very important and too complicated. So PC divided by 2 into R. PC1 TP1 into R. PC divided by 2 into R plus PC1 plus TP1 into R. Okay, so I will explain what is PC, what is PC1, TP1. PC is nothing but taxable value under section 17 to 7 in current previous year. Taxable value under section 17 to 7 in current previous year. Current previous year. And PC1 is nothing but taxable value under same section in preceding previous years in aggregate. Taxable value under section 17 to 7 in preceding previous years. In aggregate. If any. Okay. TP, taxable value under section 17 to 7a in current previous year. Okay, so TP1, taxable value under section 17 to 7a in preceding previous year. So this is the formula. I don't want to explain much because this is a very complicated area and will take a lot of time to explain this concept with practical problem. Actually, it's a time consuming section and unimportant also in exam point of. It's too difficult. If possible, please prepare at least one problem relating to this concept. Okay. So second section is very important. These sections are exclusively applicable to employer contribution. One is excess contribution made by employer in excess of 7.5 lakhs is taxable in one section. on that excess contribution, whatever the interest added in such fund during the current previous year shall be taxable in another section 17 to 7A. The last one is R is interest rate. R interest rate. Okay. So next we'll go to the next topic. Perquisites. Perquisites are nothing but extra facilities provided by employer to employee in addition to salary, monetary salary. Perquisites may be either in free of cost or at concessional rate. Sometimes employer recovered some amount from employee to provide such benefit. Then such benefit will be treated as a concessional perquisite. If nothing was recovered from employee, that will be treated as a free benefit. Perquisites nothing but extra benefits or facilities provided by employer. Example, car, house, education, health, etc. So many of perquisites are there. Okay, so it's a lengthy topic in salary set. Perquisites nothing but extra facilities provided by the employer to employee, either in monetary or non-monetary. Perquisites may be either in cash or in kind, either free of cost or at concessional rate. Okay, perquisites provided by the employer in the course of official duties, then the question of taxability does not arise. Taxability does not arise if perquisite provided by the employer during the course of employment, that is for official duties. The taxability will arise only if it was provided for personal, either to employee or any of his household, is nothing but family members. If it was provided by employer to employee only for official duties, then the question of taxability does not arise because there is no benefit from employer. There is no personal benefit from employer. Okay, so perquisites. What are the perquisites involved in salary set? Actually, due to time constraint, I don't want to explain much on the more number of perquisites. I'll explain just simple information about perquisites. Okay, so first of all, perquisites are classified into two parts: category 1, category 2. Category 1, there are 4 perquisites. One is domestic servant facility. Next one is gas, water, electricity. Third one is education facility. Fourth one is car. Domestic servant facility, gas, water, electricity, education and car. Okay, these 4 facilities sometimes taxable to specified employees, sometimes taxable to all employees. Please verify it whether it is taxable only to specified or not. The criteria is very important. Either taxable. One more perquisite is there in this list. It's an unimportant perquisite. Please be concentrate on these 4 perquisites. These 4 perquisites are very important. Okay, so either taxable to only to specified employees, or taxable to all employees. Depends on. Please verify it carefully while reading these 4 perquisites. Important. Okay. For example, car facility. If car owner is an employer, then it will be taxable only to specified employees. If car owner is an employee, then it will be taxable to all employees. For domestic servant facility, if servants appointed by the employee, salary paid by employer, then it will be taxable to all employees. If servants provided by employer directly, then taxable only to specified employees. Okay, each perquisite is having separate criteria. For domestic servants, who appointed the servant is very important. For car facility, a car ownership is very important. Gas, water, electricity, connection in whose name is very important. Connection in the hands of employee, but bills paid by employer, then it will be taxed to all employees. If facility provided directly by employer, then taxable only to specified employees. Have you understood? Education. Education provided by employer or arranged by employee outside to be considered. If it was arranged by employee outside, the bills paid are reimbursed by employer, taxable to all employees. If provided in educational institution owned maintained by employer, taxable to only specified employee. Each perquisite is having separate criteria. Please verify carefully. Okay. So all other perquisites, taxable to all employees, both specified as well as non-specified. Okay. So first of all, students must observe this. This information is very useful to you while reading the perquisites. Please verify it carefully. Specified employee. So specified employee concept is important while taxability of perquisites. Mainly in category 1 perquisites. Sometimes taxable to specified employees, sometimes taxable to all employees. Depends on. Okay. This specified employee concept is not useful in category 2 perquisites because category 2 perquisites always be taxable in all cases, irrespective of employee. Who is specified employee? There are 3 conditions provided here. In any one of these conditions were satisfied, then he will be treated as a specified employee. Or any one of these conditions. If employee acting as a director in that company is an employee as well as director in that company, then he shall be treated as a specified employee. Okay. Condition 1. If condition 1 not satisfied, then go to condition 2. Condition 2 says that employee having substantial interest. He is an employee in that organization plus having substantial interest in that organization. In that case also, he shall be treated as a specified employee plus having substantial interest. Employee plus substantial interest. Okay. This condition was also not satisfied. Then go to the third condition. Salary income exceed 50,000 per annum. Then also be treated as specified employee. If any of these 3 conditions were satisfied, then the employee shall be treated as a specified employee. Okay. So first of all, please verify whether the employee is specified or not. Then decide whether the perquisite is taxable or not, mainly in category 1 perquisite. This concept is not useful in category 2 perquisite because category 2 perquisites always be taxable to all employees. Okay. So what is substantial interest? Substantial interest is nothing but more than or equal to. Substantial interest is nothing but more than or equal to 20% voting rights in case of company. In case of others, profit share at any time during the previous year. At least 20%. That is more than or equal to 20% either voting rights or profit share. In case of company, please verify it as more than or equal to 20% voting rights. In case of others, profit share. The percentage is at least 20%. Then the person is called as person having substantial interest. Okay. And one more important point, in last condition, while calculating the 50,000 salary income, some of the amounts are not to be considered. Note number 1. These amounts are not to be considered for calculating the 50,000. Excludes the following. Except these amounts, the remaining amounts shall be aggregated and check whether it exceeds 50,000 or not. Okay. All non-monetary benefits not to be considered. Employer's contribution to RPF not to be considered. Monetary benefits to the extent of exemption not to be considered. Reduce section 16 deductions, all 3 deductions. Exclude these 4 amounts. The balance, if any, if exceed, 50,000, then the employee shall be treated as a specified amount. That's it. Okay. Let's begin our discussion with the topic perquisites. Okay. The first perquisite. First perquisite is most important perquisite, rent-free accommodation. My dear students, don't want to get 100% explanation for each and every perquisite, because perquisites is a too lengthy topic in salary set. Okay, I will explain 2-3 perquisites, then how it will be applied, how it will be taxable. Okay. So because the allocated time in this Mardhan session for salary set is only 1.5 hour or 1 hour 45 minutes. It's practically impossible to explain the perquisites topic. So don't expect much explanation. Okay, I'll explain. I try to explain 3-4 perquisites. Okay, the first perquisite, rent-free accommodation. It's a too lengthy perquisite, and there is an amendment is there. There is an amendment in Finance Act 2023. So first of all, unfurnished accommodation. This is the most important point. Actually, there are 5 points involved in this perquisite. Unfurnished accommodation, point number 2, furnished accommodation, and hotel accommodation, more than one accommodation, exempted cases. Okay, first 2 are very important. Unfurnished accommodation. So unfurnished accommodation. First, identify whether the employee is government or private. If employee is a government employee, then what is the taxable value? Government employee, then the taxable value is fixed by the government itself. Don't bother, the value fixed by the government will be provided in the problem itself. We don't apply any calculations. Okay, so it's too simple. If employee is a government employee, then directly the taxable value will be given in the problem, whatever the value fixed by the government. So second one is other employee. That's the important area. Other than government employee, we should require to calculate the taxable value. How it will be calculated? The first one is, please identify whether the accommodation is owned by the employer or taken on hire by the employer and provided to you. 2 calculations, 2 sub-calculations here. One is, please identify whether the accommodation was owned by the employer. If it was owned by the employer, then taxability is based on population in that area where such accommodation was located. Taxability based on population. So this is the taxable value. If it is a own accommodation, this is the taxable value. Actually, there is an amendment in Finance Act 2023. This is right side part is an amendment, latest amendment in Finance Act 2023. But the amendment with effect from September 1st. Therefore, you need to apply old provision also up to 31st August. Up to 31st August, you can use this calculation. From September 1st, you can use this calculation. Need to apply both the calculations. Up to August 31st, the population limits up to 10 lakhs population. The accommodation was located in an area where the population is less than or equal to 10 lakhs. What is the taxable value? 7.5% of salary is taxable. If population between 10 lakhs to 25 lakhs, 10% of salary is taxable. If population exceeds 25 lakhs, 15% of salary is taxable. From September 1st onwards, the population limits were changed. Percentage is also changed. Okay. So up to August 31st is nothing but first 5 months. You can use the left side calculation. Last 7 months, you can use the right side calculation and aggregate it. Then we'll get the taxable value. Have you understood? So this is the amendment. And the next, this calculation is applicable only if the accommodation was owned by the employer. What about if it was hired by the employer? Hired by the employer is nothing but asset taken on rent by the employer and provided to employee. Then whatever the rent paid by the employer shall be compared with 10% of salary, then whichever is lower to be considered. That is the taxable value. Rent paid by employer or 10% of salary, whichever is lower to be considered. Whichever is lower. But this calculation is with effect from, this is an amendment point. This calculation is with effect from 1st September. But what about up to August 31st? Instead of 10%, you can take 15%. simply says that here also you should apply two calculations. One is up to August 31st, rent paid by employer or 15% of salary, whichever is lower. Thereafter, rent paid by employer or 10% of salary, whichever is lower is taxable. Okay, so this is also an amendment. 10% is an amendment point, amended point, with effect from 1st September. Up to August 31st, you can use 15% instead of 10%. Okay, this is the unfurnished accommodation value. What about furnished accommodation? Furnished accommodation is nothing but whatever the value obtained in unfurnished accommodation, that will be taken into account as this value of unfurnished accommodation. Add furniture value, then we'll get furnished accommodation. First calculate the unfurnished accommodation value, then add furniture value, then we'll get the ultimate answer, that is furnished value. Okay, but while adding the furniture value, please observe whether the furniture was owned by the employer or taken on hire by the employer. If it was owned furniture, then 10% per annum of cost to be considered. 10% per annum. If it was owned, the furniture was owned by the employer. Okay. If it was taken on hire by the employer, then hire charges to be considered as this. That's it. Whatever it is. Okay. So unfurnished value plus furniture, then we'll get furnished value. That's the calculation. And hotel accommodation, more than one accommodation. These are unimportant areas. First two are very important. Okay. And hotel accommodation. Hotel accommodation is generally exempt from tax, subject to satisfaction of the following two conditions. First of all, identify whether it is eligible for exemption or not. If these two conditions were satisfied, then hotel accommodation is exempt. The condition one is the accommodation was provided at the time of transfer of job from one place to another place, and the accommodation period does not exceed 15 days. If these two conditions were satisfied, then exempt from tax. Otherwise taxable. If taxable, what is the taxable value? 24% of salary or hotel bills, whichever is lower is taxable. First to identify whether it is eligible for exemption or not. If eligible for exemption, then no issue. Need not calculate any taxable value. If not eligible for exemption, is nothing but not satisfied the conditions, then you can apply the applicable value. Whatever the calculation applicable, that is 24% of your salary or hotel charges, whichever is lower tax. More than one accommodation. If employer provided more than one accommodation, Act says that first to 90 days, only one accommodation is taxable at the option of the employee. Option given to employee. He can select any one accommodation which is taxable. The other accommodation is eligible for exemption. But after 90 days, if both the accommodations were occupied by the employee, then both the accommodations are taxable. Okay, that's it. I don't want to explain exempted cases. So it's not given in the problem, exempted cases. For example, if accommodation provided by government to Supreme Court, High Court judges, exempt from tax. Parliament officials, exempt from tax. Union ministers, exempt from tax. Opposition party leaders in parliament, exempt. UPSC commission, Union Public Service Commission chairman, member, exempt from tax. And those employees working in some complicated areas, in such case also exemption available. That is, employees working in mining sites, offshore sites, onshore sites, project execution, dam sites, power generation, remote area. If employer provided accommodation to those employees working in these areas, the accommodation is exempt from. Okay, that's it. Next, I don't want to explain the each and every perquisite. It's a time consuming. Okay, I'll explain only 4 perquisites. First one is rent-free accommodation. Second one is domestic servant facility. Domestic servant facility, my dear students, this was covered in category 1. Category 1 perquisites are identify whether these perquisites are taxable only to specified or taxable to all employees. How to identify? But only these 4 perquisites are covered in category 1. For these 4 perquisites, we should identify whether it is taxable only to specified or to all employees. But rest of the perquisites, that is category 2, always be taxable to all employees. Okay. So if Domestic servant is one of the perquisite covered in category 1. How to identify whether it is taxable only to specified or taxable to all employees? I give you. Domestic servants. Please identify the servants were appointed by whom? Appointed. Salary paid or reimbursed by. Taxability. The first case, one of the case, the first case, taxable only to specified employees. Second case, taxable to all employees. How to identify this? The first case is appointed by employer. Servants were appointed by employer and salary also paid by the employer. If servants were engaged by the employer himself, salary also paid by the employer. In this case, the benefit is taxable only to specified employees. That is not taxable to non-specified employees. Only specified employees are liable to pay tax on this perquisite. If servants were appointed by the employer, salary also paid by the employer. Okay. Next one. If servants were engaged by the employee himself, but salary paid or reimbursed by employer. In this case, the perquisite is taxable to all employees, both specified and non-specified. That's the way of identification, whether it is taxable to all employees or taxable to specified employees. Have you understood? What is the taxable value? Taxable value is simple. Whatever the salary paid or reimbursed by employer to servants will be taxed as it is. If employer paid 10,000 per month salary to servants, then 10,000 will be taxable. If employer paid 20,000 per month salary to servants, then 20,000. Whatever the salary paid or reimbursed by employer to be taxable as it is in the hands of employee. Okay. And what about if something recovered from employee for providing such benefit? That will be deducted from taxable value. For example, if employer paid 20,000 per month salary to servants, then the benefit is 20,000. For that, the employer deducted every month salary from the salary of employee 4,000 for providing such facility. Then such amount recovered by employee 4,000 shall be deducted from taxable value. The balance is only taxable. That is, taxable value is the net benefit is 20,000 minus 4,000. The balance is taxable. If nothing was recovered from employee, then entire 20,000 is taxable. If something recovered from employee, then recovered amount shall be deductible from taxable value. The balance is only taxable. Have you understood? This is the note. Amount recovered, if any, from employee shall be deductible from taxable value. Okay, this is the one of the perquisite. Next one is gas, water, electricity. I think it's an unimportant perquisite, but it is easy to prepare. Gas, water, electricity. This perquisite also covered in category 1. So how to identify whether it is taxable only to specified employee or taxable to all employees? Here we should concentrate on connection in whose name and the bills paid by whom. Based on that, you can identify it whether it is taxable to specified or all. Connection is nothing but gas connection, water connection, electricity connection. Connection, bills paid by. Taxability. First one is connection in the hands of employee, bills paid by employer. Then taxability in the hands of all employees, both specified as well as non-specified. Gas connection in the name of employee, but bills paid or reimbursed by employer. Then it will be taxable to all employees, both specified as well as non-specified. What about case 2? If connection in the name of employer, bills also paid by the employer. then it will be taxable to specified employees only, not taxable to non-specified. Have you understood? In domestic servant facility, engaged by whom? Please identify the servants were engaged by whom. But here is connection in whose name is very important. Okay, what is the taxable value? Taxable value here is if the facility, gas, water, electricity facility provided by employer to employee from own sources. Own sources is nothing but the employee working in an electricity generation company. Then the electricity provided by the employer from own sources, because the employer is carrying on the business of generation of electricity. So if it was provided from own sources, is nothing but manufactured and provided to employee. Then whatever the manufacturing cost incurred by the employer shall be taxable as this. What about if it was provided from outside sources? Outside sources is nothing but from purchased from outside sources and provided to employee. Then whatever the cost incurred by the employer for purchase of the facility to be considered as this purchase value. Have you understood? Please identify whether it was manufactured and provided or purchased and provided. If it was manufactured and provided, then manufacturing cost to be considered. If it was purchased and provided, then purchase price to be considered. Okay. So here also the common note point, this note point is common for all perquisites. If any amount recovered from employee shall be deductible from taxable value. Amount recovered from employee shall be deductible from taxable value, if any. Okay, this is the second perquisite. So it's an unimportant perquisite. Okay. My dear students, next perquisite, car perquisite. So car perquisite is a too lengthy perquisite in salary side. I don't want to explain the total perquisite, give you some information about car perquisite. Okay. So car perquisite is also covered in category 1. So please identify whether it is taxable only to specified employee or to all employee. How to identify it? So here the please concentrate on ownership of the car. If car is owned by the employee, then it will be taxable to all employees. If car is owned by the employer, then it will be taxable only to specified employees. Okay. So taxability based on ownership. So car owned by the employee, owned by the employer, then it will be taxable only to specified employees. Owned by employee, taxable to all employees. For domestic servants, please concentrate on the servants were appointed by whom. Based on that, it will be taxable. So for gas, water, electricity, please concentrate on connection in whose name. For car perquisite, please concentrate on owner of the car. Okay. So around car perquisites is having 12 cases. Out of that, 6 cases are not taxable, 6 cases are only taxable. Okay. And of course, this is one of the important perquisite. Okay. Next one. Mobile assets already completed. Interest-free loan. Interest-free loans. And one more important, sweat equity shares and interest-free loans. So I want to explain only these two perquisites in perquisites topic. Okay. So first of all, interest-free loan. Sometimes the employer provided loan facility to the employee. So either at free of cost, free of interest, or at concessional rate also. Okay. Compulsory the employee is required to pay tax on that benefit. Okay. How to ascertain the benefit in case of loan provided by the employer at free of cost or at concessional rate. So this is the taxable value. For example, if employer provided a housing loan to the employee for only at the rate of 4% interest, it's a concessional rate. But how the benefit will be ascertained? So Act says that compare the rate charged by the employer with the rate charged by SBI if same loan had taken from SBI. If you had taken housing loan from SBI, then what would have charged by the SBI? For example, if I had taken loan from SBI, then rate charged by SBI is 10.5%. But here the rate charged by the employer is only 4%. Therefore, the concession given by the employer is 6.5%. Therefore, I am liable to pay tax on 6.5% interest. Okay. For example, loan amount is 10 lakhs. Therefore, taxable value is 10 lakhs into 6.5%. Okay. What is the taxable value? Rate charged by employer, rate charged by SBI as on the first day of the relevant previous year minus rate charged by employer. The difference is taxable into outstanding amount. Into outstanding. That's the perquisite value, interest-free loan. Rate charged by employer shall be compared with rate charged by SBI if same loan had taken from SBI. Okay. So, and one more important observation here, you should concentrate on that which SBI rate to be considered, because the SBI may change the rates in every financial year. But which rate to be considered? Act says that as on the first day of the relevant previous year, the rate charged by SBI as on the first day of the previous year to be considered. In middle of the previous year, the SBI was changed the rates. The changed rate should not be considered for calculating the taxable value. Okay, the first day of the relevant previous year, whatever the rate charged by SBI to be considered for calculating the taxable value. Have you understood? So that's the important point. And the difference between rate charged by SBI minus rate charged by employer into outstanding loan. Okay. What is the treatment if outstanding loan were gradually reduced? Is nothing but nowadays the loans are repayable on monthly basis. Therefore, the outstanding balance will be reduced on month to month. Therefore, how it will be calculated? How to calculate the taxable? Then calculate for each month. First, to ascertain the outstanding balance at the end of the each month and calculate the taxable value for each month separately, and aggregate the taxable value of our 12 months. Then we'll get the answer. Okay. Outstanding balance. Interest shall be calculated on maximum outstanding monthly balance. Maximum outstanding monthly balance is nothing but monthly balance as on the last day of each month. Then calculate the taxable value. Okay, because the outstanding balance will be changed for each and every month. If assessee is repaying the loan on monthly basis. Of course, if there is no repayment during the previous year, then you can apply the entire loan amount into rate. Okay, if loan was repaid either monthly installments or quarterly installments, whatever it is, therefore the interest, the taxable value shall be calculated based on the months or quarters, depends on. Okay. Next one, food and non-alcoholic beverages. My dear students, tea snacks provided by the employer to employee during working hours is fully exempt from tax. Fully exempt. If tea facility or snacks facility provided by employer to you during working hours, including holidays as well as overtime also, okay, is fully exempt from tax. No need to pay any tax to the government. But what about food facility? So what about food and non-alcoholic beverages? My dear students, food facility is also exempt from tax in some cases. The case where the exemption is available is if it was provided in an area where, so that is remote area or offshore installation site. In these two areas, if your employer provided to you a food facility, then you need not pay any tax on such benefit provided by the employer. But what about in any other area it was provided? Then taxability will arise. Okay, so food facility is exempt from tax if it was provided in remote area or offshore installation sites. In all other areas, the food facility is exempt from the, food facility is eligible for exemption up to 50 rupees per meal. The balance is taxable. Partial exemption. Have you understood? And one more important, 50 rupees per meal exemption is available only to optional tax regime, not available in default tax regime. In case of if it was provided through paid vouchers or tokens. So that's the one of the important observation here. If food facility provided through paid vouchers and tokens, then exemption 50 rupees per meal available only in optional tax regime, not available in default tax regime. It's nothing but in default tax regime, it will be taxable fully without claiming any exemption of 50 rupees per meal. Have you understood? So what is the treatment if food facility provided in remote area or offshore installation sites? Fully exempt from tax, irrespective of tax regime. But in all other areas, exemption is restricted to 50 rupees per meal. Simply says that cost to the employed for providing per meal minus 50 rupees. The balance is taxable into number of meals. For example, cost to the employed for providing one meal is 65 rupees minus 50 rupees. The balance 15 rupees is taxable into number of meals. For example, if employed provided 200 meals in a financial year, 15 rupees into 200 meals, 30,000 is the taxable. 3,000 is the taxable value. Have you understood? So that's the concept. There are three deductions available from gross salary. One is the standard deduction, entertainment allowance, professional tax. Standard deduction, my dear students, standard deduction is a mandatory deduction. Every employee is eligible to claim this deduction. It's a mandatory deduction. Claim always 50,000 up to 50,000. If your gross total income exceed 50,000, you can claim 50,000 as the standard deduction. If your gross total income is below 50,000, then claim entire gross salary as deduction. Simply says that gross salary or 50,000, whichever is lower is eligible for deduction. It's a mandatory deduction, compulsory deduction, standard deduction. Okay. And one more important point, these deductions available in both default as well as optional tax. Sorry, these deductions are available. So this is one of the important point. The deductions under section 16 to 16.3 are not available under default tax regime. Available only in optional tax regime. What about 16A? Standard deduction is available in both default as well as optional tax regime. This is an amendment in last year. Standard deduction up to 50,000 available in both default regime as well as optional taxes. But remaining two deductions available only in optional tax regime, not available in default tax. Entertainment allowance, professional. Entertainment allowance, my dear students, entertainment allowance if provided by employer to you, then first of all that amount shall be included in gross salary under the allowances heading. Then eligible for deduction from gross salary only to government employees, not eligible to non-governmental employees. Here governmental employee includes central state government employees only. So entertainment allowance first of all included in income. Then reduce the deductions. That's the one of the important point. Entertainment allowance. For example, my employer provided 10,000 entertainment allowance to me. First of all, that amount of 10,000 shall be first included in gross salary under the heading allowances. Thereafter, eligible for deduction under section 16 subsection 2. But deduction is available only to government employees. But what about other employees? Other employees, entertainment allowance is fully taxable. So, deduction of entertainment allowance available only to government employees, that too least of the following. Maximum limit 5,000, 1/5 of basic salary, actual amount of allowance. Least of the following is eligible for deduction, that too only to government employees. First of all, the amount must be first included in gross salary, then only eligible for deduction only to government employee. Okay, have you understood? So next, professional tax. Professional tax is if paid by employee, then it shall be allowed as deduction directly allowed as deduction under section 16(3). Have you understood? Sometimes the professional tax paid by the employer on behalf of employee. In that case, the professional tax must be first included in gross salary, then only eligible for deduction. Must be recorded in 2 times. First included in salary, gross salary under the heading perquisites, then eligible for deduction under section 16(3). Okay, these are the deductions from gross salary. 3 deductions: standard, entertainment allowance, professional tax. Have you understood? Standard deduction available in both the tax regimes, but entertainment allowance and professional taxes are available only to optional tax regime. And one more important point, entertainment allowance deduction available only to government employees, not to other than government employees. My dear students, let's end off the chapter called salaries, salary income. Okay. My dear students, let's begin our discussion with PGBP head of income. It's very important head. So first of all, PGBP section 28 to 44. First of all, I give you an idea how the PGBP problem will solve. Okay. So in PGBP head of income, actually they have to provide a profit and loss account and some adjustments. They have to provide a profit and loss account. Profit and loss account. It contains a net profit. Profit and loss account. They have to provide a profit and loss account and providing some adjustments, other information. Just like a final accounts problem. Okay. So my dear students, in PGBP head of income, in general, they have to provide either P&L account or income and expenditure account or sometimes cash book also. Okay. I take an example relating to profit and loss account. So provided profit and loss account and some other information. But we are required to solve this problem according to the income tax provisions. The profit contained in this P&L account is not as per Income Tax Act. We are required to revise this profit. Revise. You are required to revise this profit according to the income tax provisions 28 to 44. Apply all the provisions relating to 28 to 44 and revise the existing profit given in the problem. That revised profit will be treated as a PGBP income. The revised profit. Is treated as PGBP. But how to revise the profit? How to revise the profit? That's the procedure for computation of PGBP income. How the net profit given in the problem will be revised. So that's the procedure. I want to provide a procedure for computation of PGBP income. First of all, take the net profit as it is given in the P&L account. Take the net profit as it is given in the P&L account. Net profit. We are required to make some adjustments to this net profit. After that, the resultant amount is the profit according to the Income Tax Act. Okay. So that's the procedure for computation of income. What are the adjustments to be made to existing net profit? Expenses to be disallowed. Expenses to be disallowed, which were already debited in P&L account, but as per Income Tax Act, such expenditure was not allowed as deduction. But now we are required to cancel such expenditure in P&L account and add back to the net profit. Okay, that's the first adjustment to be made to existing net profit. Okay, expenses to be disallowed. That's the first adjustment. Please cancel such incomes which was already created in P&L account. Disallowed incomes, if any, disallowed incomes. For example, in P&L account credit side, profit on sale of asset entry was created in P&L account. But as per Income Tax Act, profit on sale of assets will be covered under the head capital gain chapter, not taxable under the head PGB. But here the transaction was created in P&L, business P&L account. But according to the Income Tax Act, that will be taxable under the head capital gain. Therefore, here it will be cancelled. Disallowed such credited transaction of profit on sale of assets, shifted to capital gain chapter. So whenever the income was disallowed from P&L account, then what is the effect on net profit? The net profit will decrease. Second adjustment. Decrease minus disallowed incomes. Incomes to be disallowed. Have you understood how to calculate the pgbp income? So first take the net profit given in the problem as it is. After that, to that net profit, make some adjustments. Adjustment number 1, identify the expenses which were not allowed as deduction according to the Income Tax Act but debited in P&L account. Identify those expenses and disallowed those expenses and add back to the net profit. And again, go to credit side. Identify the incomes which were not taxable under the head pgbp but created in P&L, business P&L account. Please cancel it and reduce from net profit, disallowed income. And 2 more adjustments are there. Most important, is there any expenditure? Please verify the other information. Is there any expenditure which will be allowed as deduction under the head pgbp according to the Income Tax Act but not debited in above P&L account? That is new expenditure, if any. New expenditure. New expenditure, if any, given in other information but not debited in above P&L account. According to the Income Tax Act, it will be allowed as deduction but not debited in P&L account. Now we are required to debit such amount as new expenditure in P&L account. What is the effect in net profit if new expenditure debit in P&L account? The profit will reduce. So minus expenses to be allowed. That is new expenses, if any, given in other information that should be debited directly in P&L account, and the profit will decrease. If new expenditure was debited, the profit will decrease. And the same, is there any new incomes given in other information but not created in above P&L account? If any, please verify the other information carefully. If any new incomes are there in other information, that should be created directly in P&L account but not debited in the above P&L account. Now we are required to create such amount to P&L account. What is the effect on net profit if new item was created in P&L account? The profit will increase. New income. Okay. Plus incomes to be allowed. New income. The revised profit shall be treated as pgbp. Have you understood? This is the format for computation of pgbp. First, take the net profit as it is given in the problem. To that net profit, we are required to make some adjustments. Adjustment number 1, expenses already debited in P&L account but not allowed according to the Income Tax Act. Please identify it and cancel it. And the profit add back to the net profit. And the next one is identify the credit transactions which were not taxable under the head pgbp but created in P&L account. Identify it and cancel it and reduce it from net profit. So these are the adjustments to be made to existing net profit. Whatever the adjustments made after that, whatever the profit obtained, that will be treated as a profit according to the Income Tax Act. pgbp. That should be taxable under the head pgbp. After making all the above mentioned adjustments, whatever the resultant income will be treated as profit according to the Income Tax Act. Have you understood? For making these adjustments, we should require to know about each and every section involved in pgbp head 28 to 44. If you have complete idea about each and every section, then only you can make these adjustments to the existing net profit. Have you understood? First of all, I give you the information about sections. So section 28 deals with so credit items. For example, let us take an example for profit and loss account. Section 28 in PGBP head deals with what are the amounts which were taxable under the head PGBP. Incomes taxable under the head PGBP deals with section number 28. 28 deals with incomes related section. What are the incomes taxable under the head PGBP according to the Income Tax Act? Section 28. Only one section which deals with incomes which will be taxable under the head PGBP according to the Income Tax Act. Okay, and 30 to 38 deals with allowable expenses under the head PGBP. Expenses related sections. Section 30 to 38. Allowable expenses under the head PGBP. Section 30 to 38. That's the important information. So if you have an idea about sections, then you can understand the provision of relating to PGBP. Okay, so that is what section 28 deals with. What are the incomes which will be taxed under the head PGBP according to the Income Tax Act. Section 30 to 38 deals with expenses which were allowed as deduction under the head PGBP. Have you understood? And the next one is for debiting these expenses under section 30 to 37. For claiming these expenses under section 30 to 38, then need to satisfy some conditions. Conditions for allowability of expenses. Conditions for allowability of expenses. Under section 30 to 38. Condition, most important sections are there. So if those conditions were not satisfied, then such expenditure was not allowed as deduction under section 30 to 38. Okay. Conditions. What are the sections involved in conditions? Lot of sections are there relating to conditions. So section 40. Section 40. Section 40A. Section 43B. So give you some important sections relating to PGBP. The conditions, lot of sections are there relating to conditions. If those conditions were not satisfied, then section 30 to 38 related expenses will not be allowed as deduction under the head PGBP. The above mentioned expenses covered in section 30 to 38 are deductible only subject to satisfaction of the following condition. In 40A, there are two subsections, important subsections, 40A 2, 40A 3. Important sections are there in section 40A, 40A 2, 40A 3. These two sections are very important. One section deals with if any unreasonable payments made to relatives or close associates shall be disallowed as an expenditure. 40A subsection 2 deals with unreasonable payments made to relatives from your business. If any payment made to any person, but the such person is a relative of associate or close associate of associate, then the payment shall not be allowed as a deduction if such payment contains any unreasonable portion. For example, market rate is only 100 rupees, but the payment was made to such person 120 rupees. Payment made to relative, which is the amount of 120 rupees, but the market rate is 100 rupees. Act says that if any payment made to relatives or close associates and such payment contains any unreasonable portion, such excess amount shall be disallowed. 40A subsection 3, this is another condition. It says that cash payment exceed 10,000, then entire amount shall be disallowed. Don't pay the amount if it exceeds 10,000 in cash. It should be paid by way of either account pay check, account pay bank draft, electronic clearing system, any other prescribed electronic mode. If payment was made not specified payment was made in cash, if it exceeds 10,000, then entire amount is disallowed as an expenditure. 48.3. Please go through section 48 to 48.3. These two are very important conditions in pgbp. If violated these conditions, then such expenditure will not be allowed as deduction in P&L account. So these are the very important sections. Okay, next 40, section 40 also having some valuable sections. There are 6 sections are there in section 40, but I give you 2 sections which are important. 40A1, 40A1A. These two are very important. The conditions specified in these sections are TDS and deposit. Okay, please go through these sections. These 2 sections are also very important. TDS related sections. For example, if any expenditure made to outside India, then the payer is required to make TDS from such payment, and such deducted amount shall be deposited into government account. If any of these 2 conditions were not satisfied, then such expenditure will not be allowed as deduction. Have you understood? 40A1 deals with. 40A1A deals with if payment made to residents, then also the same 2 conditions will be satisfied by the payer. Make TDS and deposit the same into government account. Otherwise, such expenditure is not allowed. 30% of such expenditure is not allowed as deduction. That's the difference between 40A1 and 40A1A. In 40A1, 100% of expenditure is allowed. In 40A1A, only 30% is allowed. 40A1, the payments made to outside India are non-resident or foreign company. In 40A1A, the payments made to residents. In both the sections, the conditions are same. The payer is required to make the TDS and the deposit the same into government account. If any of these 2 conditions were not satisfied, then punishment gets attracted. Have you understood? In 40 section, these are the 2 important sections. Okay. Under 43B, there are 6 expenses covered in section 43B. 7 expenses. The 7th expenditure was newly added in Finance Act 2023, MSMED payment. Okay. So, out of 7 expenses, first 6 expenses and the 7th expenditure, MSMED payment. So 43B says that deduction is allowed only on payment basis. Otherwise, no deduction. Deduction will be allowed only on payment basis. Otherwise, no deduction. Actually, we are required to follow either cash basis or accrual basis for pgbp computation. But except 43B. 43B says that those expenses covered in section 43B are allowed always only on payment basis. Here we need not follow the accrual basis for those expenses covered in section 43B. Okay, but the payment shall be made within the time limit. What is the time limit for allowability of expenditure covered in section 43B? For first 6 expenditure, first 6 expenses. Please go through the section 43B and identify the expenses. First 6 expenses. I give you the list. For example, amount payable to the government under any law, taxes, duties, fees, cess, etc. Second, bonus commission payable to employees. Okay. Third one, interest payable to financial institution, banks, including NBFC, including cooperative banks. Fourth one, employer contribution to welfare funds. Fifth one, leave encashment, leave salary. Sixth one, amount payable to Indian Railways for usage of railway assets. These are the first 6 expenses. Last expenditure recently added. This is the amendment. Recently added, payments made to micro small enterprises. Okay. So, what is the due date for payment in first 6 expenses? Due date specified in section 139(1), within the due date for filing the return of income under section 139 subsection. Okay, due date specified in section 139 subsection 1. Nothing but if payment was made within the due date for filing the return of income or actual filing the return of income, whichever is earlier, the payment shall be made within the time limit. Then deduction is available in same previous year in which such expenditure was incurred. The related year, the deduction will be allowed in the related previous year. If payment was not made within the due date specified here, then the payment will be allowed in the year of actual payment, not allowed in the year in which such expenditure was incurred. Okay? The postpone the expenditure to payment to the year in which the payment will be actually made. That's the important content in 43B. Okay. So, and what about seventh expenditure, amount payable to micro small enterprises? Here the due date is due date specified in MSMED Act. So please go through the amendment material uploaded by the masterminds. So I'll give you a clear information about the due date specified in MSMED Act. If payment was made within the due date specified in MSMED Act, then the expenditure shall be allowed in same previous year in which such expenditure was incurred. If payment was not made within the due date specified in MSMED Act, then the payment shall be allowed in the year of actual payment. So that's the difference between first 6 expenses and the 7th expense. Have you understood? These are the valuable conditions in pgbp head of income to claim any expenditure under section 30 to 38. You need to satisfy all these conditions mandatorily. Okay. So if these conditions were not satisfied, then such expenditure will not be allowed as deduction in respective section under section 30 to 38. I'll give you a brief idea about PGBP, how to solve the problem. Okay, how to solve the PGBP income? First, take the net profit as it is given in the problem, make some adjustments to that net profit, then whatever the resultant profit arrive will be taken as PGBP. What are the adjustments to be made to existing net profit? There are 4 adjustments. Please verify the debit items and check whether is there any expenditure which were not allowed as deduction according to the Income Tax Act. Cancel it and add back to the net profit. And identify the incomes which were not taxable under the head PGBP but created in P&L account. Cancel it and adjust the net profit. Identify the new expenses, if any, allowed by Income Tax Act but not debited in P&L account. Claimed as new expenditure. The profit will reduce. Just like that, new income, if any, in other information to be taxable under the head PGBP, credited newly. Therefore, the profit will increase. After these adjustments, whatever the profit arrived will be treated as PGBP. Okay. So, and one more important point, only one section which deals with incomes relating to a PGBP, that is section 28. I don't want to explain about section 28. So, I think it's an unimportant section. And expenses sections are very important, 30 to 38. Okay. So that is section 32, depreciation. My dear students, depreciation procedure is entirely different in Income Tax Act as per Income Tax Act when compared to Companies Act. The depreciation procedure is entirely different according to the Income Tax Act when compared to Companies Act. So the depreciation section is very important in PGBP. It's a too lengthy section. But how to calculate the depreciation? My dear students, first of all, according to the Income Tax Act, how to calculate the depreciation? Act says that here the depreciation to be calculated on, not on individual assets, only on block of assets. Block of assets need to calculate depreciation according to the Income Tax Act only on block of assets. First, to convert the individual assets into blocks. First step to calculate the depreciation is the individual assets shall be converted into blocks. First step, most important, shall be converted into blocks. Okay. For example, if your business is having 100 individual assets, but Act says that, that those 100 assets shall be converted into blocks. If it was converted into blocks, okay, then you may have around 6 to 7 blocks. Then you are liable to calculate depreciation on each block itself. Okay, so first step for calculating the depreciation is assets must be converted into blocks. What is the formula to be followed while converting the individual assets into blocks? Similar nature plus same rate of assets. Are falling under same block. So while converting the assets into blocks, you need to follow this rule. Similar nature and same rate of depreciation. Similar nature and same rate. Okay. So similar nature and same rate. After conversion of blocks, for example, I was converted my individual assets into blocks. There are 3 blocks. So after converting the individual assets into blocks, then each block you have to open a WDV format for each block. For example, there are 3 blocks. Block 1, plant and machinery, 15%. Block 2, furniture, 10%. Block 3, intangible assets, 25%. I was converted my individual assets into blocks. So around 3 blocks are there. After that, what is the next step for calculating the depreciation? Open a WDV format for each block. Open a WDV format. What is the WDV format? Section 43, subsection 6. It says that first take the opening WDV of such blocks. Compulsory, it will be given in the problem. Because last year closing WDV shall be taken as current year opening WDV. Okay. Opening WDV of such block to be considered as it is. Compulsory, it will be given in the problem. Opening WDV. Opening WDV of such block. After that, if there is there any asset purchased during the current previous year relating to such block? If any asset purchased by associate during the current previous, in current previous year, I was purchased a plant and machinery which is a rate of 15%. Therefore, the value of the purchase value of such asset shall be included in the block 1. If I was purchased an intangible asset, then it will be included in the block 3. So additions, if any, during the current previous, additions is nothing but acquisition of assets, cost of acquisition of a new asset shall be added to that block, relevant block. So second point is add cost of addition. That is the next one. And one more important point. And one more adjustment to the block is there any asset was sold during the current previous year? Sold is nothing but terminated from the business due to any reason, either sale, demolish, discard, destruction. Then whatever the amount recovered for termination of such asset shall be reduced from relevant block. Okay. I was sold one of the machine relating to 15% for 5 lakhs rupees. Then the 5 lakhs shall be deducted from block 1. Okay. So money received. Next adjustment is money receivable or received on sale, demolish, discard, destruction of asset, if any, shall be deducted from block value. Have you understood? First to take the opening WDV as it is. After that, made these 2 adjustments, additions if any, during the current previous year shall be added to the relevant block, and termination of asset, if any, then whatever the amount recovered on termination due to sale, demolish, discard, destruction shall be deducted from relevant block. After that, we'll get value on which depreciation to be calculated, that is depreciable value. Depreciable value. This is the value on which you are liable to calculate depreciation. This is the depreciable value on which you are liable to calculate depreciation as per the rate specified in section 32. And one more important point, while claiming depreciation according to the Income Tax Act, need to take the rates only specified in section 32. The list of depreciation rates was given in section 32. Those rates are only to be considered. So, according to the Income Tax Act, depreciation to be calculated as per the procedure given in the Income Tax Act and as per the rates specified in the Income Tax Act. Don't use the Companies Act financial accounting rates. Here always you should require to be take the rates specified in section 32. There is a table in section 32, that is depreciation rates were listed out in that. Please go through the depreciation rates. Okay. So, depreciable value on which you are liable to calculate depreciation. Depreciation. Calculate the depreciation on depreciable value and reduce it. Then we'll get closing WD. Depreciation on depreciable value. Have you understood? So, after reduction of depreciation from depreciable value, then we'll get closing WDV. The closing WDV shall become the opening WDV for next year. Again, next year, cost of additions, if any, shall be added. Sale value, if any, shall be deducted. Again, calculate the depreciable value. Again, calculate the depreciation, and so on. This is the procedure to be followed in each and every year. Okay. Now, the question is, on which value you are liable to calculate depreciation? The answer is depreciable value. Depreciable value, how the depreciable value arises? Opening WDV of block plus additions during the previous year minus money receivable on sale, demolish, discard, destruction. Then we'll get a depreciable value on which you are liable to calculate depreciation as per the rate specified in section 32. After that, we'll get closing WDV. The closing WDV shall become the opening WDV for next year. Have you understood? So, this is the procedure for computation of depreciation. Okay. And one more important information about depreciation. While calculating the depreciation, you will concentrate on, there is a concept of reduced depreciation. Reduced depreciation is nothing but on claiming depreciation on assets falling in opening WDV. Assets in opening WDV. You can apply full rate of depreciation. But the assets in additions is nothing but assets acquired during the current previous year. That is new assets. For new assets, while claiming depreciation, please check whether it was put to use for less than 180 days or not. If it was put to use for less than 180 days, then apply only half rate of depreciation. Okay. While claiming depreciation, you need to concentrate on this area. While claiming depreciation on opening assets in opening WDV. Full depreciation. You can apply total full rate of depreciation for assets in opening WDV. That is old assets. But while claiming depreciation on additions during the current previous year, that is new assets. For new assets, while calculating the depreciation, compulsory you need to apply the concept of 180 days. If it was put to use for less than 180 days, put to use less than 180 days of depreciation. That is 50% of applicable rate. For example, the rate is 15%, then you can apply only 7.5% here because the asset was put to use for less than 180 days. Okay, and put to use for more than 180 days. Okay, then you can apply full depreciation. Have you understood? While claiming depreciation, this is the rule to be followed. Most important, this is very important point. This less than 180 days concept is applicable only to new assets, and that too applicable only to first year itself. From second year onwards, these assets are also eligible for full depreciation because it becomes old asset from second year onwards. Only first year itself you need to apply the concept of less than 180 days. Don't apply the 180 days concept for subsequent years. Have you understood? That's the one of the important point. And one more important point here is, while claiming depreciation, some selected persons are eligible to claim an additional depreciation in addition to normal depreciation. Okay, so for example, manufacturers, power generation companies, these two persons are entitled to claim an additional depreciation in addition to normal depreciation. These persons are eligible to claim an additional depreciation. Eligible to claim additional depreciation. Okay, so additional depreciation in addition to normal depreciation. Okay, normal plus additional depreciation. These persons are entitled to claim an additional benefit. That is, in addition to normal depreciation, they are entitled to claim additional depreciation. What is the rate? And these persons are eligible to claim additional depreciation not on all assets. Additional depreciation is available only on new plant and machinery. Eligible asset. New plant and machinery. Okay, there is a definition of new plant and machinery. Please go through the definition. It's very important. I don't want to explain what is new plant and machinery. New plant and machinery, there are some assets which were excluded from new plant and machinery. Those assets which were not eligible for depreciation, additional depreciation. So new plant and machinery is nothing but the plant and machinery which was involved in manufacturing process. Assets involved in office premises, residential accommodation, guest houses, not at all eligible for deduction, the additional depreciation. Assets on which already, asset which was already used by any other person either within India or outside India, then also not eligible for additional depreciation. And road transport vehicles not at all eligible for additional depreciation. Assets on which already claimed deduction and depreciation earlier, not eligible for additional depreciation. There is a definition of new plant and machinery. Please go and verify clearly. Okay, the rate of depreciation is 20%. At the rate of additional depreciation rate is 20%. And one more important point here also 180 days concept gets attracted. If it was put to use for less than 180 days, then apply 10%. If put to use, then 10%. And the balance 10% will be allowed in immediately succeeding financial year. The balance 10% will be allowed in next year. That's it. So these are the details relating to additional depreciation. Additional depreciation not available to all persons, selected persons only, those who are carrying manufacturing activity or the power generation activity. Okay, and additional depreciation rate is 20%. Concept of 180 days are also applicable here. Have you understood? And one more important information relating to depreciation section. So depreciation to be calculated on block wise, on which you are liable to calculate depreciation, depreciable value. sometimes block becomes closed. Whenever the block becomes closed, then section 32 not applicable. Instead of section 32, section 50 gets attracted. Then you are liable to calculate capital gain. That's the one of the important. Section 32 connected with section 50 in capital gain chapter. Where when the block becomes closed. Then section 50 applied instead of section 32. Have you understood? So whenever block becomes closed, then section 32 or not applicable. Instead of that, section 50 gets attracted. When the block becomes closed, there are two cases. In those cases, block becomes closed. One is if there is no asset in that block as on the last day of the previous year. If there is no value, positive value in that block as on the last day of the previous year, then block becomes closed. Then automatically section 50 gets attracted instead of section 32. Then you are liable to calculate capital gain or capital instead of depreciation. When block becomes closed, for example, I have a block of assets, plant and machinery 15%. Opening WDV. There are 6 machines in that block. 6 machines. The opening WDV is 30 lakhs. Plus, during the current previous year, I was purchased 2 new machines, additions. 2 machines. Value 5 lakhs. Total 35 lakhs. Okay. So minus during the current previous year. During the current previous year, 7 machines were sold. Sale of machines. 7 machines for 30 lakhs. Therefore, remaining value is here. Whether section 32 applied here or section 50 gets attracted. Act says that there are 2 conditions to be satisfied for attracting section 32. If any of those conditions were not satisfied, section 32 not applied, then instead of that, section 50 gets attracted. Condition number 1, at least one asset in that block as on the last day. At least one asset. In that block as on the last day of the previous year. Yes, here this condition was satisfied. Here opening WDV, there are 6 machines. Newly purchased 2 machines, total 8. Out of that, sold only 7 machines. The machines left at the end of the year, 1 machine. Yes, the condition was satisfied. And condition number 2, at least some value in that block as on the last day of the previous year. At least some value in that block as on the last day of the previous year. Yes. Here also, as on the last day, there is a value of 5 lakhs rupees. This second condition was also satisfied. Whenever both the conditions were satisfied, therefore section 32 gets attracted. Then need to calculate depreciation on 5 lakhs. Now the question is, when section 50 gets attracted, if any one of these conditions were not satisfied, then section 50 gets attracted instead of section 32. That's the important. I will change this example. For example, 8 machines were sold. What will be the consequence? Opening WDV, there are 6 machines. Additions, there are 2 machines, total 8. Out of that, entire 8 machines were sold. All 8 machines were sold. Therefore, at the end of the year, there is no machines in that block. Therefore, one of the condition was not satisfied. Second condition was satisfied. Then here section 32 not applicable. Section 50 gets attracted. Whenever any one of these conditions not satisfied, then instead of section 32, need to apply section 50. Have you understood? And one more example. For example, 8 machines were sold. Only 6 machines were sold. The remaining machines in that block is 2 machines. Yes, first condition satisfied. But the sale value is 37 lakhs. What will be the consequence? Yes, here the value of the block becomes nil. It becomes negative. No value in that block as on the last day of the previous year. Therefore, here the second condition was not satisfied. Therefore, here also same. Section 32 not applicable. Section 50 gets attracted. Whenever section 50 gets attracted, then you are required to calculate capital gain. Either resultant capital gain is short term always in section 50. If it is a gain, short term capital gain. If it is a loss, short term capital loss. That's section 32 connected with section number 50 in capital gain chart. Have you understood? And lastly, one more important information, additional depreciation is not available under default tax regime. Additional depreciation not at all eligible to claim under default tax. But normal depreciation will be allowed even in default tax regime. Okay, so let's end of the depreciation section. Next one, section 35. Section 35 is a scientific research expenditure, research related section. The government is continuously want to provide some tax benefits to the persons who are carrying research activities, because it's in the persons who are carrying the research activities are form part of the development of a country. So that's it. The research is a backbone of industrial development. It's useful to the government also. But that the government is continuously trying to provide some tax benefits to the researchers. It's nothing but persons carrying research activity. And section 35 is having two parts. First one is in-house research. Second one is contributions to outside agencies. In-house research, contributions to outside agencies. In-house research is nothing but research activity carried on by the associate himself, which is relating to his business. Every manufacturer is having a lab. In that, he is continuously trying to make a research activities. So that such research activity carried on by the associate in his own labs shall be treated as in-house research. Of course, any expenditure incurred for such in-house research, either revenue, capital expenditure, shall be allowed as deduction at the rate of 100%. That's the important. Any expenditure, other revenue plus capital expenditure. Any expenditure incurred, either revenue, capital expenditure, shall be allowed as deduction at the rate of 100%. Deduction at the rate of 100%. Okay, this is also a lengthy section. I don't want to explain 100%. So just I'll explain a brief information about section 35. Okay, any expenditure incurred for in-house research, either revenue expenditure, capital expenditure, will be allowed as deduction at the rate of 100%. In which year the deduction is available? Act says that if expenditure was incurred before commencement of the business, then the deduction will be allowed in the year of commencement of the business. But it must be incurred within 3 years before the date of commencement of the operations. What about if expenditure was incurred after the date of commencement of the business? Will be allowed in same previous year in which such expenditure was incurred. Have you understood? So deduction percentage is 100%, both revenue as well as capital expenditure. And what is the year of deduction? Year of deduction. expenses incurred within 3 years. Within 3 years. Preceding the date of commencement of operations. Then year of deduction is in the year in which such expenditure was incurred. Sorry, in the year in which the business was commenced. Year of commencement of the business. Okay. B. Expenses incurred after the date of commencement of the business. Operation. Then year in which such expenditure was incurred. Year of such expenditure. That's the year of deduction. Anyway, category 1, in-house research. Eligible for deduction both revenue as well as capital expenditure. 100% at the rate of 100%. And what is the year of deduction is very important. Okay. Category 2, contributions. Contributions to certain persons. There are 4 points involved in contribution. Research organizations, Indian company carrying research activities, so and national laboratories, Indian Institute of Technology. So all these activities, so if you contributed any amount, contribution is nothing but donated any amount to research organizations. The organization may be research association or company or national laboratory, Indian Institute of Technology, etc. Here also your contribution is eligible for deduction at the rate of 100%. 100% of contribution is eligible for deduction. Have you understood? And one more important point, contributions not eligible for deduction in default taxes, available only in optional taxes, whereas in-house research is eligible in both default as well as optional taxes. That's the important observation. Okay, so please go through the section 35. It's a lengthy section. I don't want to explain 100% of section. This is the basic view of this section. This section contains 2 parts: in-house research, contribution. In-house research is nothing but research activity carried on by the associate himself for his own business or profession. Contributions is nothing but amount donated to outside agencies who are carrying research activities. Okay, next, section 35 AD. Section 35 AD. In this section, around 14 businesses were covered. Those businesses covered in section 35 AD were called as specified businesses. Specified businesses covered in section 35 AD. Specified businesses. Covered in section 35 AD, 14 businesses. I don't want to list out that businesses, the time consuming. Okay, 14 businesses. What is the tax benefit provided to these businesses? Similar to section 35. Here also, capital expenditure incurred for these businesses shall be allowed as deduction at the rate of 100%. Amount of deduction. Capital expenditure shall be allowed as a deduction at the rate of 100%, except that some assets are not eligible to claim deduction, except land, goodwill, financial assets. Except these 3 assets, remaining all capital assets are eligible to claim deduction at the rate of 100%. This is the main view of section 35 AD. And one more important point, 35 AD is an optional section. That's the most important point. 35 AD is the optional section. 35 AD is an optional section. Okay, so because reason being, if you want to claim deduction under section 35 AD, then you are not entitled to claim 10 EAA benefit. 10 EAA and chapter 6A heading C deductions are not available to those SSCs who want to claim deduction under section 35 AD. If you want to claim those benefits, then 35 AD is not available. That's why please opt whether you want to claim 35 AD or not. Please verify whether which is beneficial to you. 35 AD is beneficial or chapter 6 heading C and 10 EAA is beneficial. So if those sections are beneficial to you, then don't opt section 35 AD. Okay, if section 35 AD itself is beneficial to you, then opt section 35 AD, then those sections are not eligible to claim deduction. Okay, so 35 AD is an optional section. If you want to claim deduction under this section, then you are not eligible to claim certain areas, certain deductions, that is 10 EAA, chapter 6 heading C. Have you understood? Important point. And one more important point, 35 AD deduction is not available under default tax ratio. 35 AD not available under default ratio. $35 AD is not at all eligible to claim deduction under this section under default tax, available only in optional taxes. And one more important note point is, if any loss arises in 35 AD business, then it can be set off against the profit of another specified business only. Loss from specified business can be set off only from specified business. Okay, that is, specified business loss cannot be set off against non-specified business. It will be discussed in set off and carry forward chapter. Wait. Okay, so these are the main topics, main points relating to section 35. And there are a lot of conditions are there relating to section 35. Please go and verify the conditions. So many of conditions are there. Books of accounts must be audited, and then plant and machinery must be new plant and machinery. So there are a lot of conditions are there in this section, but I don't want to explain the condition. I explain only main point. Okay, 35 AD is not a mandatory section, it's an optional section. Okay, so either 35 AD or chapter 6 heading C, you can claim any one of these. Both are exclusive. That's the important. Okay, next. Next one, section 35D, section 35 DDA. Section 35 DDA. 35D is amortization of preliminary expenditure. Amortization of VRS compensation. Okay, so these two sections, in these two sections, the treatment is same. In both the sections, the deduction is available for 5 equal installments. Deduction available for 5 equal installments. Okay, in both the sections, 35D, 35 DDA, deduction is available for 5 equal installments. But in 35 DDA, the deduction begins from the year of payment. Okay, so in the year of payment. But here 35D, the deduction is available from the year in which the commencement of the business or completion of extension. So the year of deduction is something different between these two sections. In 35 DDA, deduction is available always cash basis. Whenever the payment was made, then only deduction is available. Okay, so 35 DDA, the deduction begins from the year in which the VRS compensation was actually paid to the employee. the deduction will start from there for 5 equal installments. But in 35D, preliminary expenditure will be allowed as deduction. Of course, here also deduction is available for 5 installments from the year of commencement of the business. If it was incurred for commencement of a new business, then new business was started from the year in which the new business was started. If the preliminary expenditure was incurred for extension of existing business, then the deduction will start from where the extension was completed. If preliminary expenditure was incurred for setting up of new unit, then the deduction will start from where the new unit commences its operations. The year of deduction is something different in 35 AD. Please go and verify the point. Very important. Otherwise, in these two sections, the treatment is same. The expenditure shall be allowed as deduction for 5 equal installments. Have you understood? Yeah. Next section, section 36, subsection 1. Some other expenses shall be allowed as deduction under this section. Some of the expenses were covered in this section. Okay. I don't want to explain the completely because this is the lengthy section. It includes so many number of expenses. Okay, around next bonus commission payable to employees allowed as deduction, but subject to 43B. 43B says that allowed only on payment basis within the due date for filing the return of income. Otherwise, not allowed as deduction in that previous year, but will be allowed in the year of actual payment. Okay. Next one, interest on borrowed money. If assessee has taken any loan from any banks or financial institution or from any other person for the purpose of his business, then the interest is eligible for deduction under section 36, subsection 1. It's the most popular expenditure. Okay. Next one, discount on zero coupon bonds. So if assessee has issued any zero coupon bonds, then the discount provided to investors for issue of such zero coupon bonds, the discount will be treated as loss to the issuer. Therefore, the issuer is entitled to claim such loss of discount as deduction in its books of accounts. Okay. So next one is welfare contributions. This is one of the popular and important expenditure covered in section 36. I will explain some extent of this point. It's the most popular point. Welfare contribution. Whose welfare? Employees' welfare. Generally, the welfare contributions are two types. One is employee contribution, employer contribution. What is the treatment under the head pgbp? Okay. So, first of all, welfare contribution allowed under section 36, subsection 1. Welfare contribution. Welfare contributions are classified into two parts, two types: employer contribution, employee contribution. Okay. So what is the treatment of employer contribution under the head pgbp? Act says that employer contribution will be allowed as deduction directly as pgbp expenditure, but subject to 43B. That's it. Allowed as deduction. Allowed as deduction, but subject to 43B. (43B) says that if contribution was actually made, actually paid in that respective fund account, then only deduction is available. Deduction is available only on payment basis. Okay. So that's one of the important. 40 need to follow the conditions specified in section 43B. Okay. 43B says that deduction will be allowed only if the amount was deposited into respective fund account within the due date for filing the return of income. Okay. Otherwise, no deduction. So need to follow section 43B for employer contribution. Of course, allowed as deduction under the head pgbp under section 36, subsection 1, subject to 43. That's the condition to be followed. But what about employee contribution? Generally, employee contribution is deducted from salary of the employee by the employer and deposit the same into respective fund account by the employer. So just the employer is acting as a mediating point for employee contribution, collected from employee and deposited into respective fund account. Okay, then what will be the consequence? Act says that employee contribution whenever deducted from salary of the employee by the employer, then the employer is required to include such amount in his business income. Okay, first included in the income of the employer. First included in the income of the employer. Whenever the amount was deducted from salary of the employee, then that should be included in the income of the employer as it is. Okay. And what about deposit? What about deduction? Deduction is available only to the extent of amount deposited into respective fund account within the due date specified in relevant act. So then eligible for deduction only to the extent of amount deposited into respective fund account within the due date specified in relevant act. Here need not follow section 43B. So here the due date specified in the relevant act. Then whenever the amount was deposited within the due date specified in relevant act, then only deduction is available. Otherwise, no deduction. That's the treatment of employees' contribution. That's the complicated and important point also. So employer contribution, you can claim deduction directly as expenditure, need not included in the income. Directly allowed as deduction subject to 43B. But whereas employee contribution shall be first included in income side, then eligible for deduction only to the extent of amount deposited in within the due date specified in relevant act. Okay, have you understood? One more asset covered in this family planning expenditure. Family planning expenditure allowed as deduction if assessee incurred any expenditure for promoting family planning purpose. Either capital expenditure or revenue expenditure, both will be allowed as deduction. But here one thing you should remember is this deduction of family planning expenditure is available only to company assessees, only to company, not eligible to other person. Okay, that's the important point. And what is the amount of deduction? Yes, deduction is available both revenue as well as capital, but capital expenditure will be allowed for 5 equal installments. Don't claim entire amount as deduction in first year itself. Revenue expenditure will be allowed as it is in the year in which such expenditure was incurred, 100%. Okay, capital will be allowed only for 5 equal installments. Revenue will be allowed as it is in the year in which such expenditure was incurred. That's the treatment of family plan. And the last 2 expenditure is STT, CTT. I give you simple information, STT and CTT, both are allowed as deduction, subject to a condition, the income from such transaction will be taxed under the head pgbp. Whenever the income will be taxed under the head pgbp, then the concerned STT and CTT will be allowed as deduction. Okay, otherwise no, not eligible. Okay, this is section 36. Next, 37. My dear students, 37 is the residuary section. residuary section 37. 37 says that whatever the expenses not covered in section 30 to 36, whatever the expenses were not covered in section 30 to 36, then it will be allowed as deduction. Then 37. Whatever the business expenses were not covered in section 30 to 36 are automatically deductible in section 37. That's why 37 is a residuary section. It includes all expenses, those not covered under section 30 to 36, subject to some conditions. If you want to claim any expenditure under this section, you need to satisfy certain conditions. Okay, what are those conditions? 37. So any expenditure other than specified in section 30 to 36 shall be allowed as deduction on satisfaction of the following conditions. These are the conditions. The expenditure should not be covered in 30 to 36, not being a must have been incurred after the business setup. If it was incurred before commencement of business, not at all eligible under this section. If it was incurred before commencement, then it will be a preliminary expenditure. That to be allowed as deduction in another section, 35D is there for preliminary expenditure. That's why 37 is not applicable for that. Okay. Next one, not being a capital expenditure. Not being a capital expenditure. If it is a capital expenditure, section 32 gets attracted. Need to claim depreciation. That's why 37 does not attracted in that. Not being a personal expenditure. Personal expenditure not at all eligible for deduction. Okay. Next, incurred during the current previous year and exclusively for the purpose of business, expended wholly and exclusively for the purpose of business. It was not prohibited by any law. Example, penalties. Penalties are not at all eligible for deduction. It was not prohibited by any law. Have been incurred by expenditure for any purpose which is an offense or is prohibited by law. So these are the conditions to be satisfied for allowability of any expenditure under this section. Now the question is, 37 is having two explanations. One more explanation is there, explanation 3. So, but two are most popular explanations. Explanation 1, penalties. My dear students, penalties are generally not allowed as deduction because the payment was made due to violation of law, imprisonment or infraction of law. So that's the violation of law made by the assessee. So how the department will allow as deduction of this expenditure? So penalties, fines and penalties are not at all eligible for deduction. But however, here one thing you should remember, the penalty in the nature of compensatory will be allowed as deduction. So however, the penalty, this is very important point. Penalty in the nature of compensation is allowed as deduction. Compensatory nature penalties. Compensatory nature penalties. Transaction doesn't involve any violation of law, then that should be treated as a compensatory nature penalty. Therefore, that should be allowed as deduction. Okay. So it involved any violation of law, then it should be treated as penalty in the nature of violation of law will not be allowed as deduction. That is simply says that infringement of law is not at all eligible for deduction. Infringement of a contract will be allowed as deduction. Infringement of a contract is treated as compensatory in nature. It doesn't involve any violation of law. So therefore, penalties are classified into two types: violation of law and it doesn't involve any violation of law. That is infringement of contract, infringement of law. So penalty in the nature of compensation, that is compensatory nature penalties are allowed as deduction. These penalties are just like interest or late payments of taxes, that is interest on arrears of sales tax, interest on arrears of GST, interest for delay of contracts. All these penalties are allowed as deduction because these are compensatory in nature, because it doesn't involve any violation of law. Okay, so delayed payments and demurrage charges, waiting charges are also treated as penalty in the nature of compensation. All these types of penalties will be allowed as deduction because it doesn't involve any violation. Okay, next, CSR expenses. My dear students, as per Companies Act 135 of the Companies Act, every company having a net worth of 500 crores or having a turnover of 1000 crores or having a net profit of 5 crores, that is biggest companies, on satisfaction of any of these conditions, the company is required to expend certain amount of their profits to social welfare activities as CSR expenses. So that's the Companies Act 135 requirement. If every company on satisfaction of any of these following conditions is required to expend certain amount. How much amount is required to be expended for CSR activities? At least 2% of the average profits of the preceding 3 years must be incurred for social welfare activities. This is the requirement under section 135 of the Companies Act. Now the question is, what is the treatment of such CSR expenses in P&L, PGBP head of income? Is it allowed as deduction under the head PGBP or not? So that explanation 2 says that CSR expenses not at all eligible for deduction under the head PGBP. CSR expenses not at all eligible for deduction under the head PGBP. Not deductible. Not deductible under this section. But any CSR type of expenses were covered in 30 to 36 will be allowed as deduction, no objection. No CSR expenses will be deductible under section 37. But any expenses which is relating to CSR activities which were already covered in preceding sections 30 to 36 shall be deductible, no objection. Example, contributions to research activities. It's also a one type of CSR activity. That should be allowed as deduction under section 35, no objection. So the final conclusion is no CSR expenses shall be allowed under this section. Okay. And one more important point, contribution to Swachh Bharat Kosh, contribution to Clean Ganga Fund. These two are also CSR activities. But these two contributions were covered in Chapter 6A ETG deduction. But Act says that you don't claim both the benefits on these contributions. Contributions to Swachh Bharat Kosh, contributions to Clean Ganga Fund. If you want to claim these donations as deduction under Section 80G, then such expenses, such contributions will not be treated as a CSR activities. If these contributions, contribution to Swachh Bharat Kosh, contribution to Clean Ganga Fund, if these contributions was not treated as a CSR activities, then only eligible for deduction under Section 80G. 80G and CSR are mutually exclusive. These contributions are eligible for only one benefit, either as CSR activities or as Chapter 6A deduction. At your option. You can claim it as deduction under Section 80G, then these two contributions shall not be treated as CSR activity. Okay, have you understood? If these contributions were treated as CSR activities, then these contributions shall not be eligible under Section 80G. Okay, dual benefits not available. That's the information related to Section 37. 40B. So 40B is exclusive section applicable to partnership firm, not to other businesses. Okay, Section 40B. Partnership firm. Firm related section. This section deals with. So what is the treatment of interest remuneration payable by partnership firm to partners? Is it allowed as deduction to partnership firm or not? That's the important part. Interest, partnership firm, partners. Interest and remuneration. interest and remuneration payable by partnership firm to partners. No doubt it's an expenditure to partnership firm. But is it allowed as deduction to partnership firm or not? So these two amounts, interest and remuneration payable by partnership firm to partners, will be allowed as deduction to partnership firm. Allowed as deduction to partnership firm, subject to some conditions. Subject to some conditions and limits. Okay, what are those conditions and limits? This is the main content in section 40B. 40B deals with interest remuneration payable by partnership firm to partners. Is it allowed as deduction to partnership firm? If allowed, what are the conditions to be satisfied? Conditions as well as limits. So conditions, I'll explain orderly. One of the condition is compulsory the partnership deed specified for payment of these amounts. Deed should be authorized for payment of these payments, interest and remuneration to partners, authorized by the partnership, and the payment also made in accordance with the partnership. That's the one of the condition. That is, if not specified in the partnership deed, but payment made by the firm to partners, then such expenditure will not be allowed as deduction to partnership firm. Simply disallowed. The one of the condition for allowability of these expenses is it should be authorized by the partnership deed and in accordance with the partnership deed. Okay, and if it is a remuneration, the remuneration must be payable only to working partners. If it was paid to non-working partners, will not be allowed as it. So there are a lot of conditions are there. Please go and verify the conditions. I don't want to explain the conditions, but I want to explain only the limits specified in section 40B, maximum limits. Okay, so what is the limit? Conditions as well as limits also. Okay, so what is the limit for interest? Limit. Maximum interest limit 12%. Simple interest. It simply says that actual payment of interest are 12%. Whichever is lower is eligible for deduction. This is the maximum limit up to 12%. Okay. If partnership firm paid 10% interest to the partners, then entire 10% will be allowed as deduction. If partnership firm paid 13% interest, then deduction is available up to 12%. 1% disallowed. Subject to conditions. It should be authorized by the partnership deed. Okay. Next, what is the limit for remuneration? The limit for remuneration is too complicated and important also. The limit for remuneration is based on book profit. First, calculate the book profit. Calculate the book profit. If book profit is less than or equal to 3 lakhs, if book profit is less than or equal to 3 lakhs, this is book profit is less than or equal to 3 lakhs, the calculation is maximum limit is equal to 90% of book profit or 1.5 lakhs, whichever is higher. This is the limit. Have you understood? If book profit is more than 3 lakhs, then first 3 lakhs, 90% or 1.5 lakhs, whichever is higher. Balance book profit into 60%. This is the limit. Have you understood? For example, book profit is 5 lakhs. First 3 lakhs, 90% of 3 lakhs are 1.5, whichever is higher. Balance 2 lakhs into 60%. Aggregate of this amount. This is the limit. Maximum limited. The partnership firm cannot pay the amount beyond the limits specified in the act. If it was paid, then deduction is available only up to these limits specified here. Okay. So book profit. But what about in case of book loss? In case of book loss, the limit is 1,50,000. Okay. In case of book profit, then calculate like this. In case of book loss, maximum limit is 1,50,000. This is the partnership form related, section 40B related information. 40B is exclusively applicable to interest and remuneration payable by partnership firm to partners. Okay. And one more important point, this section is not applicable to interest payable to outsiders other than partners. So 40B limits and conditions not to be applied where the interest and remuneration payable to outsiders. For example, interest on bank loan, in remuneration to employees, outside employees. Then no need to follow the conditions and limits specified in section 40B. Okay, that's an important point. And one more important point, this section is applicable only to interest and remuneration to partners, not to any other payment made to partners. Okay, example, rent to partners, not subject to 40B. 40B includes, 40B is exclusively applicable only to two expenses, interest, remuneration to partners. This section is not applicable to these payments made to outsiders and any other payment made to partners. That's the important observation, my dear students. This is very important. There is some exclusive problems relating to this section. Please go through those problems, and I think it's an important section, exam point of view. Okay, and what is the treatment in the hands of partners? For partnership firm, these payments are treated as an expenditure. But what about partners? Partners' viewpoint, these payments are treated as income. But is it taxable to partners or not? Partners' point of view. Partners' point of view, these payments shall be treated as income. What is the treatment? Is it taxable in the hands of partners or not? Taxable only to the extent of amount allowed as deduction to partnership firm. Whatever the amount allowed as deduction to partnership firm as expenditure, the same amount will be taxable to partners. If it was not allowed as deduction to partnership firm, then not taxable to partners. So taxability in the hands of partners is purely depends upon allowability as deduction to partnership. Have you understood? So that's an important point. If it was allowed as deduction to partnership firm, then treated as income to partners and taxable in the hands of partners. If it was allowed as not deduction to partners, not allowed as deduction to partnership firm, then not treated as income to partners, hence not taxable. Have you understood? That's the end of the explanation relating to section 40B. Okay. Conditions for allowability of expenses. For allowability of expenses. Under section 32, 37. Okay. So give you some of the some of the conditions which are very important while calculating the income from pgbp head office. So if you want to claim any expenditure under section 32, 37, you need to satisfy certain conditions. So one of the condition is 40A1. This section says that, so if any payment made to outside India or foreign company or non-resident, so payment made to, any payment made to outside India, non-resident, foreign company. Okay, so if any payment made to any of these persons, either person located outside India or to a non-resident or foreign company, then the payer is required to satisfy the following conditions. Okay, payer is required to satisfy the following conditions. That is, one of the condition is make the TDS from such payment within the previous year. TDS shall be made from such payment by the payer within the previous year, and the TDS amount shall be deposited. TDS amount shall be deposited into government account. Within the due date for filing the return of income. Under section 139 subsection. Okay, have you understood? If any payment made to non-residents or foreign company or outside India, then the payer is required to satisfy the following two conditions. If any of these conditions were not satisfied, in case of violation of the above conditions, any one of these two conditions, if not satisfied by the payer, then in case of violation, %100% of such expenditure shall be disallowed. Shall be disallowed. %100% of such expenditure shall be disallowed. Have you understood? But however, the disallowed payment shall be allowed in the year of actual payment. Whenever the payment was actually made, then to be claimed as reduction in such previous year. But such disallowed amount shall be allowed in the year of payment. Okay, that's section 40A subsection 40A1. Have you understood? Payer is required to satisfy any these two conditions mandatorily. Otherwise, 100% of such expenditure shall be disallowed for relevant to previous year. That will be allowed in the year of actual payment. Okay, 40A subsection 1A. 40A 1A. 40A 1A, similar presentation, but here instead of any payments, you should use the word any payment. Any payment made to residents This is the difference between 40A1 and 40A1. In 40A1, the payments made to outside India, non-residents or foreign company. But here the payment made to residents. Here also the payer is required to satisfy the same two conditions. Whatever the conditions applicable in 40A1, as it is applicable in 40A1A also. Here also the payer is required to satisfy the following condition. Same condition. Payer should satisfy these two conditions, whatever applicable to 40A1 or as it is applicable to 40A1. In case of violation, of conditions, 30% disallowed. 30% of such expenditure shall be disallowed, but the same will be allowed in the year of actual payment. Remaining sentence as this. That's the difference between 40A1 and 40A1A. Have you understood? Here 100% disallowed, here 30% only disallowed. Balance 70% will be allowed as deduction in same previous year. Only disallowed 30% portion, that 30% disallowed amount shall be allowed in the year of actual payment. Okay, these are the difference between 40A1 and 40A1. So one more section I want to explain in this 40A5. Tax on non-monetary perquisites. Paid by employer on behalf of employee. Okay, tax on non-monetary perquisites paid by employer on behalf of employee. So this amount, employer point of view, it's an expenditure to the employer. Expenditure to the employer, but Act says that this expenditure is not at all eligible for deduction under the head pgbp. It's a disallowed expenditure, not allowed as deduction. Under the head pgbp. In the hands of employer. That's it. This is 40A5. Okay. Of course, such tax will be treated as an expenditure to the employer, but according to the Income Tax Act, such expenditure will not be allowed as deduction. Not allowed as deduction. If it was already debited in P&L account, then please disallow it and add back to the net profit. Have you understood? Next. 40A subsection 2. This is another condition. 40A subsection. It says that if from your business or profession, if any payment made to relatives or close associates, then if such payment contains any unreasonable portion or excess portion, then to the extent of such excess amount shall be disallowed. Okay, so any payment made to relatives or close associates, there is a definition of relative and close associate. Please go through section 40A subsection. Okay, so these two are having different definitions. Okay, actually time is not sufficient to explain the definitions here. Okay, so any payment made to relatives or close associates, any payments made to relatives, close associates, and such payment contains any excess or unreasonable amount based on the comparison with fair market value. The fair market value is 25,000, but here actually payment was 32,000. Yes, the payment contains an excess amount of 7,000. So such payment contains any excess or unreasonable payment, then such excess amount shall be disallowed. Such excess amount, unreasonable amount, shall be disallowed. That's it. This section is applicable to all payments, those made to relatives or close associates. And I give you some important information. This section not applicable to outside payments made to other than relatives, close associates. Even in such payment contains any unreasonable portion shall be allowed as deduction. No objection, because 48(2) does not attract it. 48(2) does not attract it to those payments made to other than relatives and close associates. And 48(2) applicable only to allowable expenses under section 30 to 37. Therefore, disallowed expenses are not subject to 48(2). The note point. Disallowed expenses are not subject to 48 subsection. That is, this section is available, this section is applicable, 48(2) is applicable only to allowable expenses under section 30 to 37. Any payment made to relatives which is allowable expenditure under section 30 to 37. Okay. So whatever the expenditure, if you want to claim your business P&L account, then such payment must be subject to 48(2). Okay. Already disallowed expenses, if any, no need to follow section 48(2) because it was already disallowed. Okay. And one more important point, this section is not applicable, 48(2) not applicable to payments made to outsiders. Outsiders is nothing but other than relatives, close associates. Have you understood? This is 48(2). And the next one is 48(3). Another condition. 48(3). Any of your business expenditure, if any payment, if any expenditure, exceed if any payment, any individual payment or aggregate payment to a person in a day exceed 10,000. Okay, if any payment, either single payment or if you have to pay more than one payment in same day, then aggregate payments if it exceed 10,000. So 35,000 in case of if payment made to transport operators. Okay, so this section gets attracted where the payment or aggregate of payments to a person in a day exceed 10,000. 35,000 in case of transport operator. The condition is the payment must be made, shall be made by way of, important point, by way of account pay check, account pay bank draft, electronic clearing system, any other electronic mode. These are the prescribed modes. Compulsory you need to make the payment any of these modes specified here. Okay. Act says that if you have paid the such amount by way of cash, then 100% of such expenditure shall be disallowed. In case of violation, 100% of such expenditure shall be disallowed as business expenditure. That's section 40A(3). Of course, there are certain exceptions to this section. Go through those exceptions. Around 10-11 exceptions are there. I don't want to explain the exceptions. So if your payment covered in those exceptions, then you can make the payment even in cash. No issue. 40A(3) does not attract for those exceptional cases. Example, payments made to government, payment made to banks or financial institution, including RBI, so SBI, etc., LIC, and payments made to agricultural producers, farmers, tribal area. So many of exceptions are there. Please go through the exceptions. Exceptions also very important. If your transaction covered in those exceptions, then you need not follow this section. You can make the payment even in cash, irrespective of amount. If the transaction was not covered in those exceptional cases, then compulsory you need to follow this section. And like 48(2), this section also applicable only to allowable expenses. Disallowed expenses are not subject to 48 because it was already disallowed. Have you understood? So that's it. Lastly, 44AB, tax audit. 44AB, tax audit. 44AB, tax audit. The business persons are required to audit their books of accounts. The business persons are required to audit their books of accounts mandatorily if their turnover tax audit. 44AB. Business persons are required to audit their books of accounts if turnover of such business during the previous year exceed 1 crore. Otherwise, no need to audit the books of accounts. And however, in some exceptional cases, the threshold limit is 10 crores instead of 1 crore. Okay. Where 10 crores limit gets attracted? Given here. Second note point. This is very important point. Subject to two conditions. Subject to these two conditions, 10 crores limit gets attracted instead of 1 crore. Up to 10 crores, need not audit the books of account. If your turnover exceeds 10 crores, then only you are required to audit the books of account, subject to fulfillment of these conditions. If any of these conditions were not satisfied, then the limit is 1 crore. If your turnover exceeds 1 crore, then you are required to audit the books of accounts. Okay. What are those conditions to be satisfied for applicability of 10 crores limit? The first one is, out of your total receipts, cash receipts does not exceed 5%. That's the one of the conditions. Out of your total receipts, cash receipts does not exceed 5%. Out of your total payments, cash payments does not exceed 5%. One condition is for receipts, one condition is for payments. And the conjunction between conditions and nothing but need to satisfy both the conditions for applicability of higher threshold limit of 10 crores. If any of these conditions were not satisfied, then the limit is just 1 crore. Have you understood? So in general, you are required to audit. If you are a business person, you are required to audit your books of accounts. If your turnover exceed 1 crore, but instead of 1 crore, 10 crores limit to be considered, subject to the following two conditions. Okay. So there are two limits for business person, 1 crore or 10 crore. Depends on. Please verify it carefully. Next one, professional person. Professional persons are having only one limit, that is 50 lakhs. If professional persons, the gross receipts during the current previous year, if it exceed 50 lakhs, then the professional persons are required to audit their books of accounts mandated. Okay. The audit shall be made by qualified chartered accountant. And what is the time limit for audit the books of accounts? This is an important 1 mark bit. What is the audit shall be completed and furnish prescribed forms. The assessee shall furnish audit report in prescribed forms, form 3CA, 3CB, 3CD, within the specified date. What is the specified date? That is very important. Here the specified date is 1 month prior to the due date for filing the return of income. You need to upload prescribed forms 1 month prior to the filing the return of income. Okay. So for example, if your return of income due date is October 31st, then 1 month prior, September 30th. September 30th is the last date. 1 month prior to the due date for filing the return of income. That is September 30th is the last date. Okay. That's the information relating to 4048. And finally, I want to explain about presumptive taxation. There are 3 presumptive sections are there. Presumptive taxation concept is very important in pgbp head of income. Presumptive income is nothing but tax on estimated income. Presumptive taxation. My dear students, what is the object for introduction of this presumptive taxation? So to reduce the compliance burden to small business persons, small professional persons, to reduce the compliance burden to small business persons, professional persons. Okay, this is the objective for introduction of presumptive taxation. This is just like composition scheme in GST. Okay, presumptive taxation. What is the objective to presumptive taxation? To reduce the complaints. What is the burden? The burden is maintain the books of accounts, audit the books of account. To reduce the complaints burden is nothing but maintenance of books of accounts, audit the books of account. That is maintenance of books of accounts, and audit the books of accounts. So my dear students, what is the reduction of burden to these small business persons and professional persons? If they declare the presumptive income, they need not maintain the books of accounts as per section 44AA, need not audit the books of accounts as per section 44AB. AA, AB sections are not completely applicable to them. Okay, so that's the objective for introduction of presumptive taxation. Now, is the presumptive taxation is optional or mandatory? My dear students, presumptive taxation is an optional if those associates who are maintaining the books of accounts. It's mandatory to those business or professional persons who are not maintaining the books of accounts. Okay, so presumptive taxation is purely an optional scheme. If you don't want to pay tax as per presumptive provisions, then you may go for actual income as per your books of accounts. You may pay tax as per income as per your books of accounts. Yeah. My dear students, there are 3 presumptive sections in our material. Of course, there are some other presumptive sections are there which are applicable to non-resident presumptive taxation. So those sections not in our syllabus. Okay. So we mainly concentrate only three sections: so 44 AD, 44 AE, 44 ADA. Okay. I'll explain in brief those three sections. Presumptive is nothing but tax on estimated income. Okay. So what is the objective? To reduce the compliance burden to the small business persons and professional persons. What is that burden? That is burden of maintenance of books of accounts, burden of audit the books of accounts. Okay. So 44 AD, 44 AD, 44 AD, 44 AE, 44 ADA. Okay. So first of all, presumptive provisions are applicable only to some selected persons who are eligible to declare presumptive income under these sections. The first one is eligible assessee, resident individual, resident HUF, resident partnership firm, other than LLP. LLP is not eligible to declare presumptive income. So these three persons are only eligible to declare presumptive income under section 44 AD. Okay. 44 AE, sorry, second section is 44 AE. 44 AE is applicable to all assessees. Any assessee. Okay. 44 ADA is applicable to resident individual, resident partnership firm. Resident individual, resident partnership firm, other than LLP. Okay. First of all, eligible assessee is very important point. Except these persons, no other person is eligible to declare presumptive income. These are the eligible persons to declare presumptive income. Have you understood? And one more important point: what are the businesses? What are the businesses eligible to declare presumptive income? Second point: business, eligible business or profession. 44 AD is applicable to all businesses except the business covered in section 44 AE. So 44 AE, what is the business was covered in section 44 AE? That is transport operators, flying, hiring, leasing of goods carriages. Flying, hiring, leasing of goods carriages. Only one business was covered in section 44 AE. Except this business, all other businesses were covered in section 44 AD. All businesses except flying, hiring, leasing of goods carriages. Have you understood? So all the businesses were covered in section 44 AD except one business, which was covered in section 44 AD. Next one is notified profession. Specified under section 44 AA1. Okay, only notified professions are covered in section 44 ADA. So these are the 2 points which are very important. And third point is condition. The condition is turnover does not exceed 2 crores, less than or equal to 2 crores. That's the important condition. So the turnover, having the turnover less than or equal to 2 crores are only eligible to declare presumptive income. That is the small business persons. If your business turnover exceed 2 crores during the current previous year, then you are not entitled to declare presumptive income. Then you are liable to pay tax on actual income. Actual income is nothing but as per books of accounts. Then you are required to maintain the books of account, audit the books of account. Okay. So, and here is not having, most important condition for 44AE is not having the vehicles exceed 10 at any time during the previous. Vehicles does not exceed 10. Vehicles less than or equal to 10 at any time during the previous year. Okay, this is the condition to be satisfied by transport operator. If transport operator is having more than 10 vehicles, then they are not required to declare presumptive income. Then they are required to maintain the books of accounts, audit the books of accounts, and pay tax as per books of account. That is actual income. Presumptive provisions not applicable to those transport operators having more than 10 vehicles. So that's why the presumptive taxation is applicable only to small business persons or small professional persons. Who is small business persons? In section 44AA, the turnover does not exceed 2 crores. 44AD. 44AE, vehicles does not exceed 10. And 44ADA, gross receipts less than or equal to 50 lakhs. This is the condition. The condition must be satisfied to declare presumptive income as per these sections. Okay. So the last one is, what is the presumptive income? Percentage of presumptive income. This is most important section. Presumptive income is equal to, in case of turnover in cash, then 8% of your turnover. Online turnover 6%. Cash turnover 8%. Online turnover 6%. 6% of turnover. If your total turnover includes both cash and online combination, then split up the turnover as cash and online, apply both the percentages and aggregate the total. Okay, that's also a very important point. And what is the presumptive income in 44AE? For heavy goods vehicles. For heavy goods vehicles, 1000 rupees per ton per month. 1000 rupees per ton per month. So that's the one of gross weight of the vehicle. 1000 rupees per month per ton of gross weight of the vehicle. No issue, my dear students, the weight will be given in the problem. If it is 20 tons lorry, for each ton 1000 rupees to be considered. That is 20,000 per month into number of months. Okay. So if it is a heavy goods vehicle, apply 1000 rupees per ton per month. 1000 rupees per ton per month of gross weight of the vehicle. The weight will be given in the problem. Okay. So, and if it is a light goods vehicle, for entire vehicle 7500 per month per vehicle. Have you understood? So that's the important information. And last one is 50% of gross receipt. So I'll give you some other information relating to this. These are the main points relating to presumptive taxation. And one more important point, most important note point here is, no expenses shall be deductible from presumptive income under section 30 to 37 because it has already deemed to have been deducted. No expenses shall be deductible. Under section 30 to 37. If expenses given in the problem, just ignore it. Have you understood? Note. Another note is, Chapter 6 year deductions are deductible from presumptive income. Chapter 6 year deductions, yes, deductible from presumptive income. What about losses, set off of losses? Yes, losses can be set off against presumptive income. Both current year losses as well as brought forward losses also. Set off of losses, yes, can be set off. But expenses not deductible. So these three are very important note points. Have you understood? So this is the information relating to pgbp head of income. Let's begin our discussion with last head of income, income from other sources. This is the residuary head of income, section 56 to 59. Residuary head of income. Okay. So what are the sections involved in this section? Section 56 to 59. 56 deals with what are the incomes taxable under this head of income. 57 deals with allowable expenses or deductions under the head income from other sources. So 58 deals with what are the expenses which were not allowed as deduction under the head income from other sources, that is disallowed expenses under this head of income. 59 deemed profits. Okay, so 56, 57, 58, 59. 56 relates to income, 57 relates to expenses or reductions. 58, so 57 expenses deductions related section, 58 expenses which are not allowed as deduction, 59 deemed profits. Okay, so my dear students, other sources is the residuary head of income. Residuary head of income, it includes all incomes, those not covered under previous four heads are automatically taxable under this head of income, subject to some condition. Okay, so around 20 plus incomes are there which will be taxable under the head income from other sources. It's the residuary head of income. Whatever the income which was not taxed in previous four heads are automatically taxable under this head of income. In addition that, some incomes directly taxable under this head of income. So I don't want to explain each and every income. So 56 deals with the incomes which were not covered under other heads of incomes are automatically taxable under this head of income, subject to the following condition. Condition number 1, it must be an income and the income was not exempted income. It's not an exempted income. And it was not chargeable to tax in any other head of income from salary to capital gain. So then such income will be taxable under this head automatically. These are the conditions to be satisfied for taxability of any income under the head income from other sources. Have you understood? So these are the incomes which will be taxable under this head of income. Around 26 incomes are there. I don't want to explain each and every income because due to time constraint. Okay, I'll explain only one or two incomes which are very important in income from other sources side. So first of all, gift. Gift is one of the most important and important concept in other sources head of income. The gift concept is too lengthy and important in exam point of view also. So my dear students, generally gifts received from your employer, it will be taxable under the head salary. If gifts received from any person other than your employer, then automatically taxable under this head of income, but subject to some condition. So how to value the gift? How it will be taxable in this head of income? Okay, I'll explain about the concept of gift. Gift conditions for taxability of gift under this head of income. These are the very important conditions. For taxability of gift under income from other sources. there are 4 conditions to be satisfied for taxability of gift under this head of income. One is, it was not covered in exempted cases. There are so many of exempted cases are there in other sources head for the exemption of gift. If your transaction was covered in those cases, then you are not liable to pay tax on such gift because it's an exempted transaction. So I show you the list of exempted cases. This is the list. Exempted in the following cases. Around 10 plus exempted cases are there. In these cases, the gifts are exempt from tax. Have you understood? So, for taxability of a gift, the transaction must be not covered in this list. If it was covered in this list, then you are not required to pay any tax on such gift. Okay. So, the first condition for taxability of gift is the transaction was not covered in exempted cases. It was not covered in exempted cases. Okay. And the second one is gifts may be received either in monetary or non-monetary, is nothing but either cash or kind. If gift received in kind, then the asset received as gift must be covered in property definition, otherwise not taxable. So the asset received as gift must be covered in property definition. Otherwise, such gift is not taxable if it was not covered in property definition. Property definition is also very important. And third one is, asset received as a gift must be a capital asset to the recipient. It must be a capital asset. Capital asset to recipient. Recipient point of view, the asset received as gift must be a capital asset. Otherwise, the gift is not taxable. So, and all these conditions must be satisfied for taxability of gift. Last one is, the value of benefit exceed prescribed limit, that is 50,000. Value of benefit exceed 50,000. For first 4 categories, value of gift exceeds around 5 categories are there in gift transaction. For first 4 categories, exceed 50,000. For first 4 categories, exceed 50,000. For last category, 5th category, immovable property received inadequate consideration. That is the 5th category. 5th category, exceed 50,000 or 10% of consideration, whichever is higher. 10% of consideration, whichever is. So, my dear students, these are the conditions to be satisfied for taxability of gift in the hands of recipient. It was not covered in exempted cases. If it was covered in exempted cases, then the gift is not taxable. And if received gift in kind, then such asset must be covered in property definition. If it was not covered in property definition, then also not taxable. And the recipient point of view, such asset must be a capital asset. If it is not a capital asset in the hands of recipient, then also no need to pay any tax. And the value of benefit exceed 50,000 for first 4 categories, 50,000 or 10% of consideration, whichever is higher for last category. So these are the essential conditions for taxability of gift. So my dear students, please go through the gift concept. Based on this knowledge, you should verify the concept of gift. You can understand the concept very easily. Okay. So next, valuation of gift. How to value the gift? Valuation. Gifts are classified into 5 categories. How to value the gift in each category? If gift is taxable in the hands of recipient, then on which value you are liable to pay tax to the government? How the gifts will be valued? Because the gifts may be received either in monetary or non-monetary. If it was received in non-monetary, then how to value the gift? Valuation of gift is very important. First of all, decide whether it is taxable or not. If taxable, then what is the value? Okay, valuation of gift. First category. Category 1, gifts in money. If gifts received in money, then what is the value of tax? What is the taxable value? How it will be valued? So, my dear students, aggregate value to be considered here. Aggregate money gifts received throughout the previous year, that is during the previous year. For example, if you have received 10 gifts from 10 various persons in money during the current previous year from April to 31st March, Act says that all these money values to be aggregated, and please check whether it exceeds 50,000. If it exceeds 50,000, then entire amount is taxable as gift. If it does not exceed 50,000, then exempt from. Okay, aggregate value to be considered. Aggregate value of money, aggregate money value of gifts received during the current previous year. The important point. Aggregate money value of gifts received during the previous year. If exceed 50,000, then fully taxable. So that is the valuation of gift relating to category 1, gifts in money, then fully taxable. Fully taxable is nothing but aggregate value of money is taxable. For example, like aggregate value of money gifts received during the previous year is 60,000, then entire 60,000 is taxable. If aggregate value is 49,000, then no need to pay any tax to the government. Okay, fully taxable is nothing but aggregate money value is taxable. Aggregate money value is taxable. That's the first gift. Have you understood? Next one, movable asset, category 2. Movable asset. Movable assets received as a gift, shares, debentures, jewelry, etc. So, how to value the movable assets received as a gift? Movable assets here classified into 2 parts: without consideration, inadequate consideration. Okay, movable assets received as a gift, either for without consideration or inadequate consideration. Then how to value the gift? That says that if it was received for without consideration, then the value is here also aggregate value to be considered, but which value to be considered? Fair market value to be considered. Aggregate fair market value of those gifts received during the current previous year. If it exceeds 50,000, then fully taxable. Aggregate fair market value of gifts received during the current previous year. If exceed 50,000, then fully taxable. Taxable value is aggregate fair market value. Have you understood? Fair market value to be considered. That too aggregate value to be considered. That's the very important part. And second one is, if it was received for inadequate consideration, then the difference between fair market value minus consideration price, the difference is to be considered as a gift. That too aggregate value to be considered. Aggregate value of benefit, aggregate value of benefit, that is paid market value minus consideration. Paid market value minus consideration of each gift received during the previous year, the difference shall be aggregated. And if it exceeds 50,000, then fully taxable. Okay, aggregate value. What is the benefit here? Paid market value minus consideration of gifts received during the current previous year. If exceed 50,000. Okay, here paid market value minus consideration paid to be considered. The difference is only to be considered, and the differences shall be aggregated. And aggregate differences, if it exceed 50,000, then fully taxable. So then taxable value is equal to aggregate value, aggregate benefit. That is paid market value minus differences. Aggregate paid market value minus differences to be considered. Okay, what is the benefit here? Aggregate benefit, paid market value minus consideration to be considered. So this is the valuation rule for movable property received as a gift. The next one is how to value the immovable property received as a gift. Important point. Immovable property. Immovable property. Category 3. Immovable property again classified into two parts. Okay, immovable property without consideration, inadequate consideration. Without consideration, inadequate consideration. That's the important point. So without consideration, inadequate consideration. So what was the value to be considered if immovable property received as a gift? Paid market value to be considered. But here is stamp duty value to be considered. And one more important point, in previous gifts, aggregate value to be considered of gifts received during the entire previous year. But here is need to value the each gift separately, not to be aggregated. Don't aggregate here. Each and every gift, value the each and every gift separately. That's the difference between previous and this one. Okay, so if immovable property received as a gift, example buildings, lands, etc. Okay, what is the taxable value? If stamp duty value of each gift, not to aggregate here, each gift, if exceed 50,000, then taxable value is equal to stamp duty value. Stamp duty value of such asset to be taxable as this. Simple. But the last one is most important. Immovable property, inadequate consideration. Immovable property, inadequate consideration. How to value the gift? Here, difference between stamp duty value and paid market value to be considered of each gift. Difference between paid stamp duty value minus consideration of each gift to be considered. So difference between stamp duty value and consideration. Difference between stamp duty value and consideration of each gift. If it exceed, that's the most important point. If it exceed higher of the below, higher of A 50,000, B 10% of consideration, whichever is higher. If it exceeds this limit, then the difference is taxable. What is the taxable value? Stamp duty value minus consideration is taxable. If it exceeds the above limit, what is the limit to be verified here? 50,000 or 10% of consideration. For example, if you paid 7 lakhs rupees as consideration, then 7 lakhs into 10%, 70,000, 50,000 or 70,000, whichever is higher. Here gift is taxable only if the difference between stamp duty value and consideration exceeds 70,000, otherwise not taxable. Have you understood? So important. These are the 5 types of gifts. First one, gifts in money. Second one, gifts movable asset without consideration. This is the second one. Movable asset inadequate consideration. Third one. Immovable property without consideration. Immovable property inadequate consideration. 4 and 5. Total 5 types of gifts are there. Gifts in money, movable without, movable inadequate. Immovable without, immovable inadequate. For first 4 category gifts, taxable if value of benefit exceed 50,000. For last category, taxable if it exceed 50,000 or 10% of consideration, whichever is high. Otherwise not taxable. Okay. For first 4 category gifts, taxability, sorry, for first 3 category gifts, taxable value to be calculated based on aggregate value of all gifts received during the previous year. But last 2 categories, that is immovable property gift, taxability based on each and every transaction separately. Okay, need not aggregate for immovable property received as a gift. Each gift value separately. Okay, that's the difference. These are the valuation rules of gifts. Total 5 types of gifts are there. Gifts in money. The gifts in money, first one. Gifts in money. Second one, movable property without consideration. Third one, movable inadequate consideration. Fourth one, immovable without, immovable inadequate. Okay, and one more important point. So while taking the stamp duty value, then need to follow the provisions specified in section 50C. Whatever the provisions discussed in section 50C in capital gain chapter are also applicable here. Okay. Stamp duty value. For example, if stamp duty value on the date of agreement, on the date of registration are not the same, then subject to 3 conditions. If those 3 conditions were satisfied, on the date of agreement to be considered. Otherwise, on the date of registration to be considered. The topic, whatever the topic was discussed in section 50C will be applied here also as it is. Stamp duty value. Okay. And stamp duty value to be considered. So stamp duty value to be considered. Only important point. Whatever the provisions discussed in section 50C are also applicable while calculating the value of gift. Okay. So stamp duty value related provisions discussed in 50C are to be applied here also. So please go and verify section 50C once again, which is exclusively relating to stamp duty value. Okay. Next one is, my dear students, this is the property definition. If the asset was not covered in this property definition, then the gift is not taxable. That's the important point. So these are the exempted cases. If your transaction covered in this list, then you need not pay any tax on such gift. For example, first 3 are very important. Gift received from relative, exempt from tax. Gift received on the occasion of marriage, exempt from tax. Gift received by way of will or inheritance, exempt from tax. Gift received from local authority, exempt from tax. So many of exempted cases are there. So please go through the gift concept. So please verify it, all exempted cases. If your transaction was covered in these cases, then you are not liable to pay tax. First of all, while valuing the gift, first observe whether the transaction was covered in this list. If it was not covered in this list, then calculate the taxable value. Okay, have you understood? So these are the provisions relating to gift. Next one, dividends. My dear students, dividends always be taxable under the head income from other sources in the hands of shareholders. Okay, but dividend whether declared by domestic company or foreign company, whatever the company was declared, the dividend always be taxable in the hands of shareholders under the head income from other sources. Dividends declared by company to shareholders, taxable under the head income from other sources in the hands of shareholders. Okay, that's the simple provision. But important point, company may be either domestic company or foreign company, whatever it is, always the dividends are taxable in the hands of shareholders. But here provision is dividend includes deemed dividend also. Dividend includes deemed dividend also. Dividend includes deemed dividend. What is deemed dividend? That's the important concept in this. There are 5 sections involved in deemed dividend provision: 222A, 222B, 222C, 222D, and 222E. These are the sections which are dealing with deemed dividends. Deemed, of course, the deemed dividend treatment is also same as actual dividend. It will also be taxable in the hands of shareholder under the head income from other sources. But the question is, what is deemed dividend? Okay, there is no difference between actual dividend and deemed dividend. Treatment is same for both. But the definition of deemed dividends is very important. Deals with section number 222, A to 222E. I will explain in simple manner. So deemed dividends. Section 2, subsection 22. Okay. So my dear students, there are 5 sections involved in this concept. 222A. My dear students, please remember, dividends, deemed dividends is nothing but distribution of accumulated profits. In all 5 sections, the common point is, in all 5 sections, the distributed amount is from accumulated profits held by company. Okay, distribution of accumulated profits. Distribution of accumulated profits. Distribution of accumulated profits. Most important point. Distribution of accumulated profits to its shareholders. To its shareholders in various situations. Okay. So distribution of accumulated profits to its shareholders. To its shareholder at the time of, that's the important point, A, by way of release of assets. Release of assets, 222A, in the form of assets, either part of the assets or full asset, whatever it is. Then 222A gets attracted. Okay, 222B, by way of debenture stock, deposit certificates. Debentures, debenture stock, deposit certificates. Distribution by way of, okay, or bonus shares to preference shareholders. Here specifically mentioned that bonus shares to preference shareholders. What about if it was bonus shares were allotted to the equity shareholders from accumulated profits? That will not be treated as a deemed dividend. Here specifically mentioned as preference shareholders. Equity shareholders not covered in this point. Okay, that's the important point. This is the 222B. My dear students, the treatment is same in all 5 sections. The treatment is same. Taxable in the hands of shareholder. Under the head, income from other sources. Next, 222C. 222C. Here also same. Distribution of accumulated profits by a company to its shareholders on its liquidation. On its liquidation. That is at the time of liquidation. Before the date of liquidation, whatever the accumulated profits held by the company was distributed to existing shareholders. Then that will be treated as a deemed dividend in this section. If profits after the date of liquidation will not be treated as a deemed dividend. Please go and verify the sections clearly. There are some note points are there. Okay. Next one, reduction of share capital. Fourth situation is reduction of share capital. D. Reduction of share capital. Okay. At the time of reduction of share capital, whatever the payment made by the company to its shareholders from accumulated profits shall be treated as deemed dividend in the hands of shareholders. Therefore, the shareholders are liable to pay tax under the head income from other sources from such amount. And last one is loans and advances. 222E is most important section, my dear students. Please be prepared this section compulsory. There is a question, there is a CRD question also there relating to this section. And some of the concept questions are there in our material. Okay, 222A. By way of loans and advances. But here something I want to say, here not covered by all companies in this point. Distributed by company in which public are substantially interested. Public are not having substantial interest. Applicable only to private company. Okay, so distributed by private company. Company in which public are not substantial interest. 2. Beneficial owner. Beneficial owner is nothing but shareholder having at least 10% voting rights. That is equity shareholder. Or to any other person, any other concern in which the beneficial owner having substantial interest. To any of these persons, if private company distributed by accumulated profits by way of loans or advances. Loan or advance. That's the important. Have you understood? The last section is very important. Please go through that section and please prepare at least one problem relating to 222E. It's very important in exam point of view. Here not applicable 222E, not applicable to all companies, applicable only to company in which our public are not having substantial interest. And the accumulated profits distributed by way of loans or advances. To whom? Either to beneficial owner or to any other person or any other concern in which the beneficial owner is having substantial interest. Okay. So of course, deemed dividend treatment is same as actual dividend. That is taxable in the hands of shareholders under the head income from other sources. The tax rate is normal tax, slab rates. Have you understood? So this is the information relating to dividends. Next one. (56) subsection 2 class 7B. So my dear students, this section was removed in Finance Act 2024. will not be applied from May 2025 attempt. I think this is the last attempt. Your attempt is the last for this section. So it is better to prepare it at least once. So you may expect this question, this section in upcoming January 2025 examination. Because from May onwards, this section is no more in our Income Tax Act. Okay, so that please be prepared this section. Simple section, very easy. So this section is also applicable to company in which public are not substantially interested. That is private company. Okay, so Act says that if private company issued shares at a premium and premium price, if it exceed fair market value of those shares, then excess over fair market value shall be taxable under the head income from other sources. That's it. So two conditions to be satisfied for attracting 56 subsection to class 7B. 56 subsection to class 7B. Two conditions. Condition 1, shares were issued at premium. Shares were issued at premium and the issue price exceed fair market value. If these two conditions were satisfied, then excess over fair market value to be taxed as income under the head income from other sources in the hands of issuing company. This is also important section, section 57. What are the expenses allowed as deduction under the head income from other sources? Okay, my dear students, one of the income taxable under this head of income is family pension. Family pension is having a deduction, that is 57 says that family pension is eligible for deduction, that is 1/3 of the pension received or 15,000, whichever is lower is eligible for exemption. My dear students, please remember this point carefully. So whenever you have received a family pension, then compulsory you need to deduct this amount. Balance is only taxable. It's a mandatory deduction. Have you understood? Important deduction also. Family pension is eligible for deduction. 1/3 of the amount received or 15,000. Whichever is lower is deductible. The balance is taxable. Okay, next. So dividend income. Another income taxable under the head income from other sources is dividend income. My dear students, dividend income expenses are not deductible from dividend income except one expenses, that is if you have taken any loan or investment in such shares, then the interest on borrowed money will be allowed as deduction. What is the eligible expenditure to claim deduction from dividend income? Only interest on loan taken for such investment. Interest income, interest expenditure is only eligible for deduction from dividend income. No other expenses shall be deductible, subject to a limit, that is maximum 20% of amount of dividend cannot exceed, maximum deduction cannot exceed 20% of dividend amount. For example, if you have received 20,000 as dividend, then you can claim deduction up to 20,000 into 20%, 4,000. Maximum deduction cannot exceed 20% of amount received as dividend. That too, deduction available only to one expenditure, that is interest amount. No other expenses shall be deductible from dividend. Have you understood? And my dear students, welfare contributions was covered in pgbp head of income. And winnings, no expenses shall be deductible from winnings except amount foregone to the government or lottery conducting agents. That only eligible expenditure to claim from winnings. Except that no other expenses shall be deductible from winnings. And interest on compensations, enhanced compensation. Of course, all these amounts were taxable in this head of income. But what is the deduction from interest? And this is also an important. Family pension important. Dividend income important. Interest income. Winnings important. So section 57 is very important section. Compulsory go through section 57. It's a very important section while solving the other sources head related problem. Okay, interest on compensations, enhanced compensations, of course taxable under the head income from other sources, but there is a deduction. What is the amount of deduction available from this interest income? 50% flat irrespective of expenditure. 50% of amount received will be allowed as deduction. It's a mandatory deduction irrespective of actual expenditure. Even if no expenditure was incurred, you can claim the deduction at the rate of 50%. Okay, so expenses. But what about for all other incomes taxable under the head income from other sources? Is deductible expenses deductible or not? Yes, for all other incomes, you can claim any expenditure, any reasonable expenditure to get such income to be claimed as deduction, subject to some condition, just like a section 37 in pgbp, residuary condition. Okay, so these are the specific deductions from certain specific incomes. For all other incomes, reasonable expenditure to be claimed as deduction, subject to some condition. The conditions given below. These are the conditions. It must not be a capital expenditure incurred during the previous year. It not be a personal expenditure expended only to get the such income. If these conditions were satisfied, then you can claim any expenditure from any income. Have you understood? So expenses section 57 is very important. My dear students, I don't want to take much time for explaining other sources head of income. So these are the topics and important topics in this head of income. Let's close the other sources head here. Okay. So section 57 is very important. Please be prepared. Section 57. It contains very valuable information. And gift concept is very important. Dividend concept is very important. And winnings concept is very important, and interest on securities point is also very important. These are the important topics in this head. And one section is going to be removed from next attempt. Therefore, 56 subsection 2 class 7b. This is the last attempt for such section. So better to prepare it. At least one problem relating to that. Okay, have you understood? Next chapter, clubbing provisions. My dear students, will take only 30 minutes to complete this chapter. This is the small chapter. Of course, this chapter is also an important chapter in examination point of view. You can expect one question. So in each and every attempt from this chapter. Okay, don't neglect. It's an easy chapter. Prepare all the problems involved in this chapter perfectly. Okay. So first of all, clubbing is nothing but the income of other persons shall be included in the income of the assessee. Now, where the cases where the clubbing provisions gets attracted. Okay, so around 9 to 10 sections are there in this chapter. I will explain some of the sections. Okay, so first section, section 60. Section 60. This section says that transfer of only income without transfer of asset. Transfer of only income without transfer of asset. So what section 60 says that transfer of only income without transfer of asset, then clubbing provision gets attracted as per section 60. Okay, so how this section will apply? Act says that, for example, Mr. X is having a house property. Mr. X is having a house property. From such house property, every year he received a rental income of 1 lakh. Every year he received a rental income of 1 lakh rupees from such house property. So now, during the current previous year, he instructed the tenant. He instructed the tenant to pay 1 year interest to his friend Mr. Y. So he wants to help to some extent to his friend, because his friend is suffering with financial crisis at present. So he instructed his tenant to transfer 1 year interest, that is 1 lakh rupees. 1 year interest is nothing but 1 lakh rupees to his friend Mr. Y to help him in his education or due to any other reason. Okay. So based on the instructions of Mr. X, the tenant transferred the rental income of 1 lakh to Mr. Y. The tenant transferred the rental income of 1 lakh rupees, that is 1 year interest, 1 year rent to the account of Mr. Y based on the instructions given by Mr. X. So here section 60 gets attracted. Section 60 says that, so based on the instructions, whatever the rental income was transferred to Mr. Y, the income shall be eligible for clubbing in the hands of transferor as per section 60. The 1 lakh will be eligible for clubbing in the hands of transferor. As per section 60. Okay, therefore, the Mr. X is liable to pay tax on such amount of 1 lakh rupees. Okay, even if such amount was enjoyed by Mr. X, the responsibility for payment of tax vests with Mr. X because he transferred only income without transfer of asset. Okay, so that's the section 60. Next one, section 61. Revocable transfer of asset. Revocable transfer of asset. Here the transfer is, here the asset transferred to some other party which is revocable. Whenever the transfer becomes revocable, then the income from such asset received by transferee every year is eligible for clubbing in the hands of transferor. That's what section 61 says that. Okay. For example, Mr. X transferred an asset to Mr. Y. Transfer of asset. Mr. X transferred an asset to Mr. Y. Here the asset was transferred to Mr. Y, but such transfer becomes revocable. It's a revocable transfer. Whenever the transfer of asset becomes revocable, then the income from such asset received by Y is eligible for clubbing in the hands of transferor. Have you understood? Income on such asset, received by Mr. Y is eligible for clubbing in the hands of transferor. Okay. So what the amount to be clubbed in the hands of transferor? Only the income on such asset is eligible for clubbing in the hands of transferor. If transfer becomes revocable, the revocable is very important concept in this section. Have you understood? For example, X transferred a building to Mr. Y, which is revocable transfer. Revocable is nothing but conditional. Which is revocable transfer, then the rental income on such building received by Y every year is eligible for clubbing in the hands of transferor, Mr. X. Mr. X is liable to pay tax on such income, on such asset received by transferee. Have you understood? What is revocable? Revocable transfer is nothing but it's a conditional transfer. What that condition? Act says that even after transfer, the transferor is still having right to reacquire the asset in future or right to receive the income from such asset either fully or partly. Then such transfer becomes revocable. Have you understood? If transferor having right after transfer to right to the transferor is having right after transfer. What that right? So to A, reacquire the asset after some time, okay, after some years, either 1 year or 2 years or 3 years, whatever it is, in future. So if such asset will be retransferred to transferor, that's the right having by the transferor. Next, or right to receive the income on such asset, either fully or partly. Then the transfer becomes revocable. Whenever the transfer becomes revocable, then the entire income on such asset is eligible for clubbing in the hands of transferor. Of course, there is an exception to this rule. If transfer of asset during the lifetime of the transferee, no time was mentioned in the agreement to retransfer the asset. Just the asset was given during the lifetime of the beneficiary. Beneficiary is nothing but transferee. Then that transfer will not be treated as a revocable. Then clubbing does not attracted in such case. That's the only exception to this section. Okay. The transferor is still having right to reacquire the asset, right to receive the income from such asset, either fully or partly. Then the transfer shall be treated as revocable. Then the income will be clubbed in the hands of transferor. Okay. This is section 61. What section 61 says that? Next, 64 subsection 1 class 2. Remuneration to spouse. Remuneration to spouse. Act says that in any concern, either business concern or professional concern, in any concern, Act says that if husband or wife, any person having substantial interest, for example, husband having substantial interest, wife received remuneration from same concern without any qualification. Okay. So husband having substantial interest, wife received remuneration from same concern without any qualification. Then the remuneration to be clubbed in the hands of husband as per section 64, subsection 64, subsection 1, class 2. This is called the clubbing at the time of remuneration to spouse. My dear students, please observe that this section will be applied vice versa. If wife having substantial interest, husband received remuneration without any qualification, then the husband's remuneration to be clubbed in the hands of wife also. Okay, it's a vice versa section. Okay, so either husband or wife, any of these persons having substantial interest and the other person received remuneration without any qualification, such amount to be clubbed in the hands of a person having substantial interest. But there are certain exceptions to this section. With qualification, if received remuneration with qualification, then clubbing does not attract it. Even if husband having substantial interest, wife received remuneration with proper qualification, experience, knowledge, etc., then such remuneration will not be eligible for clubbing. Have you understood? And the second one is, other than remuneration is not eligible for clubbing. Other than remuneration, example, husband having substantial interest, wife received rent, not eligible for clubbing, because heading itself contains the word remuneration. this section was confined only to remuneration, that is salary income. Salary. Clubbing gets attracted in this section only to salary income, not to any other income. Okay, exceptions, two popular exceptions to this section. One is in remuneration with qualification, experience, knowledge is not eligible for clubbing, and other than remuneration, example rent, interest, etc., all these amounts will not be eligible for clubbing. Have you understood? So exceptions. One is other than remuneration, not eligible for clubbing. Not eligible for clubbing. Remuneration received with proper qualification or experience, knowledge, etc., here also not eligible for clubbing. Remuneration without any qualification is only eligible for clubbing in the hands of individual having substantial interest, either husband or wife. Have you understood? Next. 64 subsection 1, class 4. Gift to spouse. Gift to spouse. My dear students, this is most important section in this chapter. Gift to spouse. So husband, it's also a vice versa section. Also a vice versa section, and important, very important section. Husband to wife. Husband to wife or wife to husband. Gifted any asset. Gift of any asset other than house property. Because the house property was covered in section 27, deemed ownership, therefore not covered in this section. If husband gifted house property to wife, then husband is treated as a deemed owner. Therefore, the rental income received by wife will be taxable in the hands of husband. That's the matter covered in section 27 itself. Therefore, section 64 subsection 1 class 4 does not attracted in that. Okay, except house property, any other asset if gifted by husband to wife or wife to husband, then the income on such asset is eligible for clubbing in the hands of transferor. That's the section 64 subsection 1 class 4. Gift of any asset other than house property, then the income on such asset, income on such asset is eligible for clubbing in the hands of transferor. Have you understood? This is a vice versa section, either husband to wife, wife to husband. Gifted any asset other than house property, then the income on such asset shall be clubbed in the hands of transfer. Okay, when the transaction will be treated as a gift, gift is nothing but transfer either without consideration or inadequate consideration, then only such transaction will be treated as a gift, then clubbing gets attracted. So there are certain exceptions to this rule, and one of the major and most important condition here for applicability of this section is the husband and wife relationship must be in existence at the time of gift and at the time of accrual of income, otherwise clubbing does not attract it. Okay, so the relationship of husband and wife, the relationship must be in existence both at the time of gift, at the time of accrual of income. Then only clubbing gets attracted in this section. The relationship of husband and wife must be in existence at the time of gift and at the time of accrual of income. Then only clubbing gets attracted in this section. What are the exceptions to this section? First one is before marriage. Gift of asset before marriage will not be eligible. Clubbing does not attract it because there is no relationship at the time of gift. Gift of asset at the time of agreement to live apart. Example, divorce. In that case also, clubbing does not attract because at the time of accrual of income, the relationship was not in existence. So exceptions to this section are, first one is transfer of asset before marriage. Clubbing does not attract it. transfer at the time of agreement to leave a part, clubbing does not attract it. Okay. So, and one more important point here is transfer for adequate consideration. Here also clubbing does not attract it because this transaction is not treated as a gift. It's a sale because it was transferred for adequate consideration. Whenever the asset was transferred for without consideration or inadequate consideration, then only clubbing provision gets attracted. And fourth one is asset acquired out of PIN money, clubbing does not attract it. What is PIN money? Every month, husband given around example 30,000 rupees to his wife for maintenance of family. Wife has been saving such certain amount from that 30,000 rupees every month. After certain period, some years, the amount from such saved amount, the asset, the wife purchased any asset, that is example debentures or shares, etc. out of the money saved from the amount given by her husband every month. That money to the extent of saved by his wife is treated as a PIN money. So PIN money, the husband is not having any right on that. Therefore, if asset acquired out of PIN money, then such asset related income is not at all eligible for clubbing. Clubbing does not attract it. Okay. So money saved out of the amount provided by her husband each and every month for household needs. That's called as PIN money. Okay. If any asset purchased out of PIN money, then the income from such asset is not at all eligible for clubbing. This is section 64, subsection 1, class 4. And one more important point here is if husband gifted some shares to his wife, subsequently the company allotted bonus shares to that. Don't apply the clubbing provision for the income arising on such bonus shares. That is an addition of gifted asset. Any income arising on additions of gifted asset is not at all eligible for clubbing. Clubbing gets attracted only relating to such asset which was transferred by her husband. But the clubbing confined only to the asset gifted, not to additions on gifted asset. Okay, example, perfect example for this is bonus shares. So there are a lot of note points for this section. Please go to section 64, subsection 1, class 4. There are certain and very important note points are there. So I'll explain two note points. One is if any additions on gifted asset, then income on such additions will not be eligible for clubbing. And income on gifted asset was deposited into bank and received any income on such income will not be eligible for clubbing. Example, interest on interest. Okay. Next. Some other sections are there. I don't want to explain. 64 subsection 1, class 6. 64 subsection 1, class 7, class 8. Okay. So, and two more sections I want to explain. That is income of minor children. Section 64, 1A. Income of minor children. Minor children is having any income is eligible for clubbing in the hands of either of the parents whose total income is greater. That is either mother income or father income whose total income is greater. Okay. So the main provision is minor's income is to be clubbed in the hands of either of the parents whose total income is greater. Okay. So, but this rule is applicable only for the first year itself. For example, if first year minor's income was clubbed in the hands of father's income, then you can follow the same rule for subsequent year also. Need not check that whose total income is greater in each and every financial year. So please verify only first year itself. Mother's income, father's income, whose total income is greater, then the income will be clubbed in such person. But subsequent years need to follow the same rule. If first year, if you minor children's income was included in the mother income, then for subsequent years also the income will be clubbed in the hands of mother's income. Okay. So that's the important point. And one more important point, before clubbing minors income, each minor children is entitled to claim as exemption of 1500 rupees up to per children per annum, 1032. The assessee is eligible to club exemption up to 1500 per annum per children. Okay, compulsory need to reduce this amount. After that, the balance will be clubbed. Okay, that's the important point. No restriction on number of children. This exemption is available to any number of children. No issue. Okay, the main provision is the minor's income is eligible for clubbing in the hands of either of the parents, either mother or father, whose total income is greater. Okay, but this rule is applicable only to first year. For subsequent year, the first year the income was clubbed in the hands of whom? That is mother or father. For example, if first year income was clubbed in the hands of mother's income, for subsequent years also the income to be clubbed in the hands of mother income. You need not check the whose total income is higher for each and every financial year. Okay, so before clubbing, the assessee is eligible to claim an exemption under section 1030. For each children, 1500 is to be claimed as exemption up to. The balance is to be clubbed. That's the important part. And there are certain exceptions. There are certain exceptions to minor children. That is, if minor accrued the income by application of skill and talent, will not be eligible for clubbing. Application of skill and talent. Example, singing competition, so dance participation in a dance program, and chess program, whatever the activities which involved skill and talent, then such income will not be eligible for clubbing. That's clubbing does not attracted in the following cases. First exception, application of skill and talent. Second one is application of manual work. Minor accrued the income with physical efforts, that is doing its job, and a salary income will not be eligible for clubbing. Have you understood? So manual work is not at all eligible for clubbing. Skill talent not at all eligible for clubbing. And third one is if children suffering with disabled minor children. The income of disabled minor children is not at all eligible for clubbing. So if the income was covered any of these cases, then clubbing does not attracted, then taxable in the hands of minor himself. Okay, so if the income not covered in these three cases, then the income to be clubbed in the hands of either of the parents whose total income is higher, either mother or father. Before clubbing, exemption to be claimed under section 1032 up to 1500 per children per annum, no restriction of number of children. Okay, so these are the main provisions relating to minors. So let's begin our discussion with set of provisions. Okay, so first of all, loss from house property. Loss from house property. What is the treatment of loss from house property? Inter-source adjustment, inter-head adjustment carry forward to subsequent. Okay, so first inter-source adjustment. Loss from house property. Is it possible to inter-source adjustment? Inter-source is nothing but loss from one house property can be adjusted from another house property income. That's the S eligible for set off. No limit for inter-source adjustment. Have you understood? What about inter-head adjustment? If not adjusted in same head of income, if not adjusted in inter-source, then is inter-head adjustment is available to house property loss? Yes, inter-head adjustment is also available. Yes. Inter-head adjustment is also available to house property. If not adjusted in inter-source, then go for inter-head adjustment. But my dear students, some of the conditions will be applied while making the inter-head adjustment of house property loss. That is, loss from house property can be adjusted from income from any other head of income. Okay, but subject to some conditions. There is no, this conditions will applied in inter-source adjustment. So while making the inter-head adjustments, need to follow some conditions, need to satisfy certain conditions and important point. Okay, so one of the condition is loss from house property can be set off from any other head of income except winnings. That's the one of the important point. Except winnings. Of course, my dear students, no loss can be set off against winnings. Okay, it's a common exception for all losses. So loss from house property can be set off against any other head of income except winnings. Except winnings, you can adjust from any other income. You can adjust from salary income. You can adjust from pgbp. You can adjust from capital gain, both long term and short term. You can adjust from other sources also except winnings. Okay, and another condition is maximum adjustment cannot exceed 2 lakhs. That's the important point. Inter-head adjustment of house property income is available only up to 2 lakhs. If more than 2 lakhs loss is available, then adjust only up to 2 lakhs. The balance will be carried forward to subsequent. And one more important point here is inter-head adjustment of house property loss is not available in default tax risk. Okay, it's available only in optional tax risk, not available in default tax risk. These are the conditions to be followed while making the inter-head adjustment of house property losses. The carry forward section for the house property is 71B. And my dear students, carry forward facility is available up to 8 assessment years. That is one of the important point. Last one is, if any loss carry forward to subsequent year, then it can be adjusted only from same head of income. That is from house property only. Don't adjust against other heads of income. These are the rules relating to set off of house property loss. Have you understood? Next one, pgbp. So pgbp, there are first one, non-speculative business losses is nothing but normal business losses. Non-speculative business losses. What is the treatment of intersource? Is it available to made intersource adjustment? Yes, available. Intersource adjustment available. But can be adjusted from both speculative and non-speculative. And the specified business also. Specified business is nothing but covered under section 35 AD. Yes, non-speculative business loss can be adjusted from entire pgbp income, either speculative or non-speculative or specified. You can adjust any pgbp income, whether it is speculative business profit or non-speculative or even specified business profits also. Next, if not adjusted in intersource adjustment, then go for interhead. Yes, interhead adjustment is also available. Interhead adjustment is also available, but subject to a condition. The condition is don't adjust against salary and winnings. Except salary and winnings, you can adjust at any area. Okay, except salary and winnings. Except salary and winnings, you can adjust it from capital gain chapter. You can adjust it from house property. You can adjust it from other sources other than winnings. Okay, so don't touch salary income and winnings. Except those two incomes, all other remaining incomes are eligible to set off non-speculative business if not adjusted in intersource. And next one is, if not adjusted in interhead also, then go for carry forward. What is the carry forward section? 72. And carry forward period 8 years. Can be adjusted from both speculative, non-speculative. PGBP, entire PGBP head can be utilized, either speculative or non-speculative or even specified also. And business continuity not necessary. In that previous year in which you want to adjust, the same business need not be in continuance. Even if business was closed, adjustment can be made, no objection. Business continuity not necessary. Next. Speculative business loss. Speculative business loss. Intersource adjustment, yes, available. Yes, available. Available, but only from speculative business profits. That's the restriction to be followed. Speculative business loss can be adjusted in same head of income, but there is a restriction. It can be adjusted only from speculative business profits. Okay. So if not adjusted in intersource, that is due to non-availability of speculative profits, then is there any possibility to go to other heads of income? No. Interhead adjustment not available to speculative business loss. Not available. Okay. If not adjusted in intersource, then go for carry forward. Have you understood? What are the carry forward details for this loss? Carry forward section 73. Carry forward period just 4 years. Set off only from speculative profits. Set off only from, there is a restriction to be followed even in carry forward also. It can be adjusted only from speculative business profits. And business continuity not necessary. Have you understood? Next. Specified business loss, section 35 AD. My dear student, there are 14 businesses covered in this section. So please go and verify section 35 AD. What are the businesses covered in section 35 AD? If any loss arose in those businesses, what will be the treatment? Specified business losses. Intersource adjustment, yes, available. Available. But there is a restriction. Set off against only from specified business profits. Only from specified business profits. Don't adjust against non-specified business. Okay. If not adjusted in intersource, then interhead facility not available. Then directly go to carry forward. Have you understood? Carry forward details. Section 73A. Carry forward period, you can carry forward for unlimited period, indefinite period. No limit for carry forward period. Have you understood? But set off only from specified business profits in carry forward period. Carry forward and set off only from specified business profits. Business continuity not necessary in such previous year in which you want to adjust during carry forward period. Okay. Simple. Next one. These are the unabsorbed expenses which are related to PGBP head of income. Unabsorbed expenses, unabsorbed depreciation, unabsorbed capital expenditure of scientific research, unabsorbed family planning expenditure. All these are related to PGBP. Yes, these expenses shall be eligible to set off against same PGBP head of income. Intersource adjustment available. Intersource is nothing but set off from PGBP head of income. Yes, can be adjusted. And it can be adjusted even against from other heads also. Interhead facility is also available. But here one thing you should remember, even in interhead adjustment, you can adjust from any head of income except salary and winnings. There is an exception. Except salary and winnings, you can adjust these unabsorbed expenses from house property, capital gains, other sources other than winnings. Okay. So if not adjusted, then carry forward facility is also available for unlimited period. Business continuity, set off from any head of income except salary and winnings. That's the unique provision. That's the unique benefit to these unabsorbed expenses. Even in carry forward also, you can adjust these unabsorbed expenses from any head of income except salary and winnings. Just like a first year treatment is to be followed in even in carry forward also. It can be adjusted from any head of income except salary and winnings. Have you understood? That's it. These are the details relating to pgbp. Next one, capital gain. Long-term capital gain, inter-source adjustment available, but there is a restriction. Only from long-term capital gain. Is nothing but long-term capital loss cannot be set off against short-term capital gain. Long-term loss can be adjusted only from long-term capital gain. No interhead facility. Carry forward facility is available 8 years only from long-term capital gain. That's it. Short-term capital loss set off from inter-source available, but can be adjusted from both long-term and short-term. No restriction here. You can use entire head of income, either long-term or short-term. That's the benefit, is more than the long-term capital loss. Okay, so interhead facility not available. Entire capital loss is not at all eligible for interhead adjustment, either long-term or short-term. No interhead facility to capital gain chapter. Carry forward facility is same, 8 years, capital gain, either long-term or short-term. Have you understood? Income from other sources, owning and maintaining resources, inter-source adjustment available, but only from such type of income. That is only from owning and maintaining resources. Okay, interhead facility not available. Carry forward section 74A, 4 years carry forward, only from such type of income. That is only from owning and maintaining resources income. Business continuity mandatory here. Okay, casual losses, example winnings. Interhead facility not available, inter-source facility not available, interhead not available, carry forward not available. So loss from winnings, card games, bettings, gambling, if given in the problem, simply ignore it. Ignore if given in the problem, because such loss is not at all eligible to set off, either in inter-source, interhead, carry forward also. Never adjust the loss from winnings against any other income. Okay, so and other losses, any other losses from other sources head, if available, then it can be adjusted from inter-source available, interhead available, no carry forward facility. Have you understood? These are the details of set off of losses from each head of income except salary, because salary doesn't have any loss. Okay, and I give you some important note points which are very important. Please be prepare those note points also along with this table, which are very important, which are useful to you while solving the problem. Okay. Okay. Some of the important note points relating to set off and carry forward. Okay. The first one is very important note point, has been asking frequently in examination. Around 2-3 times this point was covered in exams. Very important, which is also related to return of income chapter related concept. First of all, my dear students, if you want to carry forward any loss from any head of income, compulsory you need to file the loss return to the department within the due date specified under section 139 subsection. Okay, loss return must be filed within the due date. Not loss return must be filed to carry forward of any loss to subsequent. Otherwise, carry forward facility is not available. That's a very important point. What will be the consequence if assessee has not filed the loss return? Carry forward facility is not available to such loss. Okay, so coming to the point. So left side, this is the category 1, category 2. Category 1, what are the losses covered in category 1? PGBP losses, both speculative, non-speculative, unspecified. Capital losses, short term, long term. Owning and maintaining racehorses. For these losses, loss return compulsory filed within the due date under section 139 subsection 1. Otherwise, no carry forward facility for these losses. Okay, so must be filed. Loss return must be filed within the due date. That's the important point. For those losses covered in category 1, if you want to carry forward these losses, you have to file your loss return within the due date compulsory. But what about category 2? For category 2 losses, these two losses covered in category 2, house property, unabsorbed expenses. For these two losses can be carried forward even if loss return was filed within the due date. That is, even if loss return was filed lately, that is after the due date, you can carry forward these losses. Carry forward facility is available. Even if loss return was losses eligible for carry forward, even if loss return was filed after the due date, that is lately. Okay, that's a very important point, which is also useful for MCQ. The most important point. For category 2 losses, loss return may not be filed within the due date. Even if it was filed after the due date, you can carry forward these losses. For category 1 losses, compulsory need to file the loss return within the due date. Otherwise, no carry forward facility. Have you understood? Yeah. Fourth one. My dear students, one of the important note point here is exempted incomes related losses cannot be set off, cannot be carried forward. Simply ignore if given in the problem. Next, losses can be set off against the income clubbed in the hands of. Clubbed income is also eligible to set off losses. Okay. If more than one source available to set off of any loss, then you can adjust against any income whichever is beneficial to you. You can follow the beneficial method to minimize your tax liability. Partial set off is not, set off is mandatory. Set off is mandatory. First of all, the loss from one head of income must be adjusted in inter-source adjustment. Don't skip the inter-source and go for inter-head adjustment. Act says that if inter-source adjustment is not possible, then only go for inter-head adjustment. You have a no option. Even partial set off is also not acceptable. Okay. First, verify whether it will be adjusted against inter-source. If not, then go for inter-head. If not adjusted in inter-head adjustment, then go for carry forward. You don't have any option in this order of priority. Okay. So compulsory need to apply first inter-source provisions. If not adjusted in that, then go for inter-head. If not adjusted, then go for carry forward. And even partial set off is also not acceptable. You understood? Next one. Set off is also not possible against the income taxable under section 68-69, deemed incomes. Deemed incomes not at all utilized to set off of loss from any head of income. Okay, just like a winnings. Next, in capital gain chapter, no difference between 112 and 112A. Both the treatment for both are same. You can adjust any loss first. Okay. So these are the important note points relating to set off provisions. Begin our discussion with deductions from gross total income. Nothing but chapter 6 year deductions. This is also a very important chapter in examination point of view. Mainly this chapter will play very important role in total income problem. Okay, so don't neglect this chapter. It's very important. At least to prepare some important sections in this chapter mandatorily. Okay, so first of all, I give you some important fundamental points relating to chapter 6A deductions. Okay, so these are the main and most important points relating to chapter 6A deductions. My dear students, the first point is chapter 6A deductions are deductible from gross total income. But however, aggregate amount of chapter 6A deductions cannot exceed gross total income. Most important point, you never claim the deductions more than your gross total income. Okay, that's the important point. And no carry forward facilities to surplus deductions to subsequent year. Just ignore it. Okay, so no carry forward facility to chapter 6A deduction. That too also a very important point. No carry forward. And chapter 6A deductions in aggregate cannot exceed your gross total income. Okay, and the next one is most important point. Chapter 6A deductions are not deductible from these incomes. The most important point, not deductible from these incomes. So long-term capital gain under section 112, 112A, short-term capital gain under section 111A, casual income. From these incomes, you never claim the chapter 6A deductions. Okay, important note point. And third one is chapter 6A deductions are not available under default tax regime except three sections: 80CCD2, 80CCD CCH2, 80JJA. These three deductions are eligible to claim deduction even in default tax regime also. That is default and both opt-out tax regime. But except these sections, all other deductions are available only in optional tax regimes, but not available in default tax regime. Okay, these three sections are available in both default as well as optional taxes. Okay, so these are the important fundamental points relating to chapter 6A deduction. Okay, so let's go to the explanation of chapter 6A deductions. First section, I want to explain section number 80U. 80U says that, my dear students, this deduction is available only to resident individual. Eligible assessee to claim deduction under section 80U is resident individuals. No other person is eligible to claim deduction under this section. Okay, so what was the qualification to get this deduction? Is the assessee is nothing but the taxpayer, that is nothing but resident individual suffering with disability. The resident individuals who suffering with disability are only entitled to claim deduction under section 80U, suffering with disability. So one of the important point. So taxpayer is suffering with disability are only eligible to claim deduction under this section. That too, he must be a resident individual. What was the amount of deduction? So if disability is normal, 75,000. If disability is severe, 1,25,000. So deduction is depends upon a stage of disability. 80DD, next section, 80DD. So 80DD says that, my dear students, if assessee himself suffering with disability, then eligible under section 80U. But 80DD says that, assessee is maintaining any disabled person, then assessee is entitled to claim deduction under section 80DD. Here disability is to person who dependent on assessee. That's the important point. Dependent disabled person. Assessee, for example, assessee either individual or HUF. Who is not suffering with disability here? but the assessee is maintaining a dependent disabled person. A disabled person who was dependent on assessee. Dependent disabled person. For maintaining this person, the assessee is eligible to claim deduction under section 80DD. That's it. That's the difference between U and DD. Have you understood? So here there is no disability to assessee. Assessee is just maintaining a dependent disabled person. For maintaining such person, the assessee is entitled to claim deduction under this section 80DD. If assessee himself suffering with disability, then eligible under section 80. That's the difference between 80D, DD and 80U. Have you understood? And 80DD, some more points which are very important in section 80DD. So the dependent person must be covered in family definition. Otherwise, no deduction. The dependent person must be either spouse, children, parents, brothers and sisters. If any of these persons were dependent, who is suffering with disability and dependent on assessee, then only eligible for deduction. Otherwise, no deduction. Have you understood? The dependent person must be covered in this family definition. Otherwise, no deduction. Have you understood? Here also, amount of deduction is same as 80U. Same as 80U. That is, if it is a normal disability, the dependent person suffering with normal disability, 75,000. If it is a severe disability, 1.25 lakhs. Have you understood? That's the difference between DD and U. And in both the sections, the list of disabilities is same. Okay, please go and verify the list of disabilities. 80DDB. This section says that specified diseases specified in rule 11DD. Specified diseases. This is a section relating to the diseases. And one more important point, for disabilities, there are two sections. If assessee is suffering with disability, 80U. If dependent person suffering with disability, 80DD. But here, only one section which is applicable not only to assessee but also to dependent person. Have you understood? So 80DD available to resident individual or resident HUF. What was the qualification in this? Expenditure incurred for medical treatment of specified diseases covered in Rule 11DD. There are 6-7 diseases covered in that. Please go and verify the list. Okay. So the specified diseases in Rule 11DD, whatever the medical expenditure incurred for treatment of those diseases, either for himself or any of his dependent. Either for himself or any of it. If disease, the person suffering with disability is assessee himself, covered in this section. If a person suffering with disability is a dependent person, is also covered in this section. Here there is no specified separate sections for assessee and the dependent person, but for both same section is applicable. Okay, so what was the deduction to be claimed here is, if assessee, if a person person suffering with diseases, specified diseases is a less than or equal to 60 years, sorry, less than 60 years, the deduction is actual expenditure incurred for such medical treatment or 40,000, whichever is lower. Okay, so more than or equal to 60 years, actual expenditure, or 1 lakh, whichever is lower. That's the amount of deduction in this section. Here actual expenditure must be incurred, otherwise no deduction. But in previous two sections, even if no expenditure was incurred, the deduction will be allowed flat 75% or 1,25,000. But in this section, if you want to claim deduction, you must be incurred for medical treatment expenditure. Okay, have you understood? That's the important point. And one more important note point is, if any amount reimbursed by your employer or insurance company shall be deductible from amount of deduction. After claiming deduction, so the reimbursement amount, if any, either from your employer or from insurance company, shall be deducted from amount of deduction. The balance is only eligible for deduction under this section. Okay, reimbursement point is very important. Reimbursement. Okay, so and the next one, 80 GGB GGC. My dear students, these two sections are very small and important and easy sections also. Please do remember these two sections are also important. Contributions to political party. Same content covered in both the sections, but the difference is if donor is an Indian company, then 80 GGB. Any other person, 80 GGC. That's the difference between GGB and GGC. Eligible payment in these two sections is just contribute to political party or electoral trust. Your contribution is eligible for deduction under this section at the rate of 100%. 100% of your contribution is eligible for deduction in this. Have you understood? So, and one more, what was the eligible payment? Contribution to either political party or electoral trust. Contribution to political party or electoral trust eligible for deduction. Here also same, political party or electoral trust. If amount contributed by an Indian company, then eligible under section 80GC. Other than company, 80GGC. In both the sections, the amount of deduction is same, 100% of your contribution. But subject to two conditions, the party must be registered political party, important condition. And don't contribute the amount by way of cash, irrespective of amount. Compulsory, the payment must be made by any mode other than cash, otherwise no deduction. No deduction shall be allowed in respect of any sum contributed by way of cash. Irrespective of amount, any amount, if you want to contribute it, please contribute in any mode other than cash. Don't contribute in cash. If it was contributed in cash, then such contribution is not eligible for deduction. Have you understood? That's the important point. And my dear students, I want to say one note point relating to this. Expenditure incurred, advertisement expenditure relating to your business. Advertisement expenditure in any invitation, souvenir, pamphlets, calendars, brochures published by political party. Published by political party. Okay. Actually, this is a business advertisement, but section 37(2)(b) says that this will not be allowed as a business expenditure, but treated as donation to political party. Therefore, claimed in this section under section 80GCB. Have you understood? So, if such expenditure was incurred by an Indian company, then not allowed as business expenditure under PGBP head. Not allowed as deduction under the head PGBP, section 37(2)(b). Section 37(2)(b). Have you understood? But treated as this amount of advertisement expenditure shall be treated as donation to political party. 6-year deduction available under section 80 GGB. Okay. If it is an Indian company, it was not allowed as business expenditure as per section 37 subsection 2B, but it will be treated as a donation to political party, hence allowed under section 8 chapter 6 80 GGB. But if it is other than company, not allowed as deduction under the head PGBP. PGBP not allowed. Chapter 6A also not allowed. Completely ignored. Never claim deduction either in PGBP or in chapter 6A. Okay. Indian company is entitled to claim deduction under chapter 6A under section 80 GGB. Have you understood? That's the important point. Next one. 80E. So interest on education loan. My dear student, this is one of the triple star section. So 80DD important, DDB important, 80E important. I list out some important sections, A grade sections. You must prepare those sections at least. Okay, 80E, one of the important section. 80E is nothing but interest on education loan. Interest on education loan eligible under this section. Interest on education loan. How much amount is eligible for deduction? 100% of interest is eligible for deduction, but subject to some conditions. Condition number 1, the loan must be taken from financial institutions or charitable institutions. That's one of the important. Financial institutions or charitable institutions. Otherwise, no deduction. If you has taken loan from private lenders, family members, friends, no deduction. That's the one of the condition. And the loan must be taken for higher education. This is one of the condition. Have you understood? And another one is, these are the two conditions must be followed. And one of the important point is, what was the amount of deduction? 100% of interest is eligible for deduction. Principal repayment not eligible for deduction. Just ignore the principal amount. Just claim only interest. No deduction for principal amount. And how many number of years the deduction will be allowed? Total initial year of repayment of loan plus subsequent 7 years. Total 8 years will be allowed as deduction. If you are still paying the interest after 8 years, then no deduction. Okay. So total 8 years. You can claim deduction up to 8 years from the initial repayment of loan. Whenever the repayment was started, in that year the deduction will be allowed, from plus 7 subsequent years will be allowed. Total 8 years. Okay. That's the importance of this section. Okay. And the loan must be used for, education purpose of assessee himself or spouse or children or other student to whom the assessee is acting as a guardian. This is the family definition in this. So whenever family definition was given, please confine it. The deduction was confined only to those persons. Have you understood? This is all about section number 80, interest on education. Next one, 80EE, interest on housing loan. 80E series is totally related to interest. 80EE is also related to interest on housing loan. So eligible for deduction up to 50,000. Up to 50,000 is nothing but interest amount or 50,000. Whichever is lower is deductible. Have you understood? But subject to some condition. Condition number 1, the loan must be taken between these dates. Otherwise, no deduction. That is 1/4/16 to 31st March 17. That is 16/17. Second one is loan amount does not exceed 35 lakhs. And third one is value of house does not exceed 50 lakhs. Here conditions are very important. Loan sanction date must be in between 1/4/2016 to 31st March 2017. Loan amount does not exceed 35 lakhs. Value of house does not exceed 50 lakhs. All these conditions must be satisfied. The conjunction between each condition and. Okay. So here amount of deduction is, and one more important, the loan must be taken for purchase or construction of residential house property. Commercial property loans are not at all eligible under this section. And here also principal repayment not eligible. Principal repayment will be covered in section 80C. Here only interest is to be claimed as deduction. And what was the date of repayment? What was the period of deduction? Till the repayment, no restriction on period. That till the repayment of loan, the deduction will be allowed. So till the repayment of loan, that is no limit for period. You can claim any number of years, but subject to fulfillment of these conditions mandatory to be satisfied here. My dear students, important section. So next one, next section is also same interest on housing loan. Available only to individuals, these two sections. Here also interest on housing loan for acquisition of residential house. but the conditions were changed. Here the loan sanction date between 1/4/19 to 31st March 22. And the stamp duty value of house does not exceed 45 lakhs. The difference between previous section and this section, so the conditions were completely changed. Okay, so in fact this section is more important when compared to previous section. Please do concentrate on this, very important. And here also the deduction is available 1,50,000 up to. Here the deduction was increased to 1,50,000. Here also the deduction period of deduction is till the repayment of loan. No restriction for number of years. You can claim any number of years. Compulsory need to satisfy the conditions. In both the sections, a common condition is this is the first house. The assessee has not any house, not having any house at the time of sanction of loan other than this. That's the important part. This house must be the first house. Have you understood? Next one, 80 EE. EE also important. EEB. This is also an important section which was already asked in the examination. Okay, this is also an interest on loan for purchase of electric vehicle. That's the something different section. Subject to following conditions. The loan must be sanctioned between 1/4/19 to 31st March 23. Loan must be loan taken for electric purchase of electric vehicle up to 1,50,000. No limit for deduction of interest. No limit. So amount of deduction is available up to 1,50,000. That is amount of interest at 1,50,000, whichever is lower. But there is no restriction for number of years. You can claim any number of years. No limit for period of deduction. The two simple section. So easy to prepare. Anyway, my dear students, the conclusion is E series is totally interest related series. And 80E interest on education loan, 80EE interest on housing loan, 80EA also housing loan interest, EEB related to housing interest on electric vehicle loan. In all four sections, principal repayment is not at all eligible for deduction. Only interest is to be claimed. But conditions were changed in each section and amount of deduction is also different. Okay, but easy series, easy to prepare all these four sections, but important also in examination point. Have you understood? Next, my dear students, two most important sections will be discussed. They are going to start most important sections in this chapter, TTA, TTB. These two sections are very important. Don't neglect. Have you understood? So first of all, give you the details about TTA, TTB, 80 TTA, 80 TTB. First one is who eligible to claim these deductions as a C. First of all, 80 TTA is available to, most important point, 80 TTA is available to individuals or HUF. No age limit. Irrespective of residential status, whether resident or non-resident. Even non-residents are also eligible to claim deduction under this section. All individuals, irrespective of age and HUF. But 80 TTB is available to only resident individual more than or equal to 60 years. That is, no HUF was covered in section 80 TTB. HUF is not at all eligible to claim deduction under section 80 TTB. Only individuals, that too resident in India, that too more than or equal to 60 years. Less than 60 years aged persons were not covered in TTB. And non-residents not covered in TTB. TTB restricted, confined only to individuals being resident in India more than or equal to 60 years. That is resident senior citizens, resident very senior are only covered in TTB. That's the important point. The difference. Please be careful. Identify the importance. So important. Next one is eligible income. These are the income based deductions, my dear students. Income based deductions. So eligible income to claim deductions. Eligible income to claim these deductions are lastly received interest on savings account from interest on savings account from either banking company or cooperative society carrying banking business or post office. So from any of these area, if assessee received any interest on savings account, then such savings account interest is eligible to claim deduction under section 80 TTA. What about 80 TTB? Here also received interest on any account, either nothing but savings account or fixed deposits, whatever it is. All types of accounts were covered in 80 TTB. Okay, from same bank, cooperative society carrying banking business, post office. Okay, even fixed deposits were also covered in section TTB, but in 80 TTA confined only to savings account. That's the important point. Okay, received income from such income. First of all, such income was included in gross total income under the head income from income from other sources. Then only eligible to claim deduction in these sections. That's why these sections are called as income based deductions. That is, if your income contains this income of interest, then only you are eligible to claim deduction. Otherwise, no deduction. That's why these sections are called as income based deduction. Deduction based on income. Okay. Amount of deduction. The third point is amount of deduction. Up to 10,000. Up to 50,000. Up to is nothing but available interest or 10,000, whichever is low. Here, available interest or 50,000, whichever is lowest. These are the main points relating to TTA and TTB. Have you understood? And one more important, if resident senior citizen has claimed deduction under section 80 TTB, then he is not eligible to claim TTA. Dual benefits not available. Have you understood? That's the important point. Before claiming this deduction, compulsory to need to include such interest in gross total income under the head income from other sources. Then only eligible for deduction. Okay, important point. Next, both the sections are very important. So these are the eligible payments covered in section 80. I give you some important I list out some important points. Please keep in touch with those saving points. First one is LIC premium is very important. LIC premium, most valuable savings point and compulsory an important point in this entire list. And second one is PPF contribution, also another important point in this. And employees contribution to RPF, SPF, superannuation fund, employee contribution to superannuation fund, employee contribution to recognized provident fund, statutory provident fund, except URPF. URPF is not at all eligible for deduction. And next one is important point, NSC certificates. invested in NSA certificates eligible under section 80C. And the next one is tuition fee subject to some conditions, maximum 2 children, full-time education within India, and housing loan principal amount eligible under section 80C, and fixed deposits either in banks or post office, 5 years fixed deposit, 5 years time deposit, bank or post office. Sukanya Samriddhi, sorry, ULIP, unit linked insurance plan. ULIP point is also very important. So I think these are the important points. Please keep in touch with these points. You can prepare more number of points. So important points. Of course, even more number of points were covered in this section. Aggregate deduction cannot exceed 1,50,000. Don't claim more than 1,50,000 as deduction under this. Restricted to 1,50,000 in aggregate. Have you understood? And I'll explain one of the note point relating to LIC premium. My dear student, there is a restriction of 80C deduction for LIC premium. So if policy has taken before 1/4/2012, deduction cannot exceed 20% of sum assured. If policy has taken in previous year 12/13, then deduction cannot exceed 10%. If policy has taken on or after 1/4/2013, then for disabled person 15%, for all other person 10%. Classification is required. If date of policy on or after 1/4/2013, for disabled person deduction cannot exceed 15%, for all other person 10%. Okay, so this is one of the important note point for this section. Okay, please be prepared very carefully, and very important section 80C, the most important section in this chapter. Okay, so this is one of the important condition applicable to LIC premium. Okay, mutual fund investment is also eligible under section 80C. That's also another important point. Contribution to mutual fund UTI. Mutual fund UTI, that's the 12th point. Sorry, 12th point is very important. And yeah, these are the main points relating to 80C section. Okay, so my dear students, most important points in this section is maximum deduction in aggregate cannot exceed 1,50,000. That's the important 1,50,000. That's the important point. Deduction is restricted to individuals HUF, whether resident or not. Okay, so and the next one is 80CCC. Only one payment covered in this section, that is contribution to annuity plan. Contribution to annuity plan of LIC or any other insurance company. Annuity plan is nothing but pension plan of LIC or any other insurance company. Maximum deduction in this section cannot exceed 1,50,000. Okay, only one contribution covered in this section, that is contribution to annuity plan or pension plan of LIC or even any other insurance company approved by IRDA for receiving pension in future. Such contribution is eligible for deduction under section 80CCC. Okay, but maximum deduction in this section cannot exceed 1,50,000. Have you understood? My dear students, next section 80CCD is nothing but contribution to central government pension plan. So if you have contributed any amount to central government pension plan, simply called as notified pension scheme of central government. Okay, so central government pension plan contribution is eligible for deduction under this section. Okay, so deduction is available individuals, only to individuals, whether salaried employee or even self-employees also eligible to claim deduction under this. The thing you have to make is just contribute to NPS. Then you are eligible automatically to claim deduction under this section. So what was the amount of deduction? That's the important area, amount of deduction. Here deduction is available both to salaried employees as well as self-employees. For salaried employee, so I think you know very well, salaried employees, the contributions made by not only the employee but also to employee. There is a matching contribution involved in salaried employees. So have you understood? So, but in self-employee contribution, only one contribution is there, no matching contribution. Okay. So for salaried employees, both the parties must be contributed, employer contribution as well as employee contribution. Have you understood? Employed contribution eligible under section 80 CCD 2. Employee contribution eligible under section 80 CCD 1. So what was the limit to claim deduction under this section? So employed contribution, if the employed being government, either central government or state government, maximum deduction cannot exceed 14% of salary. Okay. If employed being any person other than government, then 10% of salary is the limit. Here the salary is equal to basic plus DA forming part. Salary for this purpose is equal to basic salary plus DA forming part to be considered. Employer being government, maximum deduction cannot exceed 14% of salary. That means actual contribution or 14% of salary, whichever is lower. If employed being any person other than government, then maximum deduction cannot exceed 10% of salary. Okay. So self-employee contribution eligible under section 80 CCD 1, maximum deduction cannot exceed 20% of gross total income because he is not having salary set. So actual contribution or 20% of gross total income, whichever is lower, to be considered as deduction. This is the amount of deduction. Have you understood? Salaried employees, employed contribution eligible under section 80 CCD 2, employee contribution eligible under section 80 CCD 1. Self-employees, only one contribution is there, that too eligible for deduction under section 80 CCD. And one more important point, in addition to 80 CCD 1, there is a section called 80 CCD 1B. This section says that in addition to 80 CCD 1, if you have any surplus contribution, out of that surplus contribution, you can claim up to 50,000 under this section. 50,000, additional deduction of 50,000. Up to 50,000. My dear students, one thing you should remember here, you can claim first 80 CCD 1B also. So that is, you have an option either to claim first 80 CCD 1, then claim 80 CCD 1B, or first claim 80 CCD 1B, then claim 80 CCD 1, whichever is beneficial to you. Okay. So need not claim first always 80 CCD 1. Usually option given to you, 1 or 1B, whichever is beneficial to you. Have you understood? 80 CCD 1B says that an additional deduction of up to 50,000 available. That's the important point. Have you understood? That's it. So this is the main. And one more important point, employer contribution shall be first included in salary set, then only eligible for deduction. Because here contribution made by employer, but it will be received by employee in future. Therefore, that should be treated as benefit provided by employer to employee. That will be treated as salary income. First included in salary set, then only eligible for deduction. Employee contribution need not be included in salary income. You can claim deduction directly. Okay. Self contribution is also, you can claim directly deduction. So this is the important information relating to 80 CCD. It's all about 80 CCD. Eligible as an individual, whether salaried or self-employed. Eligible payment, contribution to NPS. Amount of deduction is very important. Deduction is available not only to salaried employees, but also to self-employees. Okay. Next. My dear students, this is one of the section. Actually, this is not a deduction. This is a concept discussed by section 80 CCE. It says that generally there is a limit in section 80C, 1,50,000 maximum. There is a limit in 80 triple C also, 1,50,000. There is a limit in 80 CCD also, up to 14% of salary or 10% of salary or 20% of gross total income. There are individual limits of each section, but this section says that overall deduction under section 80C, 80 triple C, 80 CCD, subsection 1. The most important point, 80C, 80 triple C, 80 CCD, subsection 1. Subsection 1 deals with employee contribution or self-employee contribution, whatever it is. These three deductions in aggregate cannot exceed 1,50,000. That's an unfavorable section to the assessee. What? Next section, CCH. So, and one more important point I want to say. So, 80 CCD subsection 2. 80 CCD subsection 2 available in both the tax regimes, default and opt-out. But 80 CCD 1 and 1B available only in default tax regime. Have you understood? That's the important observation here. Default, optional. 80 CCD 1 only, not available in default, available in optional. 80 CCD 1B same, not available in default tax regime, available in optional tax regime. 80 CCD 2, that is employed contribution, that should be allowed in both default as well as optional. That's the important observation here. Okay, next. My dear student, this is a time consuming section 80D, but very, very important section after 80C. The most important section after 80C is 80D. Must prepare. Okay, so I'll give you simplified information about this. These are the 4 payments covered in this section. Medical insurance premium, preventive health checkup contribution, contribution to central government health scheme or similar health scheme of the state government, and the medical expenditure of senior citizens, very senior citizens. These 4 payments were covered in this section under section 80D. Have you understood? So, what the amount eligible for deduction under this section? This is the very important table. Amount of deduction under section 80D. 80D, deduction under section 80D. My dear student, this section is available not only to individual but also to HUF. Available individual, HUF also. And one more important point, individual classified into 2 parts. Individual himself, assessee, plus spouse, plus dependent children and the parents. HUF including members. Okay, amount of deduction under section 80D. The first payment eligible under this section is medical insurance premium. For these 3 persons, eligible only 25,000. If a person is a senior citizen, then you can claim 50,000 instead of 25,000. If such person is a senior citizen, additional benefit of 50,000 is available only to senior citizens, more than or equal to 60. Okay, and for parents also, individual is having a separate benefit if payment made to parents. Parents 25,000. If they are senior citizens, 50,000. HUF including all the members, the deduction is restricted to 25,000. In case of seniors, 50,000. Okay, so preventive health checkup contribution is also same. And one more important point, preventive health checkup, central government health scheme. Same calculation. Preventive health checkup contribution cannot exceed 5,000. For parents also cannot exceed 5,000. No deduction for this to HUF. Okay. And one more important point, aggregate of preventive health checkup, including parents, cannot exceed 5,000. If assessee himself claimed 4,000 as deduction for preventive health checkup, then the parents are eligible to claim. Per parents eligible to claim only 1,000. Because aggregate cannot exceed 5,000. That's the important point. And medical expenditure of senior citizens, very senior citizen, cannot exceed 50,000. 50,000. 50,000. Have you understood? And one more important point here is overall deduction is also cannot exceed 25,000. In case of senior citizen, 50,000. For parents also same, 25,000 or 50,000. HUF also same, 25,000 or 50,000. These two will be eligible to claim for individuals. Individual including parents cannot exceed. So either 25 plus 25, 25 plus 50, 50 plus 50. Maximum deduction to reach for individual 1 lakh. Okay. I think students 80D is most important. Please compulsory, if you get full clarity relating to 80D, compulsory you must solve a problem relating to 80D. Okay, these are the individual limits and this is the overall limit. And one more important point, medical expenditure is eligible for deduction only if on such person the assessee has not taken any medical insurance policy. If medical insurance policy is there relating to such person, then medical expenditure of such person is not eligible to claim deduction under this section. First payment and last payment are mutually exclusive. If you have claimed medical insurance premium as deduction under this section, then you are not eligible to claim medical expenditure as deduction under this section. That's the important. Okay. Preventive health checkup contribution of individual including parents cannot exceed 5%. Overall deduction. Okay. And mode of payment, this is one of the important mode of payment for preventive health checkup payment can be made in any mode, including cash. You can claim deduction. But there is no restriction for mode of payment for preventive health checkup. Even if payment was made in cash, you can claim deduction, no issue. But for all other payments, the payment must be made by any mode other than cash. Otherwise, no deduction. Okay, that's the important point. And lastly, 80G. 80G is nothing but one more important section, donations related section. Donations other than those covered in 80 GGB, GGC, donations to political party, and GGA, research activities, urban rural development. So this one is very important even when compared to GGB, GGC, GGA. So donations, around 30 total 35 payments were covered in this. Please go through section 80G. What are the payments covered in that section? I was not listed out here. Okay. Total 35 payments were covered in this. Deduction is available to any person. Any person can make the donation. Deduction to be claimed. No issue. Okay. But this 35 payments were classified as 4 categories. 24 payments in category 1, 4 payments in category 2, 2 payments in category 3, 5 payments in category 4. Total 35. How these payments were categorized? The purpose. So I give you deduction of donations covered in each and every category. Okay. So category 1, total 24 payments. Category 1, total 24 payments. Limit for payment. So for category 1, for 24 payments covered in category 1, there is no limit for payment. You can make any amount for these payments, no limit in the act. You can made any amount of payment, no limit for payment. Deduction is also 100% at the rate of 100%. Whatever the payment you made, you can claim entire amount as deduction. That's the importance of category 1. Have you understood? No limit for payment. Entire payment is eligible for deduction. If you contributed 1 lakh, entire 1 lakh is eligible. If you contributed 1 crore, entire 1 crore is eligible. No issue. Okay. So next, category 2. Category 2, 5 payments. Here also no limit for payment. You can make any amount, no issue. But deduction is restricted to 50%. 50% of amount contributed is only eligible for deduction for those payments covered in this category. Have you understood? Next, category 3 and 4. The most important area is category 3, 2 payments. Category 4, 5 payments. Around 6 payments, 5 payments. Sorry, in category 2, only 4 payments. Category 3, 2 payments. Category 4, 5 payments. And here, for category 3 and category 4 payments in aggregate, there is a limit for payment. You cannot make any amount to these categories. There is a limit in the act. That is aggregate of these 7 payments. Aggregate of these 7 payments cannot exceed 10% of your adjusted total income. Aggregate of 7 payments cannot exceed 10% of your adjusted total income. That's the important point. Aggregate of these 7 payments shall be compared with 10% of your adjusted total income, and whichever is lower to be claimed, to be considered for calculating the deduction. Payment is restricted to 10% of adjusted total income. Okay. After restriction of these payments to 10% of adjusted total income, then claim deduction. While claiming deduction, but category 3 at the rate of 100%. Category 4 at the rate of 50%. So you need to solve at least one problem to better understand this last presentation, that is category 3, category 4. Aggregate amount of donation of category 3 and 4. For example, aggregate of these 7 payments around 2 lakhs is there, but 10% of my adjusted total income is only 1,20,000. Therefore, don't claim deduction for entire 2 lakhs. First, it will be restricted to 1,20,000 because payment 2 lakhs, 10% of my adjusted total income 1.2 lakh, whichever is lower. That is restriction. Then only claim deduction for 1,20,000. Restricted amount 1,20,000. You can claim deduction only to 1,20,000. In that 1,20,000, we have category 3 payments as well as 4 payments. For 3 payments, you can claim 100%. For 4 payments, you can claim 50%. That's the presentation. While claiming deduction under section 80G, please be concentrate in category 3 and 4 payment. Very important. Okay. First, restrict the amount paid for these 7 donations to 10% of adjusted total income. Then claim deduction to such restricted amount. If it is a 4th category, 100%. If it is a 3rd category, 50%. Whichever is beneficial to you. You can claim whichever is beneficial to you, either 3rd or 4th. 3rd is a beneficial because 100% deduction is there. Okay. And what was the adjusted total income? Adjusted total income is From gross total income, exclude these amounts. Long term 112, 112A, short term 111A, and all chapter 6A deduction except 80G. From gross total income, reduce all these amounts, then the resultant amount is the adjusted total income. Okay, students, the next chapter is total income. Okay, total income, alternatively called as taxable income or net income. You can use any of these words. Okay, identify the heads of income involved. Identify the heads involved in that problem and calculate the income from each head in a separate working note. Calculate the income from each head in a separate working note. And fill up the total income statement. Okay, then okay, total income statement is nothing but aggregate of 5 heads. Then we'll get gross total income. Then reduce chapter 6A deduction. Then we'll get net income. This is the total income statement. That is the main answer. Okay, that's the important work to be made by students while solving the total income. And one more important point. There was a point which was discussed in chapter 6A deduction. Such point will be useful to you in this total income chapter. So while claiming chapter 6A deductions, some of the incomes are not eligible to claim chapter 6. That's the important point. Long term capital gain 112, 112A, short term capital gain 111A, and winnings. From these incomes, don't claim total income. Sorry, don't claim chapter 6A deduction. That's the important point. Second point, 6A deductions are not to be claimed from the following incomes. The first one is long term capital gain under section 112, 112A. Short term capital gain under section 111A. Winnings. And one more important point to be followed by the students while claiming basic exemption 2.5 lakhs, 3 lakhs, 5 lakhs, which was already discussed at the beginning, introduction chapter. Basic exemption limit to be claimed first against other incomes, then only claimed against capital gain, long term or short term 111A. Basic exemption limit shall be claimed first against other income. Then unexhausted basic exemption limit after claiming against other income, the balance basic exemption, if any, shall be deductible from long term capital gain and short term capital gain under section 111. The conclusion is don't claim the basic exemption first against capital gain. First of all, claim against other income. If other income is not sufficient, that the balance basic exemption, that to be called as unexhausted basic exemption, shall be claimed from capital gain. That's the one of the important point. Have you understood? And another important point is, if assessee is having agricultural income in addition to non-agricultural income, because non-agricultural income is nothing but heads, not only the heads but also the agricultural income, then need to calculate tax liability by using aggregation method. Okay, so important, if assessee is having agricultural income and non-agricultural income, then tax liability shall be calculated by using aggregation method. Okay, so that's the important point. If problem contains not only the agricultural income but also not only the non-agricultural income, is nothing but heads, but also agricultural income, then need to calculate the tax liability by using aggregation method. What was the aggregation method? This is a separate method to be followed for calculating the tax liability. Okay, so what was the aggregation method? Aggregation method. Step 1, calculate tax on aggregate value of agricultural income plus non-agricultural income. That's the first step. Tax on, calculate tax on aggregate value of agricultural plus non-agricultural income. Have you understood? That was the step 1 while calculating the aggregation method. And step 2, calculate the tax on aggregate value of agricultural income plus basic exemption limit. Calculate the tax on agricultural income plus basic exemption limit, that is aggregate value of agricultural income and basic exemption limit. Have you understood? Step 1, step 2. Step 3. Step 1 minus step 2. That's the net tax payable plus adjust, surcharge, education cess, rebate, whatever applicable in step 3. Okay, so ultimate answer is tax liability step 1 minus step 2 plus or minus whatever applicable, surcharge or rebate, plus cess. This is the tax liability, ultimate tax liability. And one more important point, this method is applicable subject to some condition. Condition number 1, minimum agricultural income exceed 5,000, then only this method to be followed. Non-agricultural income exceed basic exemption, then only this method to be followed. These are the two conditions must be followed. Agricultural income exceed 5,000, non-agricultural income exceed basic exemption, then only you can use the aggregation method. That's the conditions to be followed. And this method is not applicable to persons or incomes liable to pay tax at flat rates, that is companies, partnership, firm, etc. Those persons need not follow the aggregation method. They can calculate directly tax on non-agricultural income, are liable to pay tax at flat rates. Okay, so conditions to follow this method is condition 1, agricultural income exceed 5,000. Otherwise, no need to follow this method. And non-agricultural income exceed basic exemption. Otherwise, no need to follow this method. You can calculate directly on non-agricultural income. If this method is not applicable, then you can calculate the tax liability directly on non-agricultural. Ignore the agricultural income and put a note pointer. It's an exempt under section 10(1). Have you understood? Okay, this is the aggregation method of calculation. Compulsory need to follow this method if associate is having agricultural income plus non-agricultural income. And one more important point, my dear students, please observe carefully the total income. What was the question asked in total income problem? Observe the question mark, most important. If question contains, if they asked to calculate the tax liability in most beneficial method, then you need to answer that question in both default as well as optional taxes. Whenever they ask to calculate the tax liability under in most beneficial method, whenever the word used beneficial method, then you need to answer the question compulsory in two methods, default and optional tax rate. Otherwise, you can't get full marks. Okay. If your total income problem contains any of these sections, special economic zone related section 10AA, 35 AD, chapter 6 heading C. Okay, so then you need to follow, while calculating the total income, need to apply AMT concept also. Apply AMT. Otherwise, you can't get full marks. Need to solve that problem in normal tax liability and AMT. Then beneficial, whichever is beneficial, and what is your tax liability. I'll discuss the concept relating to AMT. Just wait. Okay. So how to calculate the AMT? Just wait. But compulsory you need to apply AMT concept. So first one is 10AA. This is one of the important section. So special economic zone related deduction under section 10AA. Okay. Second one is AMT, which is also very important. The third one is composite activities. Okay. First of all, let's begin our discussion with deduction under section 10AA. So I give you brief information about 10AA, that very important in each and every attempt. So expect at least one question from these three topics. Okay. So first of all, 10AA. 10AA is available to any person who started an undertaking in special economic zone, and the goods or services produced in special economic zone shall be exported to outside India, and the turnover related and the profit relating to such export turnover is only eligible for deduction under this section. Okay, so that's the important information about 10AA. So first of all, Mr. X started an undertaking in special economic zone. sorry, a business or an undertaking, whatever it is. My dear students, very important observation here is, so 10AA is available not only to the manufacturer but also to service provider. Okay, so to get this benefit, need to establish an undertaking or a unit in special economic zone, and the goods manufactured, the goods or services, whatever it is, manufactured shall be exported. And 10A says that whatever the profit on these exports will be eligible for deduction under section 10A. Profit relating to export turnover. Okay, it's eligible for deduction under section 10A. Okay, this is the very important information relating to 10AA. So if you want to claim deduction under section 10AA, you need to start an establishment or a unit in special economic zone, and whatever the goods manufactured in special economic zone shall be exported to other countries, and whatever the profit earned relating to such exports shall be eligible for deduction under section 10A. Okay, export profit is only eligible for deduction under section 10A. My dear students, so go through section 10AA. This deduction is available subject to some condition. I don't want to explain each and every point, so due to time constraint. This is the overview of section 10AA. Okay, so 10AA is available not only the manufacturing sector but also to service sector. Okay, so and one more important point here is, what is the amount of deduction in 10AA? Deduction under section 10AA. This is the main point. My dear student, deduction under section 10AA is available for 15 years. Have you understood? Most important point. For 15 years, you will get the benefit under this section for 15 years. Okay, so how much amount of deduction is available? So I'll give you, this is the most important point in that section. First 5 years. First 5 years. %100% of profit relating to export turnover is eligible for deduction. Have you understood? 100% of profit. First 5 years. Next 5 years is nothing but 6 to 10. Next 5 years, last 5 years. The benefit under this section is available for 15 years. Okay, what was the amount of deduction under this section? For first 5 years, the deduction is 100% of profit relating to export turnover. Okay, first calculate the profit relating to export turnover and claim deduction at the rate of 100%. Next one, next 5 years, 50% of profit relating to export turnover. 50% of profit relating to export turnover. Okay, and last 5 years, here also 50% of profit relating to export turnover, but subject to a condition, the profit must be deposited in special economic zone reinvestment reserve account. If you only deposit in such account, then only you are eligible for deduction under this for last 5 years. Deposit not required for first 10 years. But in last 5 years, the deposit must be made within the time limit. And one more important point, 50% of profits relating to export turnover or amount deposited in special economic zone reinvestment reserve account, amount credited to special economic zone reinvestment reserve account, whichever is lower. This is the deduction for last 5 years. If assessee has not made any deposit, then no deduction for last 5 years. The deposit is not necessary for first 5 years and the next 5 years. It is required if you want to claim deduction in last 5 years, that is 11 to 15 years. Compulsory, you need to deposit the profits in special economic zone reinvestment reserve account. Otherwise, no deduction. Have you understood? This is the important information relating to 10A. Okay. And what is export turnover? Export turnover is the most important definition in this. Export turnover is nothing but consideration for exports. Consideration for exports. Consideration for export, either received in India, received in India, and are received outside India but brought into India. That's the important. Received outside India but brought into India. Brought to India within 6 months or such extended period by RBI. Have you understood? That's the important point. This is the definition of export turnover. It's a very important definition. So, received outside India shall be treated as export turnover subject to a condition. That is, the amount must be brought to India in convertible foreign exchange. If not brought to India within this time limit, then such turnover is not at all treated as a export turnover. Have you understood? That's the important point. And one more important point. For example, exports related, export consideration, $100 crores. 100 crores is the export consideration. Out of that, received in India 40 crores. Received outside India 60 crores. Okay. So received outside India 60 crores, but brought to India within the time limit only 30 crores. 30 crores brought to India. Within the time limit. Balance 30 crores not at all brought to India. Not yet brought to India. remaining 30 crores. Therefore, the export turnover here is only 40 plus 30, 70 crores. This amount will not be considered as an export turnover because it was not brought to India within the time. Have you understood? It's AMT. AMT is also very important concept. AMT is nothing but alternative minimum tax. Okay. So applicable to all assessees other than companies, because the MAT concept is there, which is exclusively for company assessees. So that AMT concept is not applicable to companies, except that all other persons, this concept will be applied to all other persons. So first point, applicable to all assessees except companies. This is one of the important. And second one is, this concept is and one of the important condition to be satisfied for attracting this concept, that is the adjusted total income. The adjusted total income of assessee does not exceed 20 crores, then AMT concept does not attract. Not applicable in the following cases. AMT is not required to pay in the following cases. One of the cases under default tax regime. That is one of the important. Okay. B, under optional tax regime to cooperative society. Under section 115 BAD. 115 BAE. So cooperative society also not liable to pay AMT if it opted section 115 BAD or 115 BAE. Okay. Under section 115 BAC. And one more important point, not applicable if adjusted total income does not exceed 20 crores. If adjusted total income less than or equal to, and one of the important point, so this condition is not applicable to partnership firm. For partnership firm, AMT will apply always irrespective of adjusted total income, except partnership firm. Last point is not applicable to, this will not apply to partnership firm. Okay. So AMT concept is applicable to partnership firm always, irrespective of adjusted total income. For all other persons, compulsory AMT concept is applicable if adjusted total income exceeds 20 crores. Otherwise, no need. These are the important points. Now, what was the AMT? The main provision says that what the 115, what the AMT concept says that. One of the important point, main provision. And one of the important point, applicable to all assessees except companies. And one more important point, the assessee is eligible to claim either section 35 AD eligibility. That is one of the important point. Eligibility, one of the condition for applicability of this section. The assessee is entitled to claim deduction under section 35 AD 10 AA chapter 6A heading C. Okay, they are only eligible to pay AMT if required. So this is one of the important point condition. If assessee is not having deduction of any of these sections, then no need to pay AMT. AMT is applicable only to those persons who are required to claim deductions under section 35 AD 10 AA chapter 6A heading C. Okay. So one of the important, what was the provision says that? So fourth one and the main point. Act says that if your tax liability, if your actual tax liability is less than AMT, then you are liable to pay AMT to the government. That's the main provision relating to AMT. Okay. First of all, you need to calculate tax liability in two types. One is calculate the actual tax liability after on total income after claiming these deductions, and calculate again the tax liability on adjusted total income at the rate of 15%, 18.5%, 18.5% for all other persons, 15% for cooperative society. There are two AMT rates are there. Okay. So Act says that calculate the tax liability. Step 1, calculate tax liability on total income, on actual total income, that is after claiming above mentioned benefits, that is 35 AD 10 AA chapter 6 AD, whatever it is, whatever applicable to you. So calculate the tax liability on total income after claiming above mentioned deductions. By using normal tax rates. Okay. So, and second step is very important. Step 2, calculate the AMT. Actual tax liability calculate in step 1, calculate the AMT in step 2. AMT, how to calculate the AMT? Tax liability on adjusted total income. How to arrive adjusted total income? So just give you the details about adjusted total income. Just wait. Calculate the tax liability on adjusted total income by using the rate of 18.5% or 15%, whatever it is. For cooperative society, it's 15%. For all other persons, it's 18.5%. This will be the AMT. So, calculate the tax liability on actual income after claiming the above mentioned deductions in step 1. Calculate the AMT in step 2. How to calculate the AMT? Calculate the tax liability on adjusted total income by using the rate of 18.5% or 15%, whatever it is. If you are a cooperative society, then use 15%. For all other persons, 18.5%. Then compare the tax liabilities calculated in step 1 and step 2. Compare. Then conclude that. What the conclusion here is, if AMT is more than actual tax liability, actual or normal or regular, whatever it is, you can use any of these words, either actual tax liability or normal tax liability or regular tax liability. You can use any of these three words, no issue. if AMT is more than actual tax liability, then AMT is payable to the government. Okay, have you understood? And but the excess amount paid to be claimed as credit. In subsequent years. That's the main provision relating to AMT. So calculate the tax liability in step 1, actual tax liability. Step 2, AMT. Compare both the tax liabilities and conclude that if AMT is more than the actual tax liability, then you need to pay AMT to the government. After that, whatever the amount paid excess, then such excess amount shall be claimed as credit in subsequent. The government will give you the credit of excess payment made in subsequent 15 years. The credit period is 15 assessment. Have you understood? This is the main part relating to this section. Okay, and give you some other points relating to AMT. For example, if your actual tax liability, AMT. If your actual tax liability in year 1, actual tax liability is 14 lakhs, AMT is 20 lakhs, then Act says that you are required to pay amount payable to the government is you are required to pay tax to the government is AMT. Now you are liable to pay AMT to the government, that is 20 lakhs. But the excess amount paid, that is actual tax liability is 14 lakhs, but you paid 20 lakhs. Therefore, the excess amount paid to the government is 6 lakhs. The 6 lakhs will be AMT credit given to you in subsequent years. Credit, AMT credit. Credit balance in your account is 6 lakhs. This will be claimed in further years. Okay, that's the important part. In year 2, again your tax liability is 20 lakhs, AMT is 22 lakhs. Here also the AMT is more than the actual tax liability. Then here also you are required to pay AMT to the government, 22 lakhs. Then what was your credit amount? Last year credit 6 lakhs, current year credit 2 lakhs. Total 8 lakhs credit is there in your account. Okay, and the third year, your actual tax liability is 23 lakhs, AMT is 28 lakhs. Here also AMT is more than the actual tax liability. Compulsory here also you are required to pay tax to the government is AMT, that is 28 lakhs. What was the credit amount in your account? First year credit 6 lakhs, second year credit 2 lakhs, third year credit 5 lakhs. This will be the procedure to be followed. The credit period is 15 years. But when this credit amount shall be adjusted, that's the important. Credit amount shall be adjusted whenever the actual tax liability is more than the AMT. Then the surplus amount to be utilized for claim of credit. Okay, give you an example. For example, fourth year, your actual tax liability is 30 lakhs. AMT is just 20 lakhs. Now tell me, what is your tax liability? What the amount you have to pay to the government here is, you are required to pay only 20 lakhs to the government. Only 20 lakhs. But what about remaining surplus tax liability 10 lakhs? This will be utilized for claiming credit of our balance. Okay, this will be utilized for 6 lakhs, 2 lakhs, 2 lakhs. Okay, this was claimed, the credit was completed, credit was taken. This amount was also taken as credit. Out of this amount, 2 lakhs was credit as taken as credit. The balance 3 lakhs to be carried forward to next year. In next year, what was our credit balance? 3 lakhs only, because 6 lakhs and 2 lakhs was already adjusted from surplus amount. Surplus amount is nothing but whenever the actual tax liability is more than the AMT, then only the credit can be adjusted. Okay, have you understood? That's the important. Okay, and what was the next year? I conclude that in next year, for example, 5th year, your actual tax liability is 32 lakhs. AMT is 35 lakhs. Now tell me again, what is your tax liability? Amount payable to the government is AMT is more than the actual tax liability. Therefore, need to pay AMT to the government, that is 35 lakhs. What was the credit balance in your account? So 3 lakhs, and current year credit balance is 3 lakhs. Total 6 lakhs is the credit balance in your account. Have you understood? This is the procedure for computation of AMT. The AMT concept is applicable subject to some condition. I think you understood well about the AMT concept. But AMT concept is very important in examination point of view. No interest is payable on AMT credit by the government. That's the one of the important 1 mark bit. AMT applicable subject to some condition. One is you are eligible to claim deductions either in section 35 AD or 10 AA or chapter 6 heading C. Then only the concept of AMT gets attracted. And your adjusted total income exceed 20 lakhs. But this condition is not applicable to partnership. Have you understood? My dear student, one more important topic in exemptions chapter is composite activities. Composite activities is nothing but the activity involved not only the agricultural income but also the business income. So there are 3 activities which were recognized by the government as composite activities: tea, coffee, rubber. Okay, so these are the percentages given here. Need to follow the same percentages while apportionment of income. So as agricultural and business. Okay, so what was the percentages given here? Growing and manufacturing tea. Out of the total income, 60% shall be taken as agricultural, 40% shall be taken as business income. So coffee, grown and cured, unsold, then out of total income, 75% shall be treated as agricultural, 25% shall be treated as business income. And roasted and grounded also added, then sold, then the percentage will be changed as 60%, 40%. Okay, for rubber, 65% and 35%. These are the percentages to be followed as it is. Okay, my dear students, when these percentages will apply, that's the important point. My dear students, please read these 2 lines, very important. Act says that first compute the income. First compute the income as if such activity is totally business activity by using the PGBP provisions. Thereafter, the resultant income shall be apportioned between agricultural and business based on these ratios. Okay, first compute the income as if entire activity is a business activity by applying PGBP provisions. Thereafter, apply these percentages for allocating the income between agricultural and business. Have you understood? That's the information given to you. Shall be first calculated as if such activity is a business activity. Therefore, need to apply PGBP provisions and compute the profit. After that, it will be apportioned. So, thereafter, apportion the income in the following manner. Okay. And one more important point here is, students, in these composite activities, if you want to calculate tax liability, you need to follow aggregation method as it was already discussed in total income. Okay, need to follow aggregation method of tax calculation. So compulsory, because the income includes not only the agricultural but also business. It's nothing but non-agriculture. That's the important. Okay. And one more important point here is point number 2. So very important point here is, so is there any composition made in any other activity other than recognized? Is nothing but other than tea, coffee, rubber. For example, associate is having a rice mill, and associate also having agricultural lands. He cultivating paddy, and the paddy cultivated by him will be brought into his business and converted into rice and sold in open market. Actually, this transaction is also involved composite activity, but there is no specific percentages was provided in the act. But here, how to calculate the agricultural income, business income? Okay, this is also very important in exam point of view. Please be prepared at least one example for this. Okay, I'll explain some sections only, Amma. Don't expect each and every section. It's a time consuming. It will take just 1 hour or 1.5 hours for this chapter. So first of all, I observe the headings. Subheadings is very important. Section number, payment. Payment is nothing but on that payment, this section gets attracted. Okay. On which payment this section says to make TDS. That's the important point. 192 says that TDS shall be made from salary payment. Salary is subject to TDS under section 192. Okay. And threshold limit. Threshold limit is nothing but exemption limit. Exemption limit is nothing but TDS provisions applicable if the payment exceed the limit specified in this column. Otherwise, no need to make TDS. Okay, if no amount specified in this column, then every payment is subject to TDS irrespective of amount. That is exemption from TDS up to that limit. If your payment exceed that limit, then you need to make TDS on such payment. Otherwise, no need. In some sections, if your payment is more than or equal to such limit, then you can make the TDS. Otherwise, no need. So threshold limit is nothing but exemption limit from TDS. Okay, I'll explain, just wait. Then payer, who is liable to make TDS? Payer column. Next, recipient. Payee is alternatively called as recipient. Recipient or payee, same. Payer alternatively called as deductor. Deductor. And rate of TDS. While making TDS, you need to follow the rate specified in this column. That's it. And time of deduction. TDS shall be made when TDS shall be made. That is time of deduction. Just like a point of taxation in GST. The time where the payer is required to make TDS. That's the time of deduction, is nothing but when. Last one, exceptions. In some cases, such section will not be applied. Is nothing but no need to make TDS in those cases. Okay. So if your transaction was covered in exceptions list, then you are not required to make TDS. That's the exception. Have you understood? So I'll explain some sections. First of all, (193). 193 is nothing but, sorry, simply says that 193 says that TDS shall be made on interest on securities. interest on securities is subject to TDS as per section 193. So 193 says that interest on securities, whoever paid the interest on securities is required to make TDS from such payment. Okay. Next, threshold limit. Threshold limit is nothing but 10,000. Is nothing but if the security is 8% savings bonds issued in 2003 or 7.75% savings bonds issued in 2018. On these bonds issued in 2003-2018, then TDS shall not be made if interest does not exceed 10,000. That is up to 10,000, no TDS. If your payment exceeds 10,000, then entire amount is subject to TDS. Have you understood? That's the importance of threshold limit. Threshold limit column is very important. So 10,000 threshold limit is applicable only to interest on 8% savings bonds, 7.75% savings bonds. On such bonds, if interest amount less than or equal to 10,000, then no TDS. Exceed 10,000, then entire amount is subject to TDS. 10,000 is the threshold limit. Have you understood? And another threshold limit is there, 5,000. 5,000 threshold limit is applicable subject to the following three conditions. Condition number 1, it was paid on debentures issued by company in which public are substantially interested. Public are substantially interested is nothing but public company. So interest is paid on debentures, whether listed or unlisted, issued by company in which public are substantially interested. And this is one of the condition. Second one is recipient. Recipient must be resident individual or resident HUF. Recipient. Second point, recipient. First point, payer. The interest payable by whom? Company in which public are substantial interest. Okay. What was the payment covered in this? Interest on debentures. Issued by whom? Company in which public are substantial interest. Payable to whom? Is nothing but recipient. Recipient is a resident individual, a resident HUF. And payment shall be made by way of account pay check. If these three conditions were satisfied, then applicable threshold limit is 5,000. Is nothing but up to 5,000, no TDS. If payment exceed 5,000, then entire payment is subject to TDS. For example, if interest is 6,000, entire 6,000 is subject to TDS. Okay. So two threshold limits are there in this. First one, 10,000. 10,000 threshold limit exclusively applicable to 8% savings bond issued in 2003, 7.75% savings bond issued 2018. 5,000 threshold limit is applicable subject to the following three conditions. And in all other cases is nothing but not covered in above two cases, then no threshold limit, nil. No threshold limit is nothing but entire payment is subject to TDS irrespective of amount. Even if amount payable is 100 rupees, then subject to TDS because no threshold limit in all other cases. Okay. 193. What was the payment covered in this? Interest on securities. What was the threshold limit? Here is 10,000 in some cases, 5,000 in some cases. So in all other cases, nil. Who is liable to make TDS? Any payer. To whom the payment shall be made? Recipient may be any resident. Rate of TDS 10%. When TDS shall be made? At the time of payment or at the time of credit the amount, whichever is earlier. Payment the amount or credit the amount, whichever is earlier. Time of deduction. And the last one, there are a lot of exceptions are there, but I'll give you important exceptions. This is one of the important exceptions. Okay. So I don't want to explain the exceptions because it's a time consuming process. And also need not prepare each and every exception. Give you some important exceptions. Please concentrate on those areas. So on securities beneficially held by, securities held by LIC, GIC, subsidiary of LIC or other insurance. Nothing but insurance companies. If interest payable to insurance companies, that is recipient is insurance company, whether LIC, GIC or subsidiary of insurance companies, then the payer is not required to make TDS. It's an exception. So recipient, if it is LIC or GIC or other insurance companies or subsidiary of insurance companies, then the payer is not required to TDS. That's the one of the important exception to this. This is all about section 190. Like that, you can prepare all the sections. Of course, I will explain some more sections. So this is the presentation of this table. How to read this table is very important. Okay, the threshold limit column is very important. And one more section I want to, 194. 194 says that TDS shall be made on dividend payments. Dividend, TDS on dividends. Dividend amount is subject to TDS under section 194. Okay. Next, what was the threshold limit here is amount or aggregate amount of less than or equal to 5,000 in a financial year in case of dividend paid or credited to an individual shareholder by any mode other than cash. Threshold limit 5,000 is nothing but if payment is less than or equal to 5,000, then no TDS. If it exceeds 5,000, entire amount is subject to TDS. But threshold limit is applicable subject to conditions. One is, so the payment must be made by any mode other than cash. And it must be payable to individual shareholders. Individual shareholders, and mode of payment must be any mode other than cash. If these two conditions were satisfied, then 5,000 threshold limit gets attracted. Otherwise, no threshold limit. Okay. So who is liable to make TDS? Principal officer of a company. To whom the payment shall be made? Resident shareholder. Rate of TDS 10%. Okay. Here also LIC, GIC, other insurance companies are exceptions. Is nothing but if dividends payable to these persons, then the payer is not required to make TDS. Okay. If recipient is this person, recipient, then the payer is not required to make TDS. This is the time of deduction. Okay. So one more section. Interest other than interest on securities. Other than interest on securities. Example, deposits, cooperative deposits, post office deposits, bank deposits, all these were covered in this section. In fact, 193 interest on securities, 194A interest other than interest on securities. In fact, this section is more important when compared to 193. Okay. So what was the threshold limit? 5,000. First of all, see, this point is very important. Threshold limit 40,000. Subject to following conditions. If interest payable by banking company, cooperative society engaged in banking business, post office. Threshold limit is 40,000. If payer is any of these following person, then TDS shall be made if payment exceed 40,000. Otherwise, no need. Instead of 40,000, you can apply 50,000 if recipient is a resident individual, resident senior citizen. If recipient is nothing but the interest recipient is resident senior citizen, apply 50,000 instead of 40,000. If he is not a senior citizen, resident senior citizen, then apply 40,000. Okay. So that's the one of the important threshold limit. Interest payable by whom? Banking company, cooperative society engaged in banking business, post office. Threshold limit is 40,000. 50,000 in case of interest received by resident seniors. Okay. So in all other cases is nothing but if not covered in this, then the threshold limit is 5,000. Have you understood? In all other cases, 5,000. That's the important. First read 40,000 point. Then if it was not eligible for 40,000 threshold limit, then apply 5,000 threshold. That's the important point. And one more important point, who is liable to make TDS? Payer. Who is responsible for making TDS here is any person except individual HUF whose turnover in preceding year does not exceed 1 crore or 50 lakhs. Okay, so is nothing but individual HUF is required to make TDS in this section only if their turnover in preceding year exceed 1 crore or 50 lakhs. 1 crore for business persons, 50 lakhs for professional persons. Otherwise, they are not required to make TDS in current previous year. Other than individual HUF, compulsory make TDS in this section, irrespective of their turnover. Turnover condition applicable only to individual HUF, not to other persons. Individual HUF, except any person can make TDS in this section. Any person is liable to make, all persons are liable to make TDS in this section, except 2 persons. Individual HUF, subject to a condition, whose turnover is nothing but the turnover of such individual HUF in preceding year. If it does not exceed 1 crore or 50 lakhs, then they are not required to make TDS in current previous. If it exceeds the limit, then they are also liable to make TDS in current previous. This is the most important payer point. This will be repeated in few more sections also. Okay, so this point is very important. Please read carefully. Important. Exception available to individual HUF. That too, whose turnover in preceding year, if it does not exceed 1 crore or 50 lakhs. 1 crore is for business persons, 50 lakhs is the professional person. Other than individual HUF, mandatory, required to make TDS. Mandatory to make TDS, irrespective of the turnover. Turnover limit not applicable to other than individual HUF. Have you understood? For example, I give you the explanation for this. Individual HUF, preceding year turnover. Current previous year. Preceding year turnover less than or equal to 1 crore or 50 lakhs. Individual HUF, preceding year turnover 1 crore or 50 lakhs. In current previous year, they are not required to make TDS, no TDS. If exceed 1 crore or 50 lakhs, then required to make TDS in current previous. That's it. This condition is applicable only to individual HUF. Other persons always required to make TDS, irrespective of their turnover, other than individual HUF. Compulsory. Don't check the preceding year turnover for other persons. They are always required to make TDS if it exceeds the threshold limit specified in that section. That's the important point. Have you understood? This is the payer point, which is very important and which is applicable to few more sections. Okay. Next. Rate of TDS 10%. So time of deduction, when TDS shall be made, whichever is earlier. Time of credit in the books of accounts, time of payment, whichever is earlier. Exceptions. Some of the exceptions are very important in this. Mainly, second one important. Interest payable by partnership firm to partners, not subject to TDS, even if it exceeds threshold limit. That's an exception to this section. Okay. Second one is interest on income tax refund, not subject to TDS, even if it exceeds threshold limit. No TDS provisions applicable to such payment. Okay. Next one is interest on bank savings account, not subject to TDS. And the next one is interest payable by cooperative society to another cooperative society or cooperative society to members. Internal transactions, not subject to TDS. Cooperative society to cooperative society or cooperative society to members, not subject to TDS. No TDS. Okay. And some of the schemes in post office are also not subject to TDS. Interest on Kisan Vikas Patra, post office Kisan Vikas Patra, Indira Vikas Patra, national savings certificates, monthly income account, all these are not subject to TDS. And some more exceptions are there not covered in this list. Please go and verify in your study material, ICAI material. Some more. Interest payable to banks, not subject to TDS. That's also another point which is important but not covered in this list. Important. Please go and verify in your ICAI material. Few more points are there in this section. Okay. So it's a triple star section. Most important section. In top 5 sections, this is one of the section. Compulsory prepare this 194A section. Okay. So next one. (194C). 194C is nothing but contract payments are subject to TDS under section 194. It's a triple star section. One more triple star section. Contract payments. Contract payments subject to TDS under section 194C. Contract includes subcontract as well as supply of labor also. Any type of contracts, whether advertisement contracts, broadcasting, telecasting, transportation, catering contracts, any type of contracts, including subcontract, supply of labor. All these are subject to TDS under section 194C. Okay. So what was the threshold limit here is individual payment less than, single payment less than or equal to 30,000, not subject to TDS. If aggregate payment less than or equal to 1 lakh, then not subject to TDS. It's nothing but, so TDS shall be made if individual payment exceed 30,000 or aggregate payments made in a financial year exceed 1 lakh. If any one of these satisfied, then subject to TDS. Otherwise, no TDS. Threshold limit point, very important. Either individual payment exceed 30,000 or aggregate payments in a financial year exceed 1 lakh, then subject to TDS. Otherwise, no TDS. Okay. So the payer column is same as 194A. Same as 194A. But the change is same presentation. Whatever the presentation made in 194A, same to be considered in 194C also. But the same is the change is 2 more persons added in this first point. Individual HUF, not only individual HUF, but also AOP BOI also. Other than individual HUF, AOP BOI, whose turnover in preceding year, if it does not exceed 1 crore or 50 lakhs, then not subject to TDS. Otherwise, they are also required to make TDS. AOP BOI. Okay, that's the difference between 194A payer and 194C payer. Except these two, remaining information is same, 194A and 194C. Have you understood? Next one. So rate of TDS. If contractee is nothing but recipient, if recipient is an individual or HUF, payee is nothing but recipient. If recipient here is contractor. If contractor, the person who done the work is the recipient in this. Okay. So here the payee is contractor. If contractor is an individual or HUF, then the rate of TDS is just 1%. If contractor is any other person, if payee is any other person, payee or contractor, same, any other person, then the rate of TDS is 2%. Two TDS rates involved in this section. Please be concentrated. Okay. Next, when TDS shall be made, whichever is earlier, same as above sections. Here is 2 exceptions are there. All 2 exceptions are very important. Please keep in touch with these 2 exceptions because these exceptions were already covered in examinations number of times. very important exceptions. First exception, payment made to a contractor. Contractor is nothing but payee. Payee business engaged in the business of plying, hiring, leasing of goods is nothing but transport operator. The contractor business is transport business. And having a vehicles less than or equal to 10 at any time during the previous year, not having more than 10 vehicles. The contractor, if these three conditions were satisfied by payee is nothing but contractor, then the payer is not required to make any TDS. It's an exception from TDS. Okay. So contractor's business is transportation business. That is one of the condition A, and has not more than 10 vehicles at any time during the previous year, having less than or equal to 10 vehicles at any time during the previous year, and furnish his PAN number to payer. Furnish his PAN to payer. Payer is nothing but contractee. Okay. If these three conditions were satisfied, then that payment is not subject to TDS. That's the one of the important exception to this section. And next one is if payer is an individual HCF, paid by is nothing but payer. Payer is an individual HCF and the work done for the purpose of residential. For example, the work done by the payer is for personal purpose. So two conditions involved in this, payer being individual or HCF, and whatever the work done by the contractor is for personal purpose. If these two conditions were satisfied, then also the payment is not subject to TDS. Okay, these two are very important point. One exception explained in payee point of view. Payee is a contractor. Payee is a contractor and not having more than 10 vehicles at any time and furnish his PAN number to the payer. Then exception is available. Second exception explained with a view of payer is nothing but payer is an individual HCF and the work done by the contractor is for personal purpose. Then the payer is not required to make TDS. Two exceptions, the most popular exceptions and very important. Okay. Next one, 194D, insurance commission is subject to TDS. Whatever the commission paid by insurance company to agents, insurance agents, then subject to TDS under section 194D. What was the threshold limit? 15,000. The commission in a financial year in aggregate, if it does not exceed 15,000, then not subject to TDS. If it exceeds 15,000, then entire amount is subject to TDS. Okay. Payer is nothing but any person, recipient any resident. Rate, here also two rates involved. One is if payee is a non-corporate resident, non-corporate associate other than company, then TDS rate is just 5%. Recipient, payee is nothing but recipient. Who received the payment here? Agent. If agent is a non-corporate, then TDS rate is 5%. If agent is a corporate domestic company, then TDS rate is a 10%. No exceptions to this section. Simple section, easy to prepare. Okay. Threshold limit 15,000. TDS shall be applied only if it exceeds 15,000. If it exceeds 15,000 in a financial year in aggregate, then entire amount is subject to TDS. Otherwise, no need. Okay. Two TDS rates involved in this. Next section, 194DA. So it's also very important section. So this is 194DA says that TDS on maturity proceeds of LIC policy. So whatever the maturity proceeds payable by LIC to policy holders is subject to TDS, including bonus. Okay, have you understood? So that's any sum payable under LIC policy, that's the maturity proceeds of LIC policy is subject to TDS. As per section 194DA, the threshold limit is 1 lakh rupees. Less than 1 lakh is nothing but if policy maturity amount is less than 1 lakh, then no need to make TDS. If it is more than or equal to 1 lakh, then subject to TDS. Entire amount is subject to TDS. Okay. So payer, any person, recipient, any resident, rate of TDS 5%. When TDS shall be made at the time of payment. Here there is an exception. Generally, my dear students, maturity proceeds of LIC policy is some cases exempt from tax under section 1010D. So exempted payments are not subject to TDS. So that if maturity proceeds are eligible for exemption under section 1010D, then not required to make TDS under this section. Whenever 1010D exemption is not available, then only 194DA gets attracted. Okay, the cases where 1010D gets attracted was already discussed in amendment material. My dear students, please go through the amendment material. So 1010D section was explained in that very clearly and with practical example also. Okay, so that whenever 1010D exemption is available for maturity proceeds, then 194DA does not attract. Otherwise, need to make TDS under section 194DA. Okay, next one is 194H. One more triple star section. 194H is nothing but commission brokerage is subject to TDS. Commission or brokerage, payments made to agents or brokers is subject to TDS as per section 194H. Threshold limit is 15,000 in a financial year. If commission brokerage in a financial year, if it does not exceed 15,000, then not subject to TDS, otherwise subject to TDS. So payer who is liable to make TDS is same as 194A. Payer covered in section 194A, as it was discussed already in section 194A, the same payer also covered in this. Okay, that is any person other than individual whose turnover in preceding year does not exceed 1 crore or 50. So rate of TDS 5%. This is an exception. Commission payable by BSNL, MTNL. So to PCO franchises is not subject to TDS. This is an exception to this section. Okay, payable by is nothing but if these persons are payers, then payment is not subject to TDS. Next, 194I, rent. One more triple star section, important section. So rent is subject to TDS. Rent is nothing but rent relating to any asset, not only the building, but also plant and machinery, furniture, vehicles, whatever it is. Whatever the rent payable by any person, then the payment is subject to TDS. Okay, so the threshold limit is 2,40,000 in a financial year. In a financial year, the total rent payable, if it does not exceed 2,40,000, then not subject to TDS. If it exceeds 2,40,000, then subject to TDS. So the paid is same as 194A. So rate 2%. If the asset rented by you is a plant and machinery, then TDS at the rate of 2%. Plant and machinery or equipments, 2%. For all other assets, 10%. Okay. So no TDS if rent payable by rent payable to is nothing but recipient. The recipient is real estate investment trust. Then that payment is not subject to TDS. If the rent received by real estate investment trust, then the amount, the rent payable by any person, no need to make any TDS on such payment if it was received by real estate investment. Okay. Next, 194IA, transfer of immovable property. One more important section, sale of immovable property, transfer of immovable property. Then who is payer? Buyer. Buyer is required to make TDS on payment, on consideration, if it exceed 50 lakhs. If it is less than 50 lakhs, then not subject to TDS. And more than or equal to 50 lakhs, then subject to TDS. Okay, 50 lakhs is the threshold limit. So, but one more important point, threshold limit is nothing but consideration or stamp duty value, whatever it is. Either consideration or stamp duty value, whatever it is. If it is more than or equal to 50 lakhs, then subject to TDS. Have you understood? Okay. Rate of TDS is 1%. One of the important exception here is rural agricultural land. On transfer of rural agricultural land, then the consideration is not subject to TDS. This is an exception, important exception to this section. Next one, 194J, one more triple star section. My dear students, most popular section. This section says the TDS on 5 different payments. Fee for professional services, fee for technical services, royalty, non-compete fee, director's remuneration. All these payments are subject to TDS as per section 194DA. Threshold limit is nothing but 30,000. 30,000 for individual payments. For each payment, the threshold limit is 30,000. Each payment, if it exceeds 30,000, then subject to TDS. Otherwise, no date in a financial year. But however, threshold limit is not applicable to director sitting fee. So, no threshold limit to director sitting fee. Therefore, director's remuneration subject to TDS irrespective of the amount, because no threshold limit. Threshold limit is applicable only to first 4 payments: professional payment, technical payments, royalty, non-compete fee. Okay, 30,000 is the threshold limit. The payer is any person other than individual, just like 194A. Okay, so rate of TDS is generally 10%. 10% rate is important. 10% is applicable TDS rate in this section, but in some cases apply 2% instead of 10%. That is fee for operation of call centers. In this case, the TDS rate is 2%. And distribution, exhibition of cinematographic films. So, consideration for distribution or exhibition of cinematographic films is subject to TDS at the rate of 2%. Technical fee also subject to 2%. Technical fee point also important. In all other cases, 10%. Okay. So, and exception is also important here. Exception just like a second exception in 194C section, contract section. Just like a second exception. If payer is individual HUF and the work was done for personal purpose. If these two conditions were satisfied, then exception is available. Then not subject to TDS. Okay. And one more important point, payable by whom? Individual HUF. The payment is fee for professional services. Only professional fee. Payable by individual HUF. And the work for personal purpose. In these 3 cases, 3 conditions were satisfied, then it's an exception to section 194J. Then the payment is not subject to TDS. Have you understood? Next, 194. N. 194P. 194P is nothing but specified senior citizen. Total income of specified senior citizen is subject to TDS. Total income of specified senior citizen. So please go through the definition of specified senior citizen. It's very important. Specified senior citizen is nothing but, so he is a resident in India and age more than or equal to 75 years. Okay. So, and one more important point is having only interest income, having only pension. And he may have an interest also which was received from same bank account in which the pension was received. So, So condition number 1, resident in India. So actually the definition of specified senior citizen given here. Please verify it carefully. Specified senior citizen is nothing but resident in India. That's the one of the condition. Age 75 years or more, having only pension income, and he should not have any other income except interest. He may have interest income also, but subject to a condition, it should also be received from same account in which he received pension. Okay, same bank account, he received both pension as well as interest. So that's income except interest. Income received are relevant from any account maintained by such individual from same specified bank in which he receiving pension. That's the important point. So these are the conditions to be satisfied to get the status of specified senior citizen. If he is a specified senior citizen, then his total income is subject to TDS under section 194P. 194P, total income. Total income is nothing but pension plus interest received from same specified bank. Then the bank is required to make TDS on his total income as per section 194P. At the rates of slab rates is nothing but need to follow here income tax rates, slab rates, whatever the slab rates applicable to him to be followed as it is by specified bank while making TDS as per section 194P. Okay, the threshold limit is 5 lakhs or 3 lakhs is nothing but whenever the slab rates were followed by payer, then automatically the threshold limit is the basic exemption. Basic exemption limit is the threshold limit. Okay, so who is liable to make TDS? Specified bank. Who is the recipient here? Specified senior citizen. When TDS shall be made? At the time of payment. So simple section, but definition of specified senior citizen is very important. This section is applicable only if payments made by a specified bank to a specified senior citizen. Okay, then subject to TDS as per income tax rates, slab rates. If it exceed basic exemption limit, so that's the important cut. But important specified senior citizen definition is very important. So if the total income of specified senior citizen as subject to TDS under section 194P, whenever the TDS was made under this section on total income of specified senior citizen, then there is a benefit to him provided by the government, that is such specified senior citizen need not file income tax, provided an exception to filing the return of income under section 139. That's the benefit provided to such person if his total income was subject to TDS under section 194P. Have you understood? So my dear students, like this you need to prepare the entire table, TDS table. Table itself is very important due to time constraint. So I'm not explaining all the sections involved in this table. Just I want to give you so how to prepare this table. Okay, so please go through the table and remaining sections also. In fact, remaining sections also very important. In fact, 194Q, it's a triple star section. Okay, 194M also important. Next, so I want to explain some TCS provisions also and go through the TCS table. So TCS is the exact opposite to TDS. The person who make the TDS, the exact opposite person is required to collect TCS. So for example, for sale transaction, who is the payer? Buyer. Buyer is required to make TDS. For same sale transaction, if TCS gets attracted, then the seller is required to collect TCS. So generally on sale of any product, the seller need to collect consideration from buyer. In addition to, the seller is required to collect TCS also. It's nothing but you need to collect consideration plus TCS. Okay. So some of the TCS, around 5-6 TCS sections are there. The first one is 206C1, sale of certain goods. Goods specified here. So whatever the goods specified here, so alcoholic liquor for human consumption, tendu leaves, timber obtained from forest, whatever the goods specified here, if these goods were sold by any person to any other person, then the seller is required to collect TCS from buyer. Who is required to collect TCS? Seller. From whom? Buyer. On sale of these specified goods at the rates specified here. These are the TCS rates. Whatever the rate applicable to such type of goods to be followed as it is while collecting TCS. No threshold limit. No threshold limit applicable here. Is nothing but entire amount, irrespective of amount, TCS provisions gets attracted. Have you understood? But however, there is an important note point for this. If buyer proved that the goods were purchased, this is one of the important point. If the buyer proved that the goods were purchased for manufacturing activity or generation of power and furnish a declaration, then this section does not attracted. Exception to section. Exception. Then no need to collect TCS by seller. If buyer furnishes a declaration that the goods were purchased to be utilized in manufacturing of articles and things, or the goods were purchased for the purpose of generation of power. In those cases, if buyer furnished any declaration to the seller, then seller need not collect any TCS. That's an exception and important also. Okay. So next one. Next TCS section is 206C1C. 206C1C says that lease, license, contract of parking lots, toll plaza, mines, quarries. So parking lots, toll plaza, mines, quarries. Any of these given to any other person on lease, license, contract, leasing, licensing, contract of toll plaza, parking lots, mines, quarries. Then the person who given is liable to collect TCS from person who taking this on lease or license or contract. It's nothing but in case of lease, the lessor is required to collect TCS from lessee. In addition to lease payment, is nothing but in addition to consideration, the lessor is required to collect TCS also at the rate of 2%. Have you understood? So leasing, licensing, contracting of either toll plaza, parking lots, mines, quarries. The person who giving is required to collect TCS in addition to consideration. Have you understood? And next one is sale of motor vehicles. Sale of motor vehicles. Of course, in 206C1C, no threshold limit. Irrespective of payment, subject to TCS. But 206C1F, sale of motor vehicles. Sale of motor vehicle exceed 10 lakhs. This is a threshold limit. Threshold limit. The seller is required to collect TCS from buyer at the rate of 1%. Okay. So, simple TCS sections is very simple when compared to TDS section. Very easy to prepare. Don't neglect compulsory frequently asking problems from TCS areas also. So next one, 206C 1G. My dear student, this is most important section. Last two are most important sections in this chapter. Last two, 206C 1G. Last three, of course. Last three, sale of motor vehicles, 206C 1G and 206C 1H also. These three sections are very important. Please be prepared carefully. Okay. 206C 1G. In fact, in this section, there are two parts involved. One is overseas purchase of sale of overseas tour program. Sale of overseas tour program. Whenever sale transaction involved, then automatically the seller is required to collect TCS from buyer. Sale of overseas tour program. Who is required to collect TCS? Seller. From whom? Buyer. But there is no threshold limit. Have you understood? This is the applicable TCS rate for here. But there is an amendment also in Finance Act 2023. So be prepared carefully. Important. If you have any doubts on this section, please go through the amendment material. Provided a clear explanation in amendment material. Okay. So around two sections, two subparts, two parts involved in 206C 1G. First transaction is sale of overseas tour program package. It's nothing but in India, so many of the families regularly visiting other countries. So at that time, they are acquiring program packages to visit so and so country, number of days. So packages for the adults who so many of travels are there in India offered this type of packages. Exclusively maximum tourism purpose. So whoever want to visit other countries on tourism basis, they are required to purchase the packages from travels. The travels who sold such package is required to collect TCS as per section under 206C 1G. So therefore, the seller is required to collect, the seller who sold the package is required to collect TCS from buyer at the rate of 5%. 5% if it was purchased up to 30th 9 2023. Thereafter, up to 7 lakhs 5%. In excess of 7 lakhs is 20%. For example, purchased 10 lakhs worth package after 1/10/2023 up to 7 lakhs 5%. Balance 3 lakhs into 20%. Okay, that's the TDS rate increased if it was purchased on or after 1/10/2023. No threshold limit. If it was purchased before 1/10/2023, that is up to 30th 9 2023, entered amount is subject to TCS at the rate of 5%. No, not applicable. 20% rate not applicable if date of purchase before that. Okay, no threshold limit here. And the next one is another transaction covered in same section 206C 1G. Okay, so amount remitted to outside India through liberalized remittance system is nothing but through authorized banking channels, through mediators. Remittance, money remitted outside India. Remittance of money to outside India through authorized dealers. Then the authorized dealers is required to collect TCS from person who want to remit the money. Who is liable to make TCS? Authorized dealer. From whom? A person remitting such amount. Okay. So that's the important point. And here threshold limit is applicable 7 lakhs. 7 lakhs threshold limit applicable here. Okay. Next, rate of TCS. Rate column is very important in this. Please be concentrate and go through the amendment material. So this was explained clearly in amendment material. It will take some time. Okay. I'll explain in simple manner here. First of all, the purpose for remitting the money is education and medical treatment. Education purpose and medical treatment purpose. If you want to remit the money through an authorized dealer, then the authorized dealer is required to collect TCS 5% up to 30th 9/23. Thereafter also 5%. Always 5%, irrespective of date of remittance. Have you understood? And second one is, please, point number 3. Immediately, please read the point number 3. So, if it was remitted for education purpose, amount being remitted out of his loan obtained from any financial institution defined in section 80 for the purpose of pursuing any education. It's also an education purpose. But the amount taken on loan from a financial institution, that is loan involved in this point. Taken a loan from any bank and remitted to outside India, then covered in third point. The first point says that remittance of money out of your pocket. You have not taken any loan in that first point, but loan involved in point number 6. Okay. So it's a beneficial to some incapacitated persons, applicable to third point. Then the applicable rate is 0.5% instead of 5%. That's the difference between first point and last point. If you want to remit the education, remit the amount out of your pocket for education purpose to outside India, then you will be covered in first point. If you will take the education loan from any banks or financial institution and remit the same through an authorized dealer, then you will be covered in third point. Then the applicable TCS rate is 0.5% only. That's the difference between first point and last point. And in first point, medical purpose was also covered, but in last point, no medical purpose was covered. Okay. And in all other cases, so if you want to remit the money for any other purpose, for example, import of goods, payment for import of any other goods other than education and medical, then applicable rate is up to 30th 9, 5%, thereafter 20%. That's it. Here threshold limit gets attracted. 7 lakhs is the threshold limit. Okay. So if you want to remit more than 7 lakhs, then excess amount is subject to TCS, not entire amount. But in sale of motor vehicles, if you remit, if you have purchased the vehicle value exceed 10 lakhs, then entire amount is subject to TCS. Okay, that's also an important observation. And my dear students, 206C1H, it's a connected section with 194Q of TDS. TDS 194Q. So I'll explain some differences between 206C1H, 194Q. That's you need to prepare these two sections comprehensive, combinedly. Then only you will get confidence on these sections. Otherwise, you may get confused. Okay. So first of all, I'll explain the differences between 194Q and 206C1H. 194Q. 206C1H. The first point is sale of any goods. The transaction covered in this section is what 206C1H, sale of any goods. But what about 194Q? Purchase of any goods, exact opposite. So here purchase of any goods, eligible transaction. purchase of any goods. Sale of any goods. Okay. Second one is threshold limit, 50 lakhs. Here also same, 50 lakhs. So say purchase of any goods, if it exceed 50 lakhs, value exceed 50 lakhs. Here sale of goods exceed 50 lakhs. Here subject to TCS, TDS, here subject to TCS. Okay. And the next one is third point, rate of, and who is liable to collect TCS? Here seller, but there buyer. Because in TDS, who is liable to make TDS? Payer. Payer is nothing but in sale transaction, the payer, who is the payer? Buyer. Therefore, buyer is required to deduct TDS. But here is seller is required to collect TCS, because TCS is exact opposite to TDS. Okay. So person liable to make TCS. Third point, person liable. Here is buyer. Buyer is liable to make TDS. Here is seller. Okay. Threshold limit, if it exceed 50 lakhs, then in excess of 50 lakhs is subject to TCS, TDS or TCS. Have you understood? Next. Rate. (0.1%). Here also 0.1%. Okay. But one more important point here is rate column. If buyer does not furnish PAN or Aadhaar, then 1% rate applicable instead of 0.1%. 1%. If buyer has not furnished PAN or Aadhaar. That's the important point. Here also at the rate of similar provision is there in TDS also. (5% in case of 50 if PAN is not provided. If PAN was not provided, then applicable rate is 5%. That's it. That's the important analysis between 206C1H and as well as 194Q. So if you prepared like this combinedly both the sections, so you will get full clarity on these two sections. Okay, because both are interconnected sections. But here is one thing you should remember. If same transaction, and one more important point here is one of the condition is nothing but who is liable to make TCS? Buyer. Who is liable to make buyer whose turnover in preceding financial year exceed 10 crores. That's the important condition in applicable to both buyer as well as sellers. So whose turnover, that's the important point. Whose turnover in preceding year exceed 10 crores. Then only is required to make TDS in this section. That's the important condition. Here also the same condition applicable to seller. Whose turnover in preceding previous year exceed 10 crores. Same condition is applicable to buyer in case of 194Q. seller in case of 206C1. That's the important. Have you understood? For example, I give you a combined analysis of this section. If same transaction, both TDS and TCS applicable, then need not apply both the sections. So I give you practical example for that. Just wait. The buyer 194Q. The buyer for this purpose, any person whose total turnover from the business carried on by exceed 10 crores during the immediately preceding. This is the condition applicable to 194Q. Same condition is there in 206C1H also, but applicable to seller. Okay. So now one more point. For example, X sold goods to Y. To Y. Rupees 60 lakhs. Worth 60 lakhs. So now the question is, in this transaction, X is the seller, Y is the buyer. The value of goods also exceed 50 lakhs. Therefore, X point of view, 206C1H gets attracted. Y point of view, 194Q gets attracted. 206C1H, 194Q. But now the question is, in same transaction, both buyer and seller is required to collect and deduct the tax. It's an unfavorable to assessee, because of it may lead to double deduction of tax. So that's why Act says that, so on same transaction, if both buyer and seller, so for example, if seller's turnover, please verify the condition, 10 crores condition. If 10 crores condition was satisfied by the seller, but not satisfied by buyer, is nothing but X turnover in preceding year exceed 10 crores, but Y turnover not exceed 10 crores in preceding financial year. Therefore, X is only required to collect TCS, but Y need not made any TDS, because 194Q not attracted, because his turnover in preceding year not exceed 10 crores. Have you understood? So for example, due to avoidance, for important point, turnover in preceding previous year is 12 crores. In preceding previous year, turnover is equal to just 8 crores. Then apply TCS provision, don't apply TDS. Seller is required to collect TCS. It's sufficient. Buyer need not make any TDS on that. Have you understood? If seller's turnover is 8 crores, buyer's turnover is 12 crores in preceding previous year, then apply TDS provision, don't apply TCS provision. It is sufficient to make TDS. It is sufficient to deduct the tax under section 194Q by buyer. Seller need not collect any tax, because here applicable section only TDS section. But what about if both the persons' turnover exceed 10 crores? The buyer's turnover 12 crores, seller's turnover also 12 crores. In this case, both TDS, TCS applicable. But Act says that if same transaction, both TDS and TCS gets attracted, then apply TDS under section 194Q. Ignore TCS. That's it. Have you understood? So in same transaction, if both the TDS provision and TCS provisions applicable, then it is sufficient to make TDS under section 194Q. Don't apply TDS. Just ignore the TCS provision, even if it applicable. Okay, that's the important. This is the important point. If only one section was, If only one section was applied, then need to follow the same section, 194Q or 290. If both the sections get subtracted, then follow 194Q, ignore 206C, 1C. That's the important analysis. Okay. My dear students, I will explain some more points relating to TDS chapter. Just wait. Applicability of surcharge and education. Is surcharge and education just will applied while making TDS? The provision is if payments made to residents, if payments made to resident is nothing but recipient is a resident, then apply surcharge rate and education cess also in addition to TDS. Okay. So TDS including surcharge and education cess shall be deducted because the recipient is a non-resident. If payments made to non-resident, so please important, if payment made to non-resident, then apply surcharge and education cess also. Okay. If payment made to residents, if payment made to resident, need not apply surcharge and education cess except salary payment. For salary payment, apply surcharge and education cess also. For all other payments, surcharge and education cess need not apply. Okay. This is also one of the important point. Next one. (194C). So my dear students, these two sections, 206CAA, 206CAB. 206AA says that, so in all TDS provisions, in all TDS sections, 192 to 194 are, whatever the TDS sections covered in section 192 to 194 are. So in all TDS sections, the payee is required to furnish his PAN number to payer. That's the mandatory condition to be satisfied. Then only the TDS rate, whatever the rate specified in that column, rate column, to be applied as it is. If not, then higher TDS shall be made as per section 206CAA. Okay. So Act says that any person who received is nothing but payee. Payee is subject to furnish his PAN number to deductor. Deductor is nothing but payer. So payee is required to furnish his PAN to payer. Payee is nothing but recipient. Recipient is required to furnish his PAN to payer. Then only the respective TDS rate gets attracted. The TDS shall be made as per the rate specified in rate column. But in case of violation of this provision is applicable to all sections. Okay. In case of violation, the deduction of tax at source at higher of the following, higher TDS shall be made as per section 206A. What was the rate? Rate specified in the Act, that is rate specified in the column, rate column. For example, in rate column, TDS rate is 1%. 1%, or ignore B bit, just to C, 20%, whichever is higher. Instead of applicable rate, the payer is required to make higher TDS. Rate applicable, for example, rate applicable in that column is 1%. 1% or 20%, whichever is higher. Therefore, 20% TDS rate gets attracted instead of 1%. If PAN was furnished by payee to the payer, then applicable rate is 1%. If not furnished, then 1% or 20%, whichever is higher, that is 20%. Higher TDS shall be made in case of violation of this provision. Okay. And one more important point, in section 194Q, apply 5% instead of 20%. In 194Q, rate specified in that column, that is 0.1%. That is the TDS rate in 194Q. If PAN has furnished by payee to the payer, then 0.1% gets attracted. If not, then 0.1% or 5%, whichever is higher to be deducted. Except 194Q, for all other sections, higher TDS rate is 20%. Okay, that's the important point. And so this is the main section, main point in this 206C, 206AA. This section is applicable to all TDS, connected to all TDS sections. Whatever the rates specified in respective TDS sections are applicable, subject to a condition, payee required to furnish his PAN to payer. If not, instead of that rate, apply 20%. Except 194Q, in that apply 5%. Okay, this is also important point. Next one is section 200. This is, my dear student, what was the responsibility of the payer? The first one is making TDS as per section, whatever the section applicable for such payment. Second one is the deducted amount of TDS shall be deposited into government account within the due dates. What are the due dates specified here? Okay, so the TDS amount shall be deposited into government account on monthly basis, monthly deposits. Okay, so for each month TDS shall be deposited into government account by 7th of the next month. That's the important point. For April month, aggregate TDS amount shall be deposited in on or before May 7th. For May month, TDS amount shall be deposited into government account on or before June 7th. Okay, need to follow same due date but till February month. But what about March month? So the March month TDS shall be deposited in next month 30th, that is April 30th. Okay, so of course the conclusion is the TDS amount shall be deposited into government account on monthly basis. Generally for first 11 months. So next month 7th is the due date. For last month, that is March month, next month 30th. That's the important point. And the third responsibility of payer is furnish a quarterly statements to DGIT. Quarterly statements to be submitted. To Director General of Income Tax Systems. Okay, so quarterly statement to be submitted. What are the due dates to be followed for submitting the certificates? First quarter ending June 30th, April, May, June 30th. The due date is July 31st is the due date. So last date of the next month after ending of the quarter. Okay, the first quarter ending date is 30th June. The due date is July 31st. Second quarter ended on 30th September. Then the due date is 31st October. Third quarter ends on 31st December. The due date is January 31st. For last quarter, the due date is May 31st. Okay, so these are the due dates to be followed for submitting quarterly statements to the Director General of Income Tax. This is the responsibility of the payer. Okay, payer is having 4 types of responsibilities mainly in this chapter. One is making TDS. Second one is deposit the TDS amount into government account. Third one is furnishing quarterly statements to the Director General of Income Tax. And the fourth one is issue TDS certificates to the recipient to enable him to claim credit of such TDS amount from his tax liability at the time of final settlement. Okay, so TDS certificates. This is 203. TDS certificates. Certificates. Form 16, Form 16A. So Form 16 shall be issued annually. Form 16A shall be issued quarterly. 16 is applicable only on TDS on salary payment. 16A applicable TDS on all other payments. For example, for 192, Form 16 will be issued. For all other sections, Form 16A will be issued. That's the difference. Form 16 will be issued annually. Form 16A will be issued quarterly. Okay, the due date is provided here. Form 16, the due date is 15th June because the ending date of financial year is March 31st. After March 31st, so there are 2.5 months time limit will be provided here. March 31st, the year ending date is March 31st. Therefore, the Form 16 will be issued by employer to employee on or before June 15, April, May, June 15, 2.5 months. Form 16A will be issued quarterly basis. What was the due date? Within 15 days from the due date specified for furnishing the statements. Whatever the due date specified in quarterly statements, from this date, within 15 days, the certificates shall be issued. That's the due date for TDS certificates under section 203. Okay. So the due date for certificates is within 15 days from the due date of furnishing the statements. First to furnish the statements, then issue the certificate within 15 days. Okay, that's the important. My dear students, this is all about TDS and TCS chapter. Let's close here. Hope you are understood well. So if you really like this Mardhan session, please like, share and subscribe my channel. Okay.